America. Equity futures right now on the S&P totally unchanged, almost. We're positive by 0.01%. Coming up shortly, Tom Porcelli of PGIM Fixed Income to weigh in on that inflation data. Mike McKee is going to be with us around the table as well, as is Regina Mayer of KPMG, because on CPI Wednesday, TK, we have got to talk about the price of a barrel of oil. WTI and Brent at new highs for 2023.
Regina Mayer brings a great scholarship to this, and next week in London, I believe we're scheduled to meet with Christian Malik, who's just brilliant on EM demand and such. And you know, I made as a joke earlier the stew that's out there, but you look at the airline shortfall, what it's done to that sector, if you will, back to pandemic, literally back to pandemic lows. And the basic idea I would have is, are we going to get clarity here in 17?
I'm head chef at the Mariah, an unbelievable cultural oasis. People from all over the world get to experience fine dining, arts, and events here. And it's my home, a reflection of Saudi's culture and beauty.
Us, along with many in the street, were looking for a slowdown and looking for a recession this year, and it just hasn't manifested.
It's still a very strong labor market.
The U.S. economy is far from robust. It's still in positive territory, absolutely, but the momentum seems to be shifting to the downside.
I think the consumer is incredibly stretched right now.
I think the reaction function of investors is to get out quick if the data starts to deteriorate.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Inflation in America, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market slightly negative on the S&P 500. 2 hours and 30 minutes away from CPI in America. TK, that report just around the corner.
It's like Howard Johnson's 28 flavors to measure. My measurement, somebody stopped me on the street last night and said, what do you look at? And I look at Cleveland CPI. There's different names for it, not the nowcast. Everybody's nowcasting. Do you know there's Bramo nowcasting?
We've got a Bramo nowcast.
Bramo nowcast is a level of gloom that's out there. It's pretty high this morning, actually. But the answer is I look at Cleveland CPI. We're not going to go into the details now, but it's at 4.80% coming down. And if that comes down again off the data this morning, that's called disinflation.
Later on today, it's about the split, Lisa, the split between headline CPI elevated, led by gas prices, core CPI, potentially showing more progress for this Federal Reserve.
My concern is what levels are actually going to change the needle for people who are not going to look at one print. The Fed's going to say they're not going to look at one print. So my key question today is how big of a miss or how big of a hit of a boost could you potentially see a reaction from? In other words, where is the threshold and where is the market biased to, an upside or a downside surprise?
If this sets us up for the Federal Reserve next Wednesday, we need to set up for the ECB this Thursday, stuck between a rock and a hard place. Reports yesterday from Reuters that this ECB might have to upgrade their inflation outlook for next year to north of 3%, Tom. That's going in the wrong direction. And then moments ago, reports suggesting Germany will have to downgrade their outlook for growth this year to a contraction, never mind stagnation. We're talking about the biggest economy in the Eurozone in contraction for the year, and the ECB upgrading its forecast for inflation potentially Thursday for next year.
Former President Summers of Harvard leads the charge on this. I'll let Larry Summers speak about, does it smell, does it feel, does it look like stagflation? I think it does.
Smells like it, right?
Yeah.
What do you do if you're President Lagarde on Thursday?
The textbooks don't tell you. That's why people stop and listen to Larry Summers on this, and frankly others as well. Which do you attack? Do you attack growth? The politicians are going to attack growth every time. Or do you go, OMG, we got to do something here? And The distinction here is this word austerity. You remember it, and it was the cant in London around Brexit. But are you going to goose the economy in Germany? That's anathema to their economic culture.
That's a conversation for a little bit later.
Yeah.
Let's start the conversation in the equity market on the S&P 500. Pretty muted price action. Equity futures here negative by 0.07%. In the commodity market, new highs for the year.
Yeah.
On crude. We're getting closer and closer to 90 on WTI, through that level in the past week or so on Brent. Lisa, right here, right now on WTI, 89.36.
Which is going to be a key component of the discussion at 8:30 a.m. when we get the CPI print and the headline number. How much has it been increased by the price of gas? I'm also looking at real wages, which is calculated once you take a look at inflation. And you can see they've started to tick down. And yesterday, the Census Bureau put out a report saying that U.S. inflation-adjusted household income fell last year by the most in over a decade. Keep an eye on this. Today, Barclays Global Financial Services Conference continues. Citi CFO Mark Mason speaking at 10:30 a.m. Yesterday, David Sullivan of Goldman Sachs talking about those capital rules, slamming them yet again. We heard that from Jamie Dimon, basically saying that this is going to restrict access to companies big and small. And at 2 p.m., this is the other thing that kind of has come under the radar, is real yields has really led this whole charge up in yields. And we're going to get the August U.S. budget statement. How much of this is just the U.S. is getting more in debt and selling more debt to cover that? And is this really going to get juiced as we see that increase later today?
Lisa, thank you. Looking ahead to AMH a little bit later this morning down in Washington. Need to talk about the potential for a strike in Detroit as well, Tom. Listen to this from Jim Farley of Ford. I think this line is so important. What these wage negotiations mean to them. There is a line in the sand for the sustainability of the company. The sustainability of the company.
Oh,
we heard that yesterday as well
this
about the viability of the company. Can they really take on the kind of pay raises that UAW, Tom, is pushing for?
I interviewed Bill Ford once, and we've known each other for years. The guy is very good at pond hockey, John. You'd be great at pond hockey. You go north of Dearborn, way up in the Michigan.
It's like Mighty Ducks.
Climbs, like Mighty Ducks,
like Mighty
except
Ducks.
you're outdoors.
I'm all about pond hockey.
No, you're outdoors, and you're on the ponds, and you're competing with old farts, and Bill Ford leads a charge on this. We're talking about pond hockey, and then we talked about the fabric of the family. We didn't go bankrupt. They did. And Farley's channeling that. Ford and Dearborn, they will do everything they can to avoid what they avoided back when Steve Ratner was car czar.
Back in the day.
Around
the financial crisis, of course. MH joining us next hour. Anne-Marie from Washington, D.C. Joining us now, Larry Adam, Chief Investment Officer over at Raymond James. Larry, let's start with 8:31. What are we looking for at 8:31, a minute after we've had that inflation report? What would you expect to see, and how would you expect this market to respond to it?
So I think obviously we're going to get mixed results when it comes to inflation, headline moving higher, but I would still focus on the core number because I think that number is going to continue to go lower. And I think that's the broader picture of what's happening with inflation. I think inflation is going lower. When you look at this economy, it is starting to slow. It's going to continue to slow as we go into next year. When you look at goods pricing, yesterday the Adobe Digital Price Index came out, and for 12 months in a row, goods pricing has gone lower. More importantly, it's at a 40-month low. And then I think we're going to continue to get supplemented with lower prices with the fact that shelter prices are going to start to be reflected in these numbers. And keep in mind that if you look at real-time data like Zillow, this core CPI number would probably be below 3% if we were to switch out and put some real-time indicators in that. So I think that trend is going to continue to show deceleration in inflation.
Larry, bring it over to the stock market, and let's get real right now on nominal GDP. Nominal GDP ties directly into revenue growth, et cetera. Are we anywhere near the tipping point where we see substantial lessening of revenue growth because the nominal GDP comes in lower?
I think we're actually going to go into a mild short recession going into next year. And to your point, I make it really simple, and that it's simple in the sense that, do you think you're going to spend the same or less over the next 6 months that you did over the previous 6 months? And when we do our proprietary surveys, most clients say they're going to spend the same or less over the next 6 months. Now, assuming that job growth remains constant, that means you're in a recession because after inflation, to your point, you're in a recession. So I think you're going to start to see this economy modestly struggle as we get into early next year.
Well, mildly struggled, that's fine. Give me an SPX update here. I mean, we're sort of at the atom level on the stock market. Can you get more enthusiastic as corporations adjust to your recession?
Now, to your point, where our target for this year is 4,400. I think one thing to keep in mind is that we've only seen 5% pullback so far year to date. Historically, you get 3 to 4 5% or more pullbacks in a given year. So I think time is there that you're likely to see some downward pressure in this equity market over the next couple of months. I think that'll set up a better buying opportunity as we go into next year. And to your point, when it comes to inflation, I'm not so sure if inflation comes in as people expect, particularly on the core, you're going to see a big rally. We've been rallying on the same news for most of this summer. So I don't think that's going to lead to a big upside just if those numbers continue to show a deceleration in inflation.
Larry, back in August when you came on with us, you were talking about how you became cautious, which is notable because you were really optimistic for a lot of the year. Does cautious mean buy tech? How do you express caution in an equity market that's been driven by the biggest companies that, albeit there was a somewhat soft reaction yesterday, have been really delivering?
Well, tech continues to be one of the areas that we do like. If you look at our favorite sectors, they tend to be the ones that have, in our mind, the most attractive valuations. Tech falls into that realm. I know some people think that's not correct because it has an elevated PE, but we always want to look at what is going to be in the future. And when you look at tech earnings, it continues to be that one sector that consistently beats its expectations. And when you start to apply the consistent beats that we've been seeing, tech's really not all that expensive. And that's one area where if growth gets constrained, that's one place where investors can look for growth. And I think you'll continue to see fund flows into that sector.
Well, here's an area that's struggling right now, Larry. Let me bring you some news. Spirit Air is cutting its third quarter total revenue forecast, blaming increased fuel prices and steep discounting. Their stock is down about 2.8%. For anyone following the airlines and the S&P 500 down about 20% from the July highs. So the airlines have already been punished over the last couple of months, TK. Fuel prices are up, costs are bad. And ultimately, are we starting to see some pressure domestically that's leading to lower fares? On Inflation Wednesday in America, this is a big part of the conversation.
What I do is I go to Google Flights, real scientific, John. I go to Google Flights, I go New York to LA economy, what's the price? And the answer is lower. I mean, United Airlines doesn't have the problems of Spirit, but they're $275 and Spirit's $197. I mean, that's the price discount. That's a big discount by Spirit, but $197 to go that far?
Sure.
Who's making money?
Larry, talk to me about this. I wonder if this is a Spirit problem or if this is a broader story. We've got higher costs off the back of higher crude prices, higher fuel prices, and maybe testing our ability to pass them on to the consumer. Is there a story there for you, Larry?
Yeah, I mean, it's a pretty complex story. First of all, I do think the consumer is going to struggle going forward. Third quarter growth is going to be pretty healthy, right? We all knew third quarter was going to be healthy because everybody was getting out into what we call the summer of revenge travel too. But looking forward, as you mentioned, we've already seen a lot more struggles with the pricing going forward as people are starting to pull back on their travel. So I think that is a big issue and why we think we're going to go to a recession. Higher energy prices is going to continue to cool spending by the consumer. As we approach $4 a gallon, I think that's going to conserve people's what they have to spend, and that's going to further lead to some weakness by consumer spending into the year end.
What gives you confidence that the decline in consumer spending, Larry, is going to be short-lived and shallow and not something deeper if there is some sort of true recession with a feedback loop?
Well, again, we think it's going to be a mild recession because in many ways we've already had some rotating recessions to come into this. So I don't think it's going to be as broad-based, but I do think that the consumer being the biggest part of the economy is going to have a digestion period. And that's what's going to lead to this mild recession. When I mean mild, I think it's going to last 6 months. I think total growth being subtracted is going to be about 0.5% instead of 2.5%. And the total number of jobs being lost, we think it's going to be around 500,000. Historically, in a recession, you lose about 2.5 million jobs. So that's why I don't think you're going to see a total deep rollover in consumer spending.
Larry, great to get your input this morning to kick off our programme ahead of CPI in America. Larry Adam there of Raymond James. Your equity market pulling back just a touch on a session at the moment near session lows. We're negative here by 0.2% on the S&P 500. The latest news in the last couple of minutes from Spirit Airlines cutting their outlook for their third quarter forecast third quarter revenue off the back of increased fuel prices and steep discounting. That stock negative, Tom, by 2.8%.
I look at LAX. Bramo emails me. She goes, "Would you look at Paris? We're thinking late October."
Is this business class or first?
I look at business class. Bramo only goes business class.
Stop projecting.
I'm looking.
Exactly.
I'm looking at the international flight. I look at it used to be about $7,000 one ticket business class, $14,000 for a loving couple. It's gone from $7,000 plus to $3,148.
That's a change.
That's wow.
So that's international.
I think this weekend.
International arguably is where some of the strength might have been. Domestically, Lisa, where Spirit is focused, that's where the struggle has already been flagged.
Which is the reason why I liked your question to Larry about, is this a broader story, especially if this is an airline that caters to families, that caters to vacations, that caters to people who are watching their budgets. Are you starting to see more of a pullback there? We've seen mixed signals. Yesterday, Walmart CEO didn't necessarily have that kind of tone in an interview, but there is this feeling that there are people who are getting severely hammered by inflation and by wages that aren't keeping up.
How's your budget for this? USB-C to Lightning adapter, $29 on the Apple website.
Loved it.
$29.
Love the dongle.
You're buying that? You're getting the dongle, the adapter?
You think? 3 or 4?
Goodness sake.
But it includes a cord.
I thought it was fascinating.
But not the actual thing.
You know, we could talk about this through the show. Inflation leads today. But, John, I thought the Apple soiree was fascinating. Ludlow killed it.
He was great, wasn't he?
Yes,
Yeah, he's fantastic.
He's
Did a brilliant job. Tom Ford coming up a little bit later of D.A. Davidson on Apple from New York City this morning with inflation data a few hours away. Good morning.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Since the very first iPhone, we focused on giving our users a device that's incredibly powerful, remarkably easy to use, and beautifully designed. Every year, we've built on this foundation to create experiences that make a real difference in our users' daily lives. Today, we're pushing what users love about iPhone even further.
There's so much marketing buzzword stuff in that, Tom. Experiences. Beautiful. Apple CEO Tim Cook yesterday at their annual product launch announcing the new iPhone 15, the stock lower off the back of it, lower again this morning by 0.5%. Tom Ford over at D.A. Davidson. Here's the quote, Tom, killer quote. Unlike years past, we believe the company may not be able to rely on strong iPhone sales to drive its share price higher. That's the change.
We are doing the best we can on this, and when you have Mark Gurman and Ed Ludlow leading the charge, it is best in world analysis of this. And what Bloomberg Surveillance has done is get away from the blah, blah, blah and actually talk about what it means for the company, what it means for the stock, and frankly, what it means for America. Mr. Forte joins us now, senior research analyst, D.A. Davidson. He is a neutral on Apple. Let me cut to the chase. I thought some of it was fascinating and the rest of it was sort of But Tom, to me, the key thing is what does it mean for the broader Apple ecosystem? I mean, I think there's when you have storage, everybody's complaining about 2 terabytes of storage in iCloud. They pop that sucker out to 6 to 12 terabytes. Little things like that below the headline. What's yesterday mean for the Apple ecosystem?
Sure. So I think that what I thought was most interesting is that they're taking a de facto price increase on the Pro Max. They're not offering the 128 megabyte model anymore, so it's $100 more to get an iPro Max. And then the dongle, you teased it before, but the fact we're talking about accessories, not the phone, is
right.
Good and bad news. The good news is that it should be accretive to margins. The margins on a $29 dongle ought to be fantastic. For the ecosystem, I think that you may not see the incremental new buyer this year, but as you pointed out earlier, the wireless carriers seem to want to subsidize their 5G networks. which is also
Right.
good news for Apple.
I got
So
eight
some good and bad.
Yeah, I got 8 ways to go here, Tom, and John and Lisa have more intelligent questions. They got a 3 nanometer A17 chip. Is it enough for someone to upgrade in China? Is it enough for someone to upgrade sitting to my right here in New York, where he's adamant he's not going to fall for the fanboy baloney? Is that new chip enough to upgrade?
I do not believe that it is. So when I was thinking about all the buzzwords and all the new things in the iPhone 15, I was chuckling at titanium and how there have been titanium golf clubs for some time now, or how they're essentially, no one's pointed out that they're offering OnStar. And so I'm concerned that there's a lot of small incremental adjustments, but there's no one item that I think is going to get you to wait in line, like we used to for an iPhone.
So, Tom, you know the bullish thesis. The bullish thesis sounds like this. There are tons of people who haven't upgraded. The iPhone 15 is going to get them to upgrade. Now, Tom, you clearly don't buy into that. So let's go through your rating. Neutral, 180 price target. In the pre-market right now, we're at 176. Given the multiple that this stock has and the fact that you don't believe in the bullish thesis, Tom, I've got to ask the question why this isn't a sell and why that 180 isn't a whole lot lower.
Yeah, so I do think, you still have an amazing balance sheet. So they have the potential to buy back billions of dollars of shares to support the stock. I don't think they would ever raise their dividend yield to, say, 3% to attract that pure dividend investor. But the foundation is still there. And I don't think that the stock is so overheated that would warrant a sell rating at this point.
There is this question, though, if there isn't anything to really catch everybody's eye, except for a $29 dongle, there is an issue of the increasing geopolitical concerns, especially as right after this launch, China came out and said that they flagged a number of unspecified security incidents with the iPhone. How do you factor that into a price target?
So the way that I factor it in is about 10% of their revenue comes from China. They're clearly still heavily dependent on China from a supply chain standpoint. And when you think about what I'm thinking of is protectionist behavior by the Chinese government, we have protectionist behavior in the U.S. as well when you think about banning TikTok and things of that nature. But to quantify it, 10% of their sales are at some level of risk, and that's bad news for Apple.
So if you're looking at right now a product that isn't necessarily going to encourage a real refresh kind of cycle, where is the bulk of the revenue going to come from? Is it going to increasingly come from services, or can it continue to come from just the fact that at some point this is going to break and even John is going to have to upgrade?
So, all right. So there is some element of the slow to upgrade consumer, but I think that this is why there was a lot of enthusiasm for the Vision Pro. But we still think that the Vision Pro, which looks to be on track for launch next calendar year, they're not going to achieve mass adoption with their augmented reality, virtual reality headset. So if you don't have the next new thing and you have kind of the iPhone aging on the vine, it's a challenging period for Apple. It's somewhat remarkable how well the stock's done, given that they already tipped off their hand that they're going to report their 4th consecutive quarter of declining revenue in the September quarter. So new products and I guess still a foundation on iPhone and buybacks might be the things that hold up the stock on a near-term basis.
Tom, that's worth 30 times forward earnings.
No, it's not. But yeah, so it is not. The services element is what enabled them to get the premium multiple versus where they were trading before. Services, it's still a good story, but at some point, either the iPhone's going to have to exceed all of our expectations, or the Vision Pro is going to have to do much better than I think for the stock to continue to go higher over the next 12 months.
Tom, let's just finish on this line that Lisa mentioned from China. I wonder what the response will be from Apple to this, because it's not something you typically hear. This is from the Chinese Foreign Ministry spokeswoman. We noticed that there have been many media reports about security incidents concerning Apple phones. Tom, what do you think they're alluding to?
Yeah, so I think they're alluding to the reports that government workers in China are not able to use Apple devices. I think it's interesting. I've been trying to figure out the appropriate chess piece for Apple in the increasing tension between the U.S. government and the Chinese government. They're clearly not a pawn. They're not the king. They're not the queen. Maybe they're a knight. But they have tremendous sway in China. thanks to their relationship with Foxconn. But I think they're getting kind of caught in the middle here on this increasing tension between the two countries.
Without a doubt. Tom Forde, thank you, sir, of D.A. Davidson, following the release, the unveiling, the big reveal of the iPhone 15. That tension between China and the United States, Lisa, thanks for mentioning it, because that story is going to be pretty wild through the next quarter or so, just to see what those sales actually look like on the ground in China.
Especially if they're flagging unspecified security incidents right after we heard about not using these from government workers in China, but saying it's not an outright ban. I mean, they're basically specifying that. Is this sort of a tit for tat after selling the iPhone more aggressively in China? I mean, is this because of the new product launch?
I just think it's demand. I don't have a bullish bearish case here on China, what they're going to do, but I look at luxury sales in China and all that, and frankly, it's a mystery right now. I think the Apple sales in China are the same as LVMH or Hermes or the rest of them.
Luxury in North America, Tom. North America, never mind China. North America, we've seen that flagged by many luxury retailers.
Well, there's a small group at the top and the others. Yeah, there's
entry-level stuff,
split. Sure. Well, just whatever it is, but I don't have a lot of certitude on what we're going to see in China in the next 90 days on luxury, and frankly, an iPhone. The 15, what is it, Pro Max with 1 terabyte of storage, you're popping $1,400.
Is that enough for you?
For that puppy.
Is that enough storage?
And, I mean, Vet wants one, but the bottom line is that's a lot of money.
How much storage does one need?
Isn't
that a ridiculous amount?
Yeah, it's ridiculous. 256 will get it done.
Ridiculous.
For all digital
and
pack
for your
rats.
ego, if I want to go down the street, I need
but how would anyone know? You've got to tell everyone that's what's storage is on your phone.
He has 512
nice.
1 terabyte.
They're T-shirts.
From New York City, future's a little softer. This is Bloomberg. First day of losses in 3 on the S&P. Let's see if we make it 2. Equity futures on the S&P 500 slightly negative this morning, going into CPI. We're negative 0.2% on the Nasdaq. We're down about 0.25% on the Nasdaq 100. If you look at where we were since August 10th, Tom, where we are since August 10th, the last CPI report, this equity market's basically dead flat, Further signs of disinflation. Stock market's gone nowhere at the index level.
And Tom Forde talked about it with the thing everyone owns or doesn't own or wants to own, Apple, in that there's a wall of money out there. I'm going to give credit to Lawrence McDonald, as we did yesterday. And the bottom line is, as Larry wrote in a brilliant essay, there's just this wall of money holding things up, including, Lisa, would you say corporate spreads as well?
Yeah, everything.
I mean, just putting the bid on bonds and notes and bills, and it's just a wall of money.
You can actually get some yield. Let's turn to that yield. 2-year, 10-year, 30-year in the bond market. 2-year through 5%, up another basis point or so at 5.02%. On a 10-year through 4.30, up 2 basis points today. If you think about where the equity market has been since the last inflation report, dead flat. This bond market, anything but. Arguably, Lisa, absorbing, internalizing the higher for longer message at the front end of the curve.
And the most shocking part about it is it has not disrupted riskier assets. I mean, pairing those two ideas really speaks to a tension right now. Can you have a soft landing with higher for longer? And that really is honestly increasingly at debate.
It's certainly stronger dollar off the back of it, that's for sure. You push this through foreign exchange. It's been an interesting week already. Monday, the US dollar was weaker. Tuesday, it was stronger. This morning, it's stronger again. The euro's negative by 0.2%. The euro right now, 107.36. I really don't know what the ECB can do, will do, should do at the European Central Bank in Frankfurt, Germany on Thursday.
I'm using Euro Swiss as a barometer. It has not moved. You got the German news of a slower economy, as you say, the complete mystery of the ECB. And my litmus paper there is the euro as compared to Zurich, and the answer is it is not shown strong Swiss franc.
Under surveillance this morning, 2 hours away from US inflation data. CPI expected to show price pressures remaining sticky. Adding to risk, policymakers will keep interest rates higher for longer. Over in Europe, starting in the UK, the economy shrinking at the fastest pace in about 7 months, reviving fears that a recession might be underway. And traders ramping up bets that the ECB will raise rates when it meets tomorrow, following a report from Reuters yesterday that the central bank sees inflation remaining above 3% next year. So tomorrow, Tom, we'll get these forecasts, and those forecasts will be available to the Governing Council when they meet, convene to set interest rates. The idea being, if they have to upgrade that outlook for inflation to above 3, not at 3 for 2024, does that embolden the hawks to say, let's go, we need to go again?
I need some Jamie Dimon humility here. How valuable are those forecasts? Let's go back and look at the forecasts 6 months ago, a year ago. I mean, we're lucky we get to BS about it here. People have to actually make forecasts. Greg Bottle had the courage to come in from BNP Paribas the other day and say, I had to go bullish, I'm not bearish. What is the value of a next year 3% ECB forecast?
Well, have they missed? They've underestimated inflation, right? Time and time again. Hasn't that been the story in Europe?
They've underestimated the rigidities in Europe. This is a real economy issue.
They're underestimating how quickly it can come back down?
Yes, because of the rigidities. Trichet would say he would say it more romantically than me with that French accent.
Sure.
Rigidities, or however.
Is that how he would say it?
Sound good there?
I hope Trichet's not listening this morning.
I hope Catherine Deneuve is. Good morning.
Looking forward to our coverage of the ECB tomorrow. Let's take it back here to the United States. A strike by the United Auto Workers looking more and more likely as the union and the Big Three, they remain far apart on a new Labour contract. The UAW president planning to confirm the union strike at 10 p.m. Eastern tomorrow, 2 hours before the contract officially expires. This all according to people familiar with the matter. They've come down from 40, Lisa. They're at 36. I was speaking to David Welch of Bloomberg over in Detroit yesterday. I said, what gets it done, David? What gets it done? He said he reckons 20 gets it done. I have no idea if Ford, GM, Stellantis are anywhere near coming to the table and offering 20.
Especially because it's unclear what other details are on the table. There was a report about absenteeism and how absenteeism was about 23% at Stellantis. And that's one of the things that they want to remedy because this is costing them a lot of money. And they said if people actually showed up to work for all of their shifts, we would save enough money to offset this. Just it's the anchor sort of underpinning some of these discussions on both sides, really percolating out and showing how difficult it is to come together.
It's also, to your point, this idea of the fiction of a 32-hour work week. We want to be like the Germans. I mean, that's the bottom line. And maybe Stellantis of Europe is leading the charge on this. How do you make money in America on a 32-hour work week? Please help me.
TK, we're finally talking about the elephant in the room in the EV transition.
Yeah.
And it's such a difficult line for the president to walk. He wants this transition. He wants to establish his climate credentials. At the same time, he wants to establish and convey his union credentials. But we know these automakers are going to struggle to compete with their Chinese rivals. The Europeans are talking about it this morning. We'll have that conversation in about an hour. How do you do that? How do you square that circle? Isn't the elephant in the room that the EV transition is going to cost the workers that this union represents? And the UAW get the joke, and they're trying to do something about it.
Do we know what the EV transition is? I'm not sure. I'm still not clear. You know, I just got they put all the Harvard Business Reviews on my desk at home. The bottom line is it's all AIAI, EIEV, EIEIO. Baloney. Nobody knows what AI is going to do. Yeah, thank you. But nobody knows
what had a farm.
What do we know what EV's really going to do? Or besides, what do we do with the lithium batteries?
Or what kind of demand there's going to be. Ultimately, how much angst is underpinning this negotiation? And you've talked about this before, John, about how is this going to be the last? What is the outlook for certain workers in an increasingly automated space at a time where the actual technology is also changing? We just don't know, and that is underpinning some of the concerns.
Let's get to the outlook for crude just quickly. The IEA, there's another one for you, Tom, warning that oil supply cuts by Saudi Arabia and Russia will create, quote, a significant supply shortfall and threaten a renewed surge in price volatility. The announcement coming a day after Brent touched a 10-month high above $92 a barrel. This morning, 92.58. TK, going into CPI in America, we have crude at the highs of the year.
Yeah, I take it off July 4th, I believe it was, and it has been a surge. Is it a moonshot in oil? Maybe not, but it is a surge in the price of oil. It's got to change behaviors. There's no question about it. Right now, we're going to stagger forward into April of next year. John Farrow and I are riveted on the North London Derby of April 24th, 2024, April 27th, 2024. Rubila Faruqi of High Frequency Economics says that when John and I are at the North London Derby in April of next year, we're going to have a two-handle on U.S. inflation. Rubila, no one believes you. How do we get to a sub-3% inflation by the time the tots take out Arsenal?
Good morning. Great to be with you. Thanks for having me on the show.
Yeah, what we're seeing right now is a little bit of a dichotomy between what's happening with headline inflation, what's happening with core inflation. The Fed's mandate is headline. Obviously, an acceleration in that is going to be a concern, but we are seeing the right signs on core inflation. Rent inflation, shelter, that's going to start to diminish. The pressure from that is going to start to diminish. We don't think, if you're traveling, if you look at airline travel, that is still very strong, but we don't think that's going to keep on going at the pace that it has been. The labor market is key to these data. The labor market is slowing. Our base case remains that as the labor market continues to slow, as wage growth also continues to moderate, even as inflation diminishes, even as real incomes are positive, we do think that inflation pressure is going to continue to diminish. We think we will be at a 2 handle by the second quarter of 2024.
How does our study of real estate now, or our study of real estate at the North London Derby in April of next year, how does it affect what the Fed will do about 2.8% inflation?
The Fed is looking at, it's a difficult thing, right? Because they are looking at backward-looking data. They're data dependent. But at some point, they also have to, and they're talking about it, that this rent, this housing component, that is going to start, the lagged effects are going to start showing up in what we see in inflation going forward. But, whichever way you look at it, inflation is too high. The Fed has to, we think they're done hiking. They have to maintain this policy stance for some time. The question now is, are they sufficiently restrictive? Do they have to push forward a little bit more? We think they don't. We think they're done. The peak in the Fed funds rate is where we are now. It's just that, can they call victory on inflation? Absolutely not. They have to keep that, hawkish bias. They have to lean into that. But I do think that the message is, from our perspective, that they have reached the peak and they're going to stay here for some time until inflation starts to, is on a sustainable basis moving towards 2%. And we do think that that's going to happen over the rest of the year and going into the first half of 2024.
Rubila, about an hour ago, Germany put out an increased forecast or revised forecast for GDP this year to a full contraction of 0.3%. We were talking about how the ECB is grappling with the nightmare of central bankers, which is stagflation. How far away from stagflation is the United States?
I don't think we are close to stagflation at all. Look at the positive momentum in this economy. We have constantly underestimated that, the household sector, the business sector. I think what's really important to remember is that going into this recession, we saw such extraordinary support for households and businesses that household and business balance sheets were fortified, coming off a very, very strong base. And I think that's what we've constantly underestimated. This economy still has positive momentum. It still has positive job growth. We are concerned about the fact that if the Fed keeps pushing, what is going to happen to this deceleration in job growth and what's going to happen to unemployment. But right now, we are not seeing any signs of distress that would suggest to us that the U.S. economy is really hurtling towards a recession or a contraction.
One of the biggest debates right now among economists, and I even see this on the Federal Reserve with certain papers that are conflicting about how much of the Fed increases in rates have already trickled through to the economy, with some people saying most of them have already come through, other people saying no, the bulk of them is going to slam into the economy in the next 12 months. We were hearing from Bob Michael of J.P. Morgan yesterday on that front. Where do you sit?
I think a lot of that effect has already gone through. We've been talking about lending standards tightening. We're talking about borrowing costs, at very high levels, multi-decade highs. The consumer has still been very resilient despite those headwinds. So I do think we're looking at a different cycle. This is not a typical business cycle. This is not a typical response to over 500 basis points of tightening. This is not what we expected. So I do think things are a little bit different right now. We do still expect that, these tightenings are going to affect the labor market. Things are going to adjust, and that's going to filter through to businesses and to households, towards the demand side of it. So I do think that we are going to see the effects. It's just that, we've been surprised. The economy has surprised us to the upside over and over again. We're still looking for growth to, decelerate pretty sharply in the fourth quarter. Based on the fact that the labor market is going to soften. But we are also prepared for upside surprises given what's happened so far this year.
Rubila, just quickly, What do you think is going to be captured in the forecast we'll get from the Federal Reserve next Wednesday?
Oh, I think they have to upgrade their growth forecast. They have to downgrade their inflation forecast. I think what happens with the Fed funds rate is important. I think they leave it where it is, given that they want the insurance. You know, they don't want to give the impression that they are, at the peak and that they're not ready to do more if needed.
Got it. Rabina, thank you. Rabina Faruqi there of High Frequency Economics. Looking ahead to the Federal Reserve next Wednesday. Get a set of forecasts, not just a decision. Tom, North London already complaining. Did you spell Derby with an A?
I thought that's the way you guys spell it. It's a Derby.
That's how we say it. It's not how we spell it. I feel like you knew that.
I'm learning every day.
I was told over the Bloomberg just to correct you quickly so you understood before we go to London.
But you say Derby. Why don't you say Derby? I mean, it's a Derby.
It's a Derby.
It's a Derby.
It's a Derby. Will Kennedy's going to join us shortly.
Is Merseyside a Derby?
It's a Derby too, Merseyside Derby.
With Everton?
Liverpool and Everton. Get Everton right.
Everton.
Nailed it.
I'm nailing things.
That's not Will Kennedy's team. Will Kennedy's going to join us shortly on the oil market. A warning about a deficit in the crude market. A deficit, Tom. Not enough supply. And it's driving up crude prices again. 92.63 on Brent.
Francisco Blanche is brilliant yesterday on this. I mean, he didn't say 100 on the way, but look at that. 1, 2, 3. We're there.
How far away are we? Will Kennedy of Bloomberg just around the corner to weigh in on that. Crude prices elevated near new highs for 2023. Those latest prices going into a higher CPI print off the back of more costlier gasoline. We'll talk about headline inflation and the difference between that and core in the next hour of the program. From New York City, this is Bloomberg.
Opportunity.
People.
Things get done.
Before, I never did business in Georgia. I was amazed what kind of opportunities. There are many of them here.
Very little bureaucracy, simplicity of doing business.
You have access to markets, finance, and authorities.
It's perfectly located logistically. We have the biggest suppliers nearby.
EBRD has invested 4.6 billion euros in 270 projects, and I think that speaks for itself.
Georgia.
A pleasure
doing business.
The market is really tightening in the second half of the year. With the extensions of the cuts by Saudi Arabia, but also Russia through the end of the year, we're seeing global oil demand overtaking supply by about 1.4 million barrels a day in the fourth quarter. So this risk, tightening the market, increasing volatility.
We've had warning after warning yesterday from OPEC, today from the IEA. Toro Bassoni there, the head of the oil markets division at the IEA, warning of the deficit we could see in the crude market. Not enough supply. It's driving up prices. Let's talk about prices right now. 92.63 on Brent crude, WTI 89.44. New highs for 2023, even with supply in America near record highs and a slowdown, we're told, in China. Crude up, equities looks like this. Let's whip through the price action for you just briefly. Equity futures negative here by 0.14% on the S&P 500. Yields a little bit higher by a couple of basis points at 430. Going into CPI a little bit later on this morning. The estimates, Tom, look a little something like this. Headline month over month, because of this move in crude and gasoline prices, could come in at 0.6%, according to our survey. The previous number was 0.2. If you look at core month on month, totally different story. 0.2% previously, 0.2% is the estimate now in our survey. So the question is, do you ignore what's happening in headline? And do you ignore what's happening in the commodity market if you are the Federal Reserve, particularly when the likes of Marko Kolanovic over at JP Morgan has this to say, Tom? Here's the quote. The potential for the commodity price surge to feed inflation and extend the hiking cycles over at central banks. Tom, is that the risk going into this Fed meeting next week? Or should we embrace that softer core figure for another month?
To me, the risk, as you put it, is it's two separate conversations. The conversation of our listeners on radio, our viewers on TV, is the real world out there. If I look at a gallon of gas, $3.84, the answer is my long-term moving average is $4.30, Lisa, down from the spike of $5. $4.30. We're a long way from that, but at the rate we're going, we could get there sooner than later.
Are higher oil prices inflationary or disinflationary? And this is at the heart of the debate for the Fed. But at the bottom line, if you have this appearance of inflation, that could create a self-fulfilling kind of prophecy in the University of Michigan Sentiment Survey, which you guys follow very closely. That's going to be important for at least politics, but also maybe the Fed.
Actually, Will Kennedy just fell off his chair in London because he's looking at petrol, they say. A gallon of petrol.
That is what we say,
a little bit higher. Will Kennedy, a gallon of gas in London, that's like $7 something, isn't it?
It is. But, I drive an electric car these days, so I'm not sure of the size price, but it's definitely going up.
How does Saudi Arabia, who seems to be in the driver's seat, no pun intended, how do they deal with Will Kennedy driving an electric car or China committing to an electric car? At what price of Brent crude do more people buy electric cars?
It's a good question, but I think that lots of us are driving electric cars in China, but the really important thing from the Saudi perspective and the oil market perspective is it isn't doing that much yet to dent demand. Demand is looking robust around the world. Gasoline demand especially is looking quite strong. Part of that is people switching out of diesel cars, which we've grown to hate, used to love in Europe, and now we hate them. But in China... people are driving more electric cars, but they're also driving more gasoline cars. They are moving around. After being locked up for several years, they are moving around again. And gasoline demand over the summer has been very strong in China. And I think one of the facts about the market right now is there was a lot of concern about Chinese demand. But when you look at the numbers, it's looking pretty good. And the Saudis know that.
Did the Farrow household have a diesel vehicle?
We did not know. We had a Rover 416.
But everybody went nuts on it. My father went nuts on it.
Did he get a diesel?
VW diesel.
We didn't do that. There was a big German push. Yeah. German manufacturers really pushed that stuff. Well, let's talk about supply deficits. I've seen two different numbers in the last 24 hours. There's quite a big difference between the two. OPEC have given us one. IEA's given us another. Well, you and a team running commodities in London at the moment. What's the number I need to be thinking about? How big will that supply deficit be through this year?
Well, I think the thing to point out is that even the IEA number is a pretty chunky deficit when you're looking at global demand in the sort of region to, just over 100 million barrels a day, 102, say, you're looking at almost 1% even on the IEA number, and that adds up pretty quickly. And if you split the difference between the IEA number and the OPEC number, you're looking at pretty chunky deficits, and that's what's driving markets higher here. And that's why it's clear that, the Saudi decision to keep that cut in place by the end of the year is severely tightening the market. And as Toril Bassoni said on the program earlier today, is driving down inventories very quickly. I think increasingly, though, the market's going to be focused on what that number looks like in the first quarter of next year. There will be some, year-on-year growth will not be quite as strong. There will be some more oil in the market, probably. And so that balance will increasingly come into focus. But there's no doubt, no matter which number you choose, if you look at somewhere in between, we're looking at a pretty tight market where inventories are coming down quick.
Well, are we back in the zone where we're going to be talking about the weather, and we're going to be talking about how cold the winter is going to be, and the value of not only oil but also gas is going to surge on that if inventories are so low heading into what has always been a big question mark of weather?
Yes, I think it's always a question, and a lot of people around the world use effectively what's diesel to heat their homes as heating oil, and the diesel market right now is a part of the oil market that looks extremely tight. Refiners are being rewarded for making diesel. The spread between diesel and oil prices has really blown out on just the global resilience in industrial demand as we, as the economy keeps going. And if we do get a very cold winter, that part of the market will continue to be under pressure. And yes, a cold winter always drives demand. So yes, we will start having that conversation. But it's worth pointing out that in Europe, the natural gas inventory situation looks as good as it could be for this time of year.
At the same time, when we do talk about heading into winter and some of the inventories and how depleted they are, I wonder about the lag effects, not of monetary policy, but of output cuts. Do we have a sense, Will, of how quickly the Saudi Arabia could turn on the taps and change that balance? Or is this something that could get a bit over their skis as they try to target a $90 to $100 price target, as we were hearing about yesterday?
Yeah, I mean, they're going to have to watch the market carefully. They won't, clearly they want to see prices rise higher than here. They won't want it to become a full-blown upward ramp, I don't think, because clearly then it does have an impact on the economy. But, the one thing you can say about Saudi policy is that they do meet their pledges and follow through, and they can adjust relatively quickly. I mean, it takes a number of weeks for them to get the oil on the tankers and to market, but they are able to respond, and they do tend to do what they say. So although they're committed to this 3 months, they always reserve the option to readjust if the facts change on the ground.
A monthly review, I think we're told. Will, I'm also watching the weather, but somewhere else. Hurricanes forming and potentially heading towards the United States. And as we know, the SPR was built up for a reason, Will. I'm sure it was in the midterm elections a year or so ago. And Will, that SPR has been depleted. I just wonder, from your perspective, given where crude output is in America near all-time highs, just how vulnerable the market might be with the SPR as low as it is.
Well, I think there's enough in the SPR to cope with a hurricane season, because also there you really need oil products if the refineries are knocked out, which is often the greatest risk. But what I would say is the market is very right to focus on hurricanes, and that Gulf of Mexico region is becoming ever more important to the global energy system. You've got the refineries on the Gulf, you've got oil production in the Gulf, you've got oil export terminals for shale to get to the rest of the market, and you've got LNG export terminals. So those hurricanes absolutely need to be watched across all sorts of markets, and a really big hurricane blowing up, in the Louisiana, Texas area could cause a lot of havoc, and we're not at the end of the season yet.
That's where the supply boom is currently. Will, thank you, sir. Will Kennedy there on the latest off our London desk on the commodity market. TK, output in America, thank goodness it's near all-time highs, given what we're seeing develop elsewhere.
To the late Bill Richardson, former energy secretary, governor of New Mexico, dying last week. To Bill Richardson and others who were energy secretaries, one of the charms of America is we never really had an energy policy. We just went out and did technology, and pretty much like the internet, nobody saw the technology of shale coming. Now what?
92 is now what on
now
Brent.
What?
89 is now what on WTI. And Lisa, to your point, I've been asking this question. I think it's an important one. I agree with you. Is this crude price a reflection of the extension of the cycle or the recipe to end one? And that's the question I've been asking as well to a lot of the guests that come on the 9 o'clock. Bramo, which one is it?
If it's driven by supply cuts, then you could argue it has a greater chance of ending the cycle because it's not driven by strength.
We'll continue this conversation. Gargi Chowdhury of BlackRock joining us very shortly. Crude at new highs for 2023. Equity futures slightly lower. We're down about 0.1% on the S&P 500. Inflation data in America 1 hour and about 34 minutes away from New York City. The second hour of Bloomberg Surveillance up next.
Us, along with many in the street, were looking for a slowdown and looking for a recession this year, and it just hasn't manifested.
It's still a very strong labor market.
The U.S. economy is far from robust. It's still in positive territory, absolutely, but the momentum seems to be shifting to the downside.
I think the consumer is incredibly stretched right now.
I think the reaction function of investors is to get out quick if the data starts to deteriorate.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The most important data point of the month coming right up. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P slightly negative by 0.1% on the S&P 500. That data is 90 minutes away. TK, that data, US CPI.
It's going to be nominal data there, the core number, and then and on top of it, the inflation number. We've studied it all. We'll give you, Michael McKee's treatment here at 8:30. Just printing moments ago, the 10-year real yield, John, pops up to a 1.96%. That's a 2 basis point move here, and that's underlying churn here between nominal analysis and real analysis. We'll do that at 8:31.
And the difference, Tom, between core and headline within the data itself. Core, we're making progress. Headline, do we have a problem? Lisa, Brent crude, 92.65. WTI, 89.50.
There's a big debate. Does headline matter? If you do see a pop upward in response to higher oil prices, do we care? Does the Fed care? And we talked about how you hear JP Morgan analysts saying that maybe the Fed's going to game out oil prices and respond to them. The issue is, it's how they are increasing. Is it increasing in a way that reduces consumer spending, and do you see that show up in the numbers?
On the commercial break, John Farrell's looking at what Lando Norris is doing as he goes to Singapore for the Formula One this weekend. What am I doing? I'm looking at a log gallon of gas, Lisa, and we're up above 2 standard deviations, above $5 a gallon gas. We're at $3.84, just teens-weens above 1 standard deviation. Now's when the tension starts.
What Tom just said, reverse it. I was doing one thing and Tom was doing the other. I was also reading this from Andrew Hollenhorst just moments ago. He says this about the Federal Reserve going into next Wednesday. The Fed is very likely to skip hiking this month, but stronger core inflation could convince the Fed to leave the 23 median dot, showing another 25 basis point hike in November. We've got to work out what this oil story does to demand. I think this is so important. So let's pick a company. Already this morning, in the last hour, we've heard from Spirit Airlines, domestic-focused airline here in America, citing increased fuel costs, steep discounting, and cuts in the outlook for revenue. Lisa, that stock is down 2.95%.
And this is such a confusing picture because you've seen some airlines getting beaten up more than others. But you raise such a good point, which is, do you see discretionary spending coming in dramatically? Or is that strength and that surprising resilience that Rubila Fariki was just talking about, do you see that come to the fore and that actually consumers are able to keep spending well past what people expect?
Let's get to the price action this morning. Futures a little softer. We're down by 0.1% on the S&P 500, 87 minutes away from that economic data. Futures pulling back just a touch. In the bond market, yields higher by a single basis point, 429.42 on a 10-year. In the FX market, tons to talk about in Europe. We'll save that conversation, but I'll tell you where the euro is currently. It's slightly weaker against the dollar, Lisa, 107.38.
8:30 a.m. in about 90 minutes, we do get the key data point of the day, arguably of the month, as you were just saying. U.S. CPI comes out. People are going to be parsing through the headline number as well as the core figure. I'm also looking at how it compares to the pace of wage increases or not. And this to me is important because it's basically a question of, does this inflation reduce the spending power of the average American? If it does to have a different response from the Federal Reserve. Today, we do hear from more banking executives at the Barclays Global Financial Services Conference. We do hear from the Citi CFO, Mark Mason. Yesterday, Goldman Sachs' David Solomon talking about the resilience that we're seeing in IPO markets, but again, raising this warning about increased capital requirements and how that could hamper the access to capital markets by companies. And we've heard this a lot from a lot of banks, but maybe it's a little bit different. And 2 p.m., Tom, you were talking about the real yields, and I'm also looking at the real yields on 10 years. On 10-year treasuries. How much does it have to do with the deficit in the U.S.? And at 2 p.m., we get that August U.S. budget statement. As the deficit increases and as you have other regions move away from buying, like Japan, what does that do to the real yield? How much can that drive some of the gains that we're seeing?
I get that the debt and the deficit discussion is going to be huge and politically huge forward, but I'm going to go back to Jeff Curry of Goldman Sachs, who said this real yield, John, permeates everything we do, including buying the next iPhone. I mean, the real yield is different. It's back to our youth. It's back to 1994, 1984, et cetera. It's a whole new world after all.
I know Jeff is no longer at Goldman, but I know he often tunes in. Can we give him a victory lap for his crude call? What a forecast. Ultimately, we're up here,
Great
aren't we?
Call.
In the 90s, going into the back end of the year.
Each of these guys is different. And Jeff Curry, I don't know what he's going to do. Maybe he's going to go teach microeconomics again at Chicago, but he brings microeconomic foundations to the debate like no one.
Gagi Chowdhury joins us now, head of iShares Investment Strategy Americas at BlackRock. Gagi, wonderful to catch up with you. It always is. Two-part question. One, what do you expect the data to look like later this morning? And two, how do you expect this market to respond to it?
Sure. Good morning, Tom, John, and Lisa. So for the CPI data this morning, I think, the expectations are for a stronger than expected headline. I think that'll be around 0.6. Obviously, the market will put a little bit more focus on the core data. I think that's where we get a strong 0.2. Now, after 2 months of that weaker, about 15, 16 basis points, expect this one to be closer to 23, 24 basis points. What I will be focused on is really looking at some of the details. So where are we seeing weakness? Are we still seeing that goods weakness? Are we still seeing goods weakness, especially in used and new cars, which is my expectation? And then focusing really on that shelter and more specifically on the owner's equivalent rent. And obviously that moved up a little bit last month. To see if OER comes down a little bit this month will be important. And then finally, last point I'll make is that despite the weaker data, especially on the core front last month, bond markets really didn't have the reaction that you would have expected. So I think this month it's going to be all around seeing how the bond markets react if we get that, point to expected data print.
Garga, your research notes all 1994, which is the last time the Red Sox and the Yankees were fighting for first place in the American League East. I hope you love the doubleheader yesterday at Fenway Park. The bottom line, Gargi, is I'm looking at a research note talking how quaint the belly of the curve. Teach us about the value of the midpoint, the belly of the curve.
Sure. It was great to actually be in Boston, where I'm joining you from for that. But sadly, I did not get to go to the game. I was at a client event instead. But I'll say about the belly of the curve, the part that we're talking about is really that 3 to 7 year point. And, we look at the iShares ETF IEI, which gives you access. And the reason we're talking about the belly, number one, that's where the carry we think is the most advantageous to investors. So you can hold that 5 year point, or you can hold anything from that 3 year to the 7 year point. Rates can still move higher. And I think that's a really important thing for us to remember. Rates can still move higher by about, call it 60 basis points or so for the next 12 months. And you can still have a positive outcome in your portfolio. So that's number one. Number two is, and as you know, Tom, we've been speaking about this before, we'd come into this year and we talked about this, bonds are back in yield of dreams, but we'd really focused on the very front end. And now we're telling investors to move out a little bit and add some duration in that 5 year point, in that belly. And that's primarily because I think with the consumers slowing down in the in the fourth quarter of the year, as well as inflation moderating, or at least core inflation moderating, all that behooves a little bit more duration. Wouldn't go out past the 10 year point quite yet. I heard you guys talking about the deficit issue earlier, obviously Bank of Japan and their actions. There can be a lot of reasons for the longer end to continue to move higher and the yield curve to continue to move steeper. So the sweet spot is really that 3 to 7 year point.
If oil prices keep rising, as they have over the past couple of weeks, what does that do to your call?
Yeah, I think that's a really important point. I think it depends on how it rises. So whether it's like a grind higher or a sharp move higher. The second point will be how where it gets to. I think if we sort of hover between $90 to $100, obviously that's a very high number. But I think that this is an economy that can still withstand that. If we're looking at an oil shock at 120 or something, significantly higher than today's levels, number one, I think that becomes a huge problem for the Fed. They haven't historically focused on headline, but they would have to, and that brings in a question of many more rate hikes. And the second, I think that also brings up a question of, again, the consumer slowing down. That is a huge tax on the consumer at that 115, 120 level. And I think that then brings us to a point of buying duration again, because that means that growth slows down pretty meaningfully. Everything that we're talking about for Q4 having a 1+ handle on growth, I think we would have to question that. So I think, the very front end would certainly suffer because the Fed would have to raise rates more than what's priced in. But I still think that the belly could probably be okay, especially when you think of the carry that's priced in. And then the last thing I'll say is, one of the things that we've also talked about in our research note, and we've been recommending since sort of our mid-year guide, is talking about owning tips, owning real rates here. And especially as we move closer to that 2% level, I think real rates become really attractive in a diversified portfolio. And again, if you have that real rate allocation in your portfolio, I think that can work out pretty well in that higher yield situation as well.
Do you notice fewer potential buyers when you're visiting clients? I know that you're in Boston and you mentioned the Bank of Japan. Are there fewer international buyers, and are there enough domestic ones to take over?
I think that that's exactly what's beginning to happen now in the fixed income market specifically. Obviously, we talked about how some of the international buyers may be stepping into their own domestic markets, given the yield availability in those markets. But I think if we look historically at who owns treasuries, if you look at households, that they have historically been a buyer of treasuries, and they haven't really bought as much yet, and they have a lot more room to add. And let's be honest, if you look at the last 15 years, last 10 years, there was really not much need for investors, households particularly, to own fixed income at 2-1%. And I think now at above 5%, sitting in the 2-year point or a little bit lower than that on the 5-year point, I think households will gravitate towards owning fixed income, not just as a diversifier to an equity risk, but a real source of income. And I think that's why obviously there can be volatility in the short term if we continue to see actions from the Bank of Japan or other central banks. But I think for the most part, I think there will be buyers coming in the U.S. market.
Or as a wise lady at BlackRock once said, the yield of dreams, Gargi. The yield of dreams. Gargi Chaudhry, Gargi, thank you, of BlackRock. Gargi's words, not mine. If you're just tuning in, welcome to the programme. On the S&P 500, equity futures here lower by 0.16%. The conversation will continue. Daryl Cronk of Wells Fargo in the next hour. In just a moment, coming up next, we're going to catch up with Bloomberg's Anne-Marie. Can someone help me and translate what on earth is going on in DC, TK? The impeachment inquiry launched by House Republicans.
We've seen it before, but it's like on steroids. It's the same debate as before. Anne-Marie is encyclopedic on this, but it's just been amped up, ramped up. Of course, all of this leading into the election next November.
Got to talk about that one and this too, the prospect of strikes Thursday night in Detroit.
Yeah,
it's like right there. It's right on the horizon.
It's right there. And you mentioned your good conversation with our great team in Dearborn, Southfield, and Detroit. And the answer is, is it like the cable TV thing? They get it done so we can watch the Jets go down in flames.
And record viewership, I think, on ESPN for Monday Night Football off that game.
Well, that's the
Bills,
power
Jets.
of sports, but
Sure.
UAW doesn't end that romance.
I think this
really
this dispute is slightly different, Bramo, between ESPN and carriers.
This doesn't feel like a marketing tool, and this doesn't
Not
feel
at
like just sort of a positioning kind of drum, beating of chest. They're really far apart. When you look at the details, it actually makes you feel like they're even further apart.
Can we close that gap in the next couple of days? Those two stories coming up next with Bloomberg's Anne-Marie. AMH just around the corner. US CPI about an hour and 16 minutes away. Equity futures negative here by 0.2% on the S&P 500. In the commodity market, crude making new highs for 2023. From New York City, good morning.
What we have observed is that larger asset management firms, but also private banks or just general financial institutions have established themselves here in ADGM.
Abu Dhabi gives us capital access, but it also gives us talent access and market access.
So we have access to the private sector, to the public sector, to the policy makers.
I am directing our House committee to open a formal impeachment inquiry into President Joe Biden. This logical next step will give our committees the full power to gather all the facts and answers for the American public. That's exactly what we want to know.
The latest from the nation's capital coming up shortly with Bloomberg's Anne-Marie. That was House Speaker Kevin McCarthy.
He looks tanned like John Boehner.
He's at a vacation,
yeah,
is he?
I'm wondering what's going on. He's getting the Boehner look.
I'm not sure how
bit.
rested Speaker McCarthy is after the events of the last 24 hours.
Wow.
I understand. We'll talk about that in a moment. Equity futures right now on the S&P, 1 hour and 13 minutes away from inflation data in America. Equities pulling back here by 0.2%, just a little bit softer. Dollar stronger, euro weaker, tons to talk about in Europe. We're talking about recessionary environment through the whole of this year in Germany in the latest forecast set to be unveiled later this week. We're discussing the Reuters report that came out yesterday, suggesting that when we get new forecasts from the ECB tomorrow, they will be upgrading, not downgrading their CPI outlook to north of 3% for 2024. All of that still to come in the next 24 hours. Tom, your yield on a 10-year 430.
Oh, there it is, and the real yield again elevated as well into this key inflation report, 1.96. So enough of the chit chat. We need to go to our Bloomberg soap opera correspondent, Anne-Marie Horton in Washington as well. For those that are an inside baseball, Anne-Marie, and we know everybody listening and watching is, how close is Kevin McCarthy to the edge of Boehner?
Well, that's a great question. I would turn to Matt Gaetz, representative from Florida, who says that he wants to come in. It's going to be the prayer, the pledge, and the motion to vacate, meaning he is looking to potentially ouster and have this motion to vacate, ouster Speaker McCarthy from the job. And he gave this fiery, hot floor speech yesterday saying Kevin McCarthy is not in line in doing the job that he was elected by those members to do, which is potentially why everyone says you see McCarthy yesterday, first day back, going to the podium and without a House floor vote, which he indicated that he would take this to the floor first. He just launched an impeachment probe into President Biden.
I got 8 ways to go here, particularly for our international audience. We don't need a civics lesson on Boehner of Ohio down in flames. He had to get Democratic votes, folks, to get things done as a Republican Speaker of the House. But, Anne-Marie, just cut to the chase. How big is this group of Republicans? Is there a dearth of Republicans in name only in the House?
Well, the issue, Tom, is that every single one of them wants something different. So a member of the House Freedom Caucus, which many would say these are far-right members of the conservative of the Republican caucus, Ken Buck says there's just no evidence right now to go along with an impeachment inquiry. You have others that are more focused on not wanting a continuing resolution. Scott Perry, the chair of the House Freedom Caucus, saying we're not going to go on with a continuing resolution. We want deeper spending cuts. We don't care about the deal Speaker McCarthy cut with the administration when we were discussing this back with the debt ceiling drama. So every single member has some sort of provision they want in order to get their vote to say keep the government open. And that is what makes this so difficult for Speaker McCarthy to navigate.
One of the things that you do best, Anne-Marie, is to strip out the noise from the signal and to focus on what's the political drama, the soap opera, the theater versus what is real. Is it fair to say that the impeachment is theater and most everybody in Washington, D.C. is treating it as such?
Well, it is because it's an inquiry at the moment. And even if the House was to have a vote on impeachment, there's no way there's going to be a conviction in a Democrat-held Senate. So this is an impeachment to nowhere. It's going to be a ton of theater in the House Judiciary Committee, in the House Oversight Committee, James Comer, Jim Jordan. There's going to be subpoenas for a number of bank records, et cetera. But a lot of this is going to be noise. At the same time, while there's no evidence yet, potentially keeping this in the news, the Biden administration is going to have to deal with it. And so is the campaign, because obviously he's running for re-election in November of next year.
So that's the theater side. And here's the real side that a lot of people are looking at right now, away from the political circus, which is the UAW strike and the potential for some sort of breakdown in negotiations. Goldman Sachs put out a report saying that a potential strike would reduce quarterly annualized growth by 0.05 to 0.1 percentage point for each week it lasted. This is going to have a material effect on growth. What is the response from the Biden administration, and what is the response from the Republican leadership?
Well, Wally Adeyemo recently said, and he's the one we have this week on the record talking to CNBC, saying that he does not think there'll be a strike. There are still negotiations. But the reporting we have from our colleagues out of Detroit is that they are very far still at this moment, and that Sean Fain, by 10 p.m. tomorrow, will have plans in place if there is no agreement to go on strike. Maybe not at all three, maybe not at all plants, but a certain number of plants. There will be strikes and walkouts if they do not have this agreement. Between the labor workers, the union, and the big three, they just are not coming in on the hard demands that both sides have laid out. And Sean Fain has said that we are willing to strike over this. This is going to be a difficult position for the White House. The president wants to make sure that he is on the side of the union, but at the same time, he doesn't want to see growth impacted because of this or strikers on the streets in Detroit. And he also wants to, the crux of this is move the auto industry into a greener future. What you saw at the end of last month was $15 billion to retrofit those factories instead of having these companies go to the south and do these joint ventures for battery operations for EVs. And last month, almost a month ago, it would be a month to the date of the contract expiring, the president put out a statement, and he talked about how its union workers should get the first shot at any of these jobs, and there needs to be a just transition, and that union workers should have the wages they deserve to support a family. You could see the line he is trying to walk as he's trying to balance two big goals of his administration.
I'm not sure how he walks this line, AMH, without picking a side. You've got the auto manufacturers in Detroit warning about the sustainability and viability of their companies as they make the effort to make the transition. How does he carry on walking this line without picking a side?
Well, it would have been easier for him if an Inflation Reduction Act, which some Democrats wanted, which was an extra bonus tax credit for those who bought electric vehicles that were made by unions. But guess what? Toyota has a huge non-unionized factory in West Virginia. And they were never going to get Senator Joe Manchin's vote on that. This is the predicament for President Biden. At the end of the day, there's going to be a lot of phone calls that are going to be worked between the big three and the UAW. He's already tasked Gene Sperling to be in the middle of this, but so far, there's still no agreement.
Has the president made it harder for himself by continually saying that he is the most pro-union president in the history of this country?
Potentially, if you're going to see a strike and if the UAW feels like they're getting a lot of pressure from the White House to settle for something they do not want, they can say to the president, well, you're supposed to be backing us. At the same time, really, a big bedrock of this discussion and a source of serious consternation for UAW workers is being left behind in the EV transition. And what we've seen from this administration is the biggest industrial policy when it comes to EVs, climate change since the end of World War II. And that is why it is so complicated for the Biden administration.
It could potentially be a massive test for his position later this week. AMH, Anne-Marie, thank you. And the position, of course, I'm talking about is the position of someone saying that they are the most pro-union president in the history of this country, Tom. Let's see how the White House responds to a potential strike later this week.
The election's down to 10 states, I'm going to say, as an amateur. Greg Giroux at Bloomberg is expert on this. But the bottom line is those states have a tendency towards manufacturing Rust Belt and even the romance of it, the look back, the image, the heritage. And so he plays to that. And so does Mr. Trump as well.
AMH, thank you. As always, down in Washington. Coming up shortly, Megan Robson of BNP Paribas on the credit market. Plenty to discuss there. And we've had a ton of supply issuance from corporate America through September so far. Your equity market slightly negative on the S&P 500. We're down by 0.1%. Inflation data in America 1 hour and about 4 minutes away. Inflation data in America 60 minutes away. Going into it all, your equity market looks like this. Good morning to you. Futures on the S&P 500 slightly negative by 0.1%. Similar move on the Nasdaq, softer, lower, negative by 0.12%. Look out below in the equity market if you get a big upside surprise on inflation later. Let's see if we get that. In the bond market, 2-year, 10-year, 30-year shaping up as follows. The 2-year still stubbornly around 5%. Just won't go away. 5.03% on a 2-year, up a single basis point. And for all the talks of getting bullish bonds, BMO, call it a screaming buy.
Screaming buy.
Morgan Stanley, call it a buy. Wells Fargo, call it a buy. JP Morgan Asset Management, Bob Michael sitting around this table yesterday, called it a buy. And here we are through 4:30 again, Lisa, up 2 basis points, 4:30.21.
I love this. I love that you framed it that way. For all the buyers out there, yields aren't budging. And so it raises a question, who's not buying and how much is this an international withdrawal? A Japan, for example, versus something more persistent that maybe has legs.
Sets us up for the Federal Reserve a week away. The week away for the Federal Reserve, for the ECB, a day away. And it's getting harder and harder as we inch closer to that decision. The euro looks like this. The euro against the dollar, 107.37, negative 0.16%. Late yesterday, a Reuters story. A Reuters story. Bear in mind there's meant to be a quiet period, but there never is. Because whenever they want to communicate, they can just leak whatever they want to leak. to various media
You're
outlets,
so
including
cynical.
this one. Cynical, it's real, it's reality, it's what's happening. Reuters come out and say that according to official close to the decision, we're going to get an upgrade to the inflation outlook for 2024, north of 3%, which reintroduces the risk that we get a rate hike tomorrow, Tom, from the ECB. And that risk is now on the table in a more profound way, more pronounced way, at the same time that we have reports that Germany is going to be downgrading their growth outlook to contraction for 2023. That's the mess that President Lagarde has to confront in 24 hours.
And the overlay with the drama of Mr. Putin meeting the gentleman from North Korea and all the imagery that we see of that meeting is completely unspoken as this war advances. Overnight, there were legitimate missile attacks on Crimea by Ukraine directly at the Russian Navy. And I'm sorry, that's an overlay to the strategy Lagarde has to impart on the herd of cats she has to herd.
It's been the story of the year, hasn't it?
Yeah.
The fragility, the energy backdrop.
I just don't think we talk about it. We do finance, but the fact is the war's going full bore.
Well, it's all connected, isn't it?
Yes.
Without a doubt. Under surveillance this morning, the latest CPI reading from the United States is less than 1 hour away. Higher gas prices expected to help push month-over-month prices to 0.6%. Core is where the good news is for this Federal Reserve, at least a 0.2%. Do we focus on core or do you focus on headline and what's happening in the commodity market?
I think it's a great question. Or do you focus on both? And when does headline start to matter more for the Fed when it comes to the potential for rate cuts next year? Can you see rate cuts with headline figures that are sticky on the heels of oil prices? I don't know the answer, and this is something that maybe we'll get a sense of today.
Need to get to this story. So earlier today, we heard from Spirit, which had to downgrade its outlook for revenue and had to do so because of higher fuel costs and ultimately maybe even lower prices. This from American Airlines just moments ago. This is the new range for EPS, 20 to 30 cents. The previous range, 85 to 95. That stock is down by 3.4%. That, Tom, is another downgrade from the airlines. And this market was in front of it. We've had a 20% move lower off the highs of July for the airlines on the S&P 500, off the back of higher costs, thank you energy, and maybe even lower ticket prices.
And what's so important to me here is capacity is actually up. There are fannies in the seat. John, I'm looking at the chart of American Airlines back to 2014. And let's be clear, this was a train wreck, no pun intended, before the pandemic. Since the pandemic, they've enjoyed going from 30 to 10. Maybe they rebounded a little bit, but they're rolling over now at a 13 level, back on their way potentially to break support and go down to pandemic worry levels at American Airlines.
Fuel prices up, Tom. They've also got to recognise, Lisa, in the third quarter, a $230 million retroactive pay expense as well. It's kind of all going in the wrong direction at the moment for these airlines. Labour unit costs up, jet fuel prices up, and maybe tickets not going up with it.
Well, they can't. They can't. And we've seen this because we do get some consumer pushback. That's what we're hearing anecdotally. And at first we said, yeah, right, prices aren't going down. And then anecdotally, when you start looking at prices to Paris, as Tom does every day, you start to get a sense maybe they are going down. The idea of this raises a question. Is this just the airline industry? And they were one of the outliers in terms of the strength. If they're fading, is this really just a specific industry issue, or is this a broader question, especially with the UAW and the labor pushback, considering that that's really going to eat into their costs, into their profits?
This conversation is coming at a perfect time for the inflation debate that we're going to have throughout this morning with CPI about an hour away, Tom. If you're looking at fuel right now, can you really pass this on? If costs are going up in corporate America, labor costs one, energy costs two, can they really pass that on to the consumer? Is that consumer price tolerance still out there in quite the same way? Arguably, relative to where we were 12 months ago, the answer to that is no. But how much has it changed and how much weaker will it be going through year end?
Well, Mike, I don't know if the airlines are a good example because, like I said, they're flat on their back near pandemic lows, unlike the Standard & Poor's 500, unlike the 7 Glory stocks and everything else out there. But I think it's a sum of the parts. Why are used car analysis different from airline analysis? And the answer is used car prices, I believe, are maybe imploding is too strong a language, but they're disinflating.
Well, but it also points to the different economies and the different rolling recessions. Cars were what people bought in the pandemic. They couldn't travel. Then it was the revenge travel, and then they pulled back from some of the cars. My issue is, are we seeing the point at which margins have to compress more than people have previously thought? We see this with American Air. We saw that with Spirit. We've seen this across the airline industry. but it's not just there.
The back of this is disinflationary tendency. Perfectly timed. Megan Robson joins us, head of U.S. Credit Strategy, Senior Vice President, Disinflation at BNP Paribas. And what's so important here, we had on a guest earlier who frames out there somewhere next year a sub 3% inflation. What does your credit world do if we get airline disinflation, used car disinflation, aggregate disinflation, as some are suggesting?
Well, I think we're starting to see, Tom, signs of that with inflation coming down. I think a side effect that goes underappreciated is revenue slowing. And leisure has been a main top performer among high yield over this year, but we're starting to see early signs of weakness in some of those more cyclical sectors. So gaming is an example where we're seeing softer demand in some regions. I think airlines is another great example that could be impacted further by this risk of higher energy prices. But as revenue slows and you get some of these deflationary pressures, we expect margins to compress. And at the same time, you have a maturity wall that's approaching into next year.
Are the spreads at such tights, basically price to perfection types of level, if you just take a look at the extra yield over benchmark treasuries, are we really accounting for margin compression in corporate America in the credit sphere?
We don't think so. So we do see downside for credit spreads. We're forecasting wider spreads into year end. We think that decompression should play out. To really break out of this more narrow range, though, we do think we need to see more material weakness in the consumer. So we are watching for that as a catalyst, but risks are negative. I think in addition to all these dynamics, you have investor positioning, which has gotten much longer, and then this dynamic of rates being elevated in combination with margins.
High-grade companies coming to market, tons of supply. When does high yield come to play?
So high yield, we had a large investment grade calendar, very well absorbed, spreads unchanged on the week. I think what's interesting about investment grade is despite all the supply, you didn't see much on the long end of the Treasury curve. So decision makers are still reticent to really commit to issuing long-term capital. We have seen high yield supply start to come back to market this week, which is a good sign. Most of that has been on the refinancing side and higher quality. So we've yet to see sort of that expansionary type of supply from lower quality issuers, unsecured bonds.
If they came to market, could you give us an idea of the average coupon? What would it be, like 8%, 7-8%?
So I think it depends by the rating, but we're looking at around 8.5% for the high yield market broadly.
Can they live with that?
Well, I think that the lack of real pickup in high yield tells you that high yield issuers don't want to unless they have to. So I think there is, issuers can come to market and access borrowing so far if they need to. But over time, we're going to see that higher coupon, as it's digested, will eat into interest coverage even more than it already has. So we've seen interest coverage drop by about 1 times in the high yield market to about 4 times interest expense over our EBITDA over interest expense.
Are you managing for total return or to clip the coupon?
I think it depends on, it really depends on the investor mandate. So there is this debate.
My mandate is not to lose money like I have the last 3 years in bonds. Continue.
So I think heading into year end, we like carry. So we do think there's a narrow range for credit to trade in, and spreads will go a bit wider. But given how elevated yields are, carry is an attractive prospect for returns.
Do you ladder? Do you barbell? Do you single bullet? What are you doing here?
Well,
you need to make some money.
To my point earlier about investment grade supply, I think that there's a very positive technical on the long end. So we have lower issuance from investment grade issuers in the 10 to 30 year bucket. In our rate strategists, unlike some other calls across the street, we actually have constant, relatively steady 10 and 30 year treasuries heading into the end of the year. So we're calling for a 420, which we think could support long end performance.
The reason why some people say that the bulk of some of the rate increases haven't made it into the economy is because most companies haven't borrowed at these rates, particularly the lower rated ones. When does it start to bite in a more material way, where those that don't want to borrow, if rates are at this level and they have to borrow at 8-9% coupons, their business model does not work. When does that happen?
So we think it started to happen for floating rate issuers, and you have seen the leveraged loan default rate creep a little bit higher. Next year, we really think it starts to hit the fixed rate bond market in a gradual way. So for high yields, we forecast that about 13% of the market will have to refinance by the end of 2024. This will cause interest coverage to drop, and there's a lot of dispersion across sectors. So I think it really depends on the amount of lower quality issuance, a lower quality refinancing a sector is going to see, and that will really drive the impact to coverage. So some areas we see as more risky cyclical sectors, where places like tech and leisure, where you have not only the high maturity wall, but also this cyclical revenue exposure that we've talked about that could come down.
Megan Robson, thank you, of BNP Paribas, on some of the supply we've seen from high-grade companies in America, tons of it, to kick off the month of September, one of the busiest starts ever to the month of September. Tom, whether that continues is a separate question. The real test for this market, I think, is when the high-yield stuff starts to come down the pipe.
What's Luca doing in Cupertino this morning?
Luca
It's like the show's over. How many gazillion can we raise now?
Usually when Luca comes out,
calls?
it means one thing, Tom. Spreads are going wider.
Yeah.
That's usually the case with Luca's market timing. Fantastic market timer for whatever that's worth. Futures on the S&P 500, negative here by 0.08%. If you are just tuning in, welcome. CPI just around the corner. Equity futures down by 0.1%. Coming up, just after that CPI report, Tom Porcelli has a new seat. It's at PGIM Fixed Income. Very, very cool. His first interview with us right here on Bloomberg TV and Radio, Tom, following that inflation report.
This is the single best guy I know on wage analysis in America. He was a wonder child on it. He was brilliant. This guy understands job market and wage dynamic like no one.
And cost pressures and inflation and all of that. We need to recap this American Airlines story. A cut from Spirit an hour ago, a cut to the outlook from American Airlines an hour later. It really does raise the question, I think, Bramo, for a lot of us this morning. Who's next? Who are we waiting for now? United, Delta? Who's next?
This isn't just oil prices going higher. There is something more, especially when you start talking about the cost of employment and you start hearing about that kind of pushback. Does this lead or signal a wave of margin compression that is not yet priced in? This is something that we've heard a lot from Michael Wilson. Do we see this continue from other sectors in particular?
To me, it's hugely behavioral. They got to put fannies in the seat. It's a fixed cost experiment. And in the headlines, capacity is still there. They're hyper managing, as Robert Crandall invented, price discrimination within the cabin. And look at the Paris trip, 7,000 whatever, 14 grand, 2 people to Paris. It's now under $7,000.
Total revenue per available seat mile. This is the range from American Airlines, Tom. Negative 5.5% to negative 6.5. Previous range was negative 4.5 to negative 6.5. The outlook, not great. Coming up shortly, Republican Congressman French Hill of Arkansas on an impeachment inquiry in Washington, D.C. That's next. This is Bloomberg.
I am directing our House committee to open a formal impeachment inquiry into President Joe Biden. This logical next step will give our committees the full power to gather all the facts and answers for the American public. That's exactly what we want to know.
The latest in the nation's capital, Washington, D.C. That was House Speaker Kevin McCarthy. That conversation coming up shortly with Congressman French Hill, the Republican from Arkansas. Before we get there, just going into the inflation report in about 43 minutes' time in America. Inflation in America, the CPI report just around the corner. Equities look like this. We're down by 0.06% on the S&P, just a bit softer. Yields a touch higher by a couple of basis points, Tom, to 430.21.
4:30:21, and just a lot going on here. The countdown clock's helping me out today, John. 43 minutes, 4 seconds and counting here to the CPI report. It matters in New York. It matters in finance. You know what? It matters in Arkansas as well. I mean, it's that
big time.
It's just that way worldwide. There's no other way to put it. Joining us right now, the gentleman from Arkansas, French Hill, Republican. French, I got like 14 ways to go, ending with Arkansas football. But forget about that. Kevin McCarthy has a football he's playing right now I read Cass Sunstein's magisterial book, Impeachment, cover to cover. It seems like we're almost downgrading impeachment as a concept of our civics lesson. Have we ruined the phrase impeachment? Have we bastardized it?
Well, you bring up such a good point, Tom, and that's how I felt during the Nancy Pelosi impeachment for President Trump 1 and 2. I felt like it was rushed. I don't think people collected the evidence. I don't think they even looked for the facts during those years. And that's why I was pleased to see McCarthy this year really encourage Jim Jordan in the Judiciary Committee and Jamie Comer, who chairs the Oversight Committee, and the same for Ways and Means with Jason Smith. Do your homework. Don't rush this. And so for the last few months, they've asked simply basic questions about, Joe Biden says he didn't know anything about Hunter Biden's business dealing. He wasn't involved. He didn't have any business relationship. And what they've uncovered is that those assertions from President Biden weren't true. And so that's what's led, I think, Speaker McCarthy with Jordan and Comer to take the next step to give them an extra clout in asking the banking and legal records they need to answer those questions definitively.
Do you have any sense, as an adult in the room, Congressman, banker from Arkansas, do you have any sense that there are high crimes and misdemeanors involved?
Well, one of the constitutional lists of impeachment items in the Constitution, of course, is bribery. And actually, in the whistleblower testimony from the IRS agents and other people that have come forward, there is that suggestion that potentially there was a bribe involved here or a cover-up of illegal activity when Vice President Biden was in office and Hunter Biden was taking action here. And then it leads to the question, well, what's happened since President Biden's been president? The only way to get to those facts is simply have both sides present those assertions and look for the evidence and follow it where it goes.
You know, I look, French, I know Lisa wants to jump in here. These are really important questions. Where is this going to be into the Republican primary season? I mean, I understand there's theater here. There are partitions of GOP. You're in a certain partition. Where does your type of Republican want this to be in February?
Well, I think for all Republicans, all Democrats, and all independents, to get to the bottom of this quickly and promptly is important, and see where the facts lay out. Perhaps President Biden and Hunter Biden, their attorneys, their lawyers can present evidence that those suspicious activity reports, the LLC formations, the $21 million in payments to those LLCs, et cetera, all are completely logical and don't have anything to do with President Biden today or as vice president, and that'll clear up the whole matter. So I hope it's over just as soon as possible. But we want to make sure that the work gets done in an effective way, and that's what I really do contrast it with how the Trump investigations were carried on by the House Democrats.
Congressman, in your Bentonville, there probably is less concern about the impeachment proceedings and much more concern about the UAW strike discussions. What this means going forward for worker earnings, what this means for negotiating power. What do you hope happens tomorrow at 11:59?
Well, again, this administration has been very pro-union, and they have taken the side of the union in every legislative battle. So I think that question's better left for the administration. Obviously, the United States doesn't need a strike right now, but this administration has had such a pro-union policy in every way, stretch, and form. I'm sure the unions are feeling quite empowered to take action. And that's concerning to me because I think the economy is at a very fragile moment.
That said, I was looking at a number of reports calculating what the earnings of some of these union workers were and extrapolating out to a 40-hour work week. It's about $35,000 to $67,000 a year. This at a time where inflation is continuing to rise and where we saw the biggest drop in household real income last year, going back a decade. What do you propose to actually increase wages at a time where, on a real basis, households are basically being taxed by inflation?
Well, first of all, stop inflation. And we could have done that if we'd taken our foot off the gas at the Federal Reserve in the fourth quarter of 2020 instead of doubling down and buying another $1 trillion of bonds and keeping interest rates zero. And if we hadn't unleashed an avalanche of spending to where we're now spending on an annualized basis over $6 trillion a year, when we were spending in FY19 $4.5 trillion. So beating inflation is the #1 way to help working families.
Well, but Congressman, I guess that, and I apologize for interrupting, I guess that I'm wondering what the cohesive plan is at this point, other than saying, you know, the Fed. What is the cohesive plan? Yes, spending cuts, although it's been on both sides of the aisle that you've seen spending expansion. What is the plan in the near term to bring down inflation from your side?
Well, I think they are linked, and you can't separate them. I mean, the Fed's job's been made much harder because of the incredible fiscal stimulus and regulatory burdens put on by the 2 years of the Biden administration. And that's why in the debt ceiling deal, we propose get more workers available for the workforce by encouraging work in the assistance programs, cut down regulatory burden, make it easier to get a project permitted, and cut spending and try to get spending back to pre-pandemic levels and stop having these huge budget deficits that Joe Biden has forecast.
Congressman Hill, a very serious question. We are so focused on 3 zip codes here, the doings of financial America and the global reach of Bloomberg and all. What are you hearing from small business people in Arkansas? The unemployment rate is low. Life is great. Arkansas is stealing for a game against LSU in 2 weeks. I get it, but what are you actually hearing from small business in your state?
Well, I spent a lot of time in August talking to businesses all over the 8 counties of central Arkansas, and I have to tell you that labor is still an issue for both white collar and manufacturing, where they're trying to find the right people for the right seats with the right training. And so Governor Sanders has really put an emphasis on workforce development. That's something I've worked on for the past 15 years as a bank president, as a chamber chairman, and now as a congressman. And so the technical skill attainment, and then just the bodies, Tom, it continues to be an issue. We have low unemployment in Arkansas, and despite inflation and despite all the economic challenges, that's what I hear about both with community bankers and with individual business owners when I'm at home.
Razorbacks at Tiger Stadium, TK.
They're going to get past BYU.
Are you proud of me, French, that I know all this now?
Yeah, it's just great.
I see engagement. We're taking a baby step forward, and the next step is to visit Razorback Stadium in Fayetteville.
That's up to you. We're going to make it happen. Congressman, thank you. Congressman French Hill there on the latest, an impeachment inquiry and the cost of living, Tom, in America.
Well, it is. In the inflation report, we were 34 minutes away from this key inflation report. And to me, John, the heart of the matter is the fancy people we talk to, like Rabila Farouk, have disinflationary tendencies in place. Our world changes with sub 3% inflation, except in Arkansas, that's not how they feel.
I've been surprised that presidential candidates have been going after Chairman Powell. I'm not sure how that polls. This is what you should do, exactly what French Hill just did. The reason why rates are high is because they've been doing XYZ in the White House. That's a more effective line of attack, I think. I mean, how many people in this country know Chairman Powell is and the Federal Reserve?
Are you busting my chops because I didn't know what Generation XYZ was yesterday?
Yeah, I am. Yeah, that's exactly what this is about. That's exactly what this is about.
You're brutal.
Daryl Cronk of Wells Fargo up
What's
next.
The connection?
The effect of the massive policy tightening that we've had is going to have an effect on the economy. It's just taking longer to percolate than people thought.
I think the Fed absolutely has more ammunition in its tool belt to continue to raise rates closer to that 6% target.
They were already wrong once on inflation with the promise of transitory. They can't be wrong again.
The Fed's getting its way here. It's removing some of the demand, some of that froth, and yet not crushing the economy.
It's more likely that they hold rates here or maybe one more rate hike as opposed to go ever higher.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrell, Lisa Bramos, and Tom Keene on radio and television. The countdown clock says it all. 29, 10, 9, 7. The gantry separates here.
You're going to keep this up.
The inflation report
Lift
in
up.
30 minutes. And what we've got is the airlines maybe telling Washington authorities what's really going on.
They're telling you two stories. Labour unit prices are higher. Jet fuel costs are higher. And ultimately, here's the question. Can they pass it on to the consumer? That's what we'll be talking about in about 29 minutes' time when that US CPI report drops.
All sorts of ways to go here with this inflation report. Rabila Farouki, I think, with the comment of the day, looking for a modeled out sub 3% inflation out there somewhere in 2024. And the key thing, John, is how does it fold into what we do with markets? What does it do to the Saudis and oil? What does it do to the stock market?
Crude, 92. That's the number that matters right now, Tom.
Yeah.
89 on WTI. On Brent crude, 92.53. Headline inflation's going to be elevated because of gas prices. I think we all know that. It's baked into what we're estimating, actually. Headline to come in at 0.6% month on month. It's core. Where does core land? 0.2 is the expectation, which is why, in the minds of so many, Tom, rate hikes are on ice at the Federal Reserve next week. But there is this risk. This risk is still out there that maybe inflation starts to pick up again. And that's why this Federal Reserve needs to be somewhat cautious, TK, about how things materialise into year-end and beyond.
It's out there. There's a toxic brew out there 28 minutes away. But, Lisa, the real question is, what do we do at 8:31? How do we readjust to what do we got? Line up the ducks, a UAW strike, tomorrow. Formula One in Singapore. Then we move on to a Fed meeting. We're going to London on a reduced fare. Did you see that?
I did see that.
Yeah.
Did you get a reduced fare?
I got a reduced fare. They said
I booked my ticket months ago.
Redo keeper of the Amex said, Tom, you're not taking the Gulfstream. Move on. And so there we are. Lisa, what do you think of this? I mean, at 8:31, we recalibrate.
It's actually a really good question, which is what is going to move the needle, given the fact that everyone is looking at core, expecting it to be sort of in line and not really showing any reacceleration. Headline numbers, people are expecting to go up, and they don't really care. They're saying, it's transitory. The Fed's going to look past it. When does that headline figure really matter in a more meaningful way? Can the Fed be cutting rates next year if the headline figure is still running really north of 3%, north of 4%, even on the heels of oil prices?
Torsten Slok channeling Jason Furman up at Harvard. I've been talking this up, John, whether it's 3-month moving average or 3-month annualized. Slok publishes today the trend, the vector, in non-farm payrolls, 700,000. He's out about the time of the Arsenal-Tottenham derby that we see next year, 20,000 positive. Wow. David Kelly at JP Morgan says a negative NFP. That begins to fold into the debate after 26 minutes away.
Thanks for the promo, because Torsten Slok's joining us, I think, in about 57 minutes' time on the Open on Bloomberg TV. So
That'll
we'll have this conversation.
Well timed.
He put out some great charts over the
weekend.
weekend.
Wear a Jets jacket?
I've talked about that over a couple of days. That's Mohammed on Friday. He'll wear a Jets jacket.
Okay, excuse me.
He's put out some great charts over the weekend, TK, about why he thinks maybe we are sufficiently restrictive. Away from the mortgage market, what you're seeing elsewhere, delinquencies up, bank lending started to contract in various places, and that'll be a part of the conversation we have with him a little bit later.
Speed data check, 10-year real yield, 1.96%.
How fast? Just super quick? Equity futures down.
We got a great guess.
By 0.03%, yields up 2 basis points. Tom, your yield 430.
25 minutes, 37 seconds away. Daryl Cronk, Chief Investment Officer of Wells Fargo, joins us now with decades of experiment. Everybody's in a lather. Do I buy stocks? Do I add to my portfolio now? Do I go to cash? What's the mood at the margin with equity allocation?
At the margin, people are basically renting the market right now with a VIX that's at 14. You can use the options market with cheap premiums to get your exposure, but they're quick to sit near the exits. It's like your airline ticket to Europe. You want to buy the best seat and sit near the exit, right? And be ready to basically get out. So I think it's, we're stuck between this 4,300 and 4,600. All we've done is bounce back and forth between it. At this point, you need something to change in the baseline to really accelerate beyond the 4,600. Equity risk premiums are at a 19-year low. I'm not getting paid to take equity risk today.
Can we build on that just a little bit? Because I was curious too. I was looking back to the last inflation report. I think it was August 10th. Since then, the market's just been dead flat.
That's right.
And we've got the data we wanted to see, didn't we? With further signs of disinflation, growth still robust. What aren't we happy with?
So let's talk about inflation for a minute, right? When nobody's talking about this morning, everybody talks about the headline number, obviously going up because of energy prices. Everybody talks about core coming down, right? Which is important. Double click on core, right? Double click on core. What is Powell's super core doing ex shelter? It's going to go up 0.4 this month from up 0.2 last month, right? And it's still going to be running north of a 4% number and maybe even a 5% number. So if you think about, if you bookend this with headline, super core with core in the middle. Yes, core in the middle is a good story. Headline's not a terribly good story with the oil prices where they are. Super core is not a good story.
So what are we talking about here? What industries are sort of reaccelerating in a way that's catching the Fed's attention? Because I'm getting lost in the core, super core, non-core, how core. At a certain point, what is the Fed really keying in on if you are seeing housing costs disinflating on the margins? And, people are seeing goods prices disinflate at a pretty hefty pace.
Yeah, it's a good question, Lisa. So I would say, obviously, if you think about inflation, it's commodity prices, it's wages, and it's housing. Out of those three, housing is giving us some good data, right, in the form of slowing, right? You're seeing mortgage apps go down. You're seeing existing home sales come crashing down, actually. Rents are coming down, so that's good. Commodity prices and wages are still very, very sticky. So if you get into that supercore, why is it up 0.4, to your point? Travel, the travel is starting to fade now, basically, and health insurance numbers are fading. So the services piece, which is what Powell cares about, is still running much hotter than people expect and want. So I think you've got to really look into the data much deeper than what a lot of people are doing. They want to take the core and run with it. It's a little bit like, I'm going to use a John analogy here, right? It's Goldilocks and the Three Bears, right? It's the English fairy tale, right? Everybody wants Goldilocks to the equity markets, but your three bears are oil prices, interest rates sitting a few basis points off a cycle high, and earnings, right, which we're coming to the end of third quarter. Earnings growth is still going to be basically zero for third quarter, which is still going to be a challenge. So who's going to win that battle, Goldilocks or the three bears?
Given the fact that basically you're saying oil prices matter, and they're going to matter to the Fed, and they're going to matter to input prices for services that really count on oil. So what are you expecting? How high does the headline figure have to be to capture the market's attention to mean that the Fed has to respond to a headline figure that a lot of people say is very volatile?
I think the upside is calibrated well there. I don't think a headline number can get them off center for September. It may put November back into the conversation, right? But I think if you saw 0.8, 0.9 on the headline number, right, which would take your headline basically from, it'd put it somewhere around 4.7, 4.8, pushing a 5 number again. That would certainly get their attention, but they'd be able to, again, calibrate it to energy prices, and food prices have moderated some, right? But, I don't think the headline moves it for them. I really think the story is about core and super core, ex-shelter.
Do you think they're still willing to beat down growth to get inflation lower?
Yes, absolutely.
I didn't get that impression in Jackson Hole whatsoever from the people around that meeting.
Well, look at, so in June, 12 of the 18 members who have a vote on a dot, right, an SEP, right, still say there are more hikes ahead of them. That didn't change in July, right? We'll see if it changes here in September. So they're still saying, like, look, we've got at least one more hike. Now, again, the market's taken solace from that of, like, that's the end of the road, right? It's kind of like one more for the road, right? One more hike and then we're done. And so they're taking solace in that. But it's what everybody talks about. It's keeping rates high for long and the grind that happens on growth.
I want you to talk to retail institutional Wells Fargo clients who have hit a home run with these 7 big tech stocks. They're all trading at 30 times multiple. So if I take a 30 times forward multiple Microsoft, how does that react given a presumed growth scarcity? Do they become ever more treasured and even sustain or trade higher in PE?
Well, that's been obviously the trade this year, which is when growth is scarce, right? You take whatever growth you can get, right? Which is the place you've been getting growth. I think what's interesting is if you break down things like the semiconductor industry, which is the darling, right? You've got now half of that industry in the S&P 500 below its 200-day moving average, right? It's failing technically right now. Consumer discretionary, half the names in the S&P 500 below their 200-day moving average, right? So under the surface, again, you're starting to see erosion and deterioration.
Are you seeing that in Apple, Microsoft, and the others?
Yes. They're all sitting, I mean, on a technical basis, the 20-day pierced the 50-day from above, which is a bad technical sign, and you're starting to see them fall down below the 50-day, which there's a big blue sky between the 50 and the 200-day, right? So what I would say there, Tom, is you're losing engines, right? If those were the engines for the first half of the year, right, think almost in terms of a plane, you're losing those engines that you need to really drive us forward here. And I agree with the conversation that you had yesterday about the consumer is stretched here, right? We have to pay attention to that.
Can we put some numbers on this just quickly? What kind of downside are you thinking about?
So we think the risk reward for equities, right, if you just use the S&P as a proxy, starts to turn around 4,200 or less. So it's probably, I'd much rather see it around 4,000, 4,100 to get equity risk premiums where they are, get multiples where they are. I mean, today, if you just simply take a 20 multiple,
You sounded
John,
super gloomy, so it's not that drastic. It's 300 points.
No, I don't think it's a correction, right? Yeah. And I think you use that correction to base off of for next year. But at 20 times earnings, right, you not only need earnings growth, the market's starting to demand it, right? It has to have it, right, in the back half of this year and early next year. So we've got to turn that at some point.
Daryl, this was thoughtful. It's good to see you. Always
You
is.
too, John.
Daryl Cronk of Wells Fargo. If you are just joining the programme, welcome. We're counting you down to CPI in America. Equity futures right now on the S&P, totally unchanged almost. We're positive by 0.01%. Coming up shortly, Tom Porcelli of PGIM Fixed Income to weigh in on that inflation data. Mike McKee is going to be with us around the table as well, as is Regina Mayer of KPMG, because on CPI Wednesday, TK, we have got to talk about the price of a barrel of oil, WTI and Brent, at new highs for 2023.
Regina Mayer brings a great scholarship to this, and next week in London, I believe we're scheduled to meet with Christian Malik, who's just brilliant on EM demand and such. And I made as a joke earlier the stew that's out there, but you look at the airline shortfall, what it's done to that sector, if you will, back to pandemic, literally back to pandemic lows. And the basic idea I would have is, are we going to get clarity here in 17 minutes, 15 seconds? And I'm going to say yes, we are going to have a clearer picture here at 8:31.
On what do you think specifically?
The vectors, the 3-month. I'm going to 3-month annualized. I was trained to take 90 days of data and squeeze it out 1 year as a respectful guesstimate. And that's a raging debate among the nerds right now.
Where's the clock now, Lisa? 16 minutes and 51 seconds, something like that?
Yeah, I actually agree. I think that we will get a lot of clarity, but not because of the actual numbers, but because of how the market responds. I think it'll be interesting to see where the balance of risks are right now, not for the Fed, for the markets in terms of upside or downside potential surprise.
The 2-year yield came in a 5.04. I don't think that's a small matter.
I don't disagree. It's near cycle highs.
Yeah.
Going into an inflation print that is set to show further signs of disinflation on core. That inflation report is about 16 minutes away,
18,
live from New York City,
17,
with your equity market
15,
totally unchanged
14,
on the S&P 500.
2,
This is Bloomberg.
Gantry's pulled away.
It's more likely that they hold rates here or maybe one more rate hike as opposed to go ever higher. I think where the market may be a little bit off base is to think that the Fed's going to ease a lot in 2024. I think the last mile in terms of getting inflation down, I think it's going to turn out to be pretty difficult. And so I think that means that the Fed's going to keep rates higher for longer than people think.
Bill Dudley just nailed this Fed rate call a couple of years ago, the Bloomberg opinion columnist and former New York Fed president. I remember the conference. I was speaking to him, Mohamed Al-Erin. It was the summer of 2021. And Bill was talking about Fed funds going through 5%.
Yeah.
And at the time, Tom, I think we're all just shaking our head. What's Bill Dudley talking about? 5%. And here we are staring down a prospect to getting closer to 6. Never mind going through 5.
How did he do this? It was Dudley and McKelvey at Goldman Sachs. They had a young Turk, I think he was 23 years old, named Hatzius, who, picked up the coffee and be sure everybody was
doing
okay.
all right at Goldman now, yeah.
And in the crucible of market economics, he would crank this out. He is a lone duck in our monetary policy. He's been in the crucible, again, is the right word. He's been in the market economics of day to day. Very rare.
And he's now talking about higher for maybe even longer. Let's go through the price action together, just going into this inflation report about 13 minutes away. Equities are totally unchanged on the S&P 500. In the bond market, yields are a little bit higher by 3 basis points at 431. The dollar's stronger against the weaker euro at 107.31 into the ECB tomorrow. But here's the number I want to talk about. 89.20 on WTI. On Brent, 92.46. And for the airlines, it's getting tougher and tougher. Unit labour costs are up, fuel costs are up, and the outlook is not looking good. We get a cut to the outlook from American Airlines this morning, Spirit as well. Lisa, American down 3.26%, Spirit off by 4%.
And you could see the declines in commensurate airlines across the board. What's interesting to me is it's not just Spirit, which is more domestically focused. It's also American. This is a broad-based weakening when it comes to profits and the compression that you're seeing with costs going up, which raises a question, and we were talking about it earlier.
Oh, we're on the same page, Bramo.
Very
totally.
much. Is it just an airline story, or is this a broader economic story of what's to come in corporate America?
Can they pass it on?
Yeah.
Can they pass it on? So let's take crude. I'll go back to that framing we used in the last couple of hours. Is oil an example, a reflection of the extension of this cycle? Things are better than we thought they were, and we can absorb prices like that, or a recipe to end this cycle? I'm not just going to talk about crude. Lisa, let's throw in yields as well. A high yield's a reflection of the extension of the cycle, or a recipe to end it? 6
months ago, everyone said a recipe to end it. And then they were wrong.
Here
we are. And the economy just kept grinding along. Yes, we can exist at 5% benchmark rate. So if that's the case, are we misunderstanding some of the oil prices that everyone is saying is purely from supply cuts by Saudi Arabia? Is it also a demand side that could keep it going for longer than many people would like?
Can this economy get by with $92 Brent and 5% interest rates? We'll see. Inflation data just around the corner. Allow me to share the estimates with you. Month on month for headline, 0.6%. The previous month, 0.2, 0.6 is the estimate in our survey. Month on month for core, better reading. 0.2% previously, 0.2% in our survey. Mike McKee, you've got to break this one down for us in about 10 minutes' time. Mike, what are you looking for?
Well, we're looking at some of the categories that you just have been talking about. You and Lisa, airline fares have been down for 4 months in a row. They dropped 8.1% last month. Now, can that continue? That's something to keep an eye on. Maybe in August it did. But going forward, with fuel prices up and now they got to pay these huge wage settlements, airfares could be going up again. And that's a fairly heavily weighted category in the core. We're also looking at shelter costs. Do we still see progress on rents and owner's equivalent rent coming down? And of course, everybody's favorite, used cars. Here's a tipping point. Is it going to change because the UAW goes on strike? The big three have very large inventories right now, so it won't matter for a while. But if it were a long strike, then you'd probably see used car prices go up again.
Mike, just to build on the oil conversation and this question of headline CPI versus core, at what point, based on your knowledge of the Fed and its history, what point does the Fed feel compelled to raise rates in the face of higher oil prices?
They probably don't, in that sense that they wouldn't directly attribute it to higher oil prices because the Fed can raise rates all at once and it won't push oil prices down. What they'd be watching is consumer expectations. Do inflation expectations start to rise because people are paying more for gasoline? And that would have an impact on them. But exactly how do you attack that is difficult when it comes to oil.
Mike, 8 minutes away here. First thing I did when I walked in the door this morning is went to my favorite Cleveland 16% number. Great series out of the Cleveland Fed. Which series away from this gives you a better core knowledge than core?
better core knowledge than core. I mean, the Cleveland Fed is good. You can also look at the Dallas Fed has a trimmed mean as well. And a lot of Fed officials like the Dallas numbers. And also what's kind of interesting is it only gives us a sort of look backwards, but the consensus forecast of economists surveyed by Bloomberg is one of the most accurate of anything that we survey on. So if we come in at 02 today and we come in at 06 on the headline, that'll just show you pay attention to the people who have Bloombergs.
Mike McKee will continue with us here 7 minutes away from this important report. We're going to digress here. As John mentioned, what else matters? $92.45 Brent crude. Regina Mayer is Global Head of Clients Markets and Petroleum at KPMG with military service to the nation. Regina, thank you so much for joining us today. Your research note is demand, demand, demand. Are the Saudis aware of the resiliency and demand that KPMG projects?
Absolutely. So part of the supply challenge is it's against the backdrop of a stubbornly robust economy, but it is also a big supply part of the equation, right? We are anticipating supply drawdowns through the rest of the calendar year, Q3, Q4. And we're in probably the tightest supply situation that we've been in 10 years. 10-month crude highs, that you've emphasized. But what I'm looking at are some underlying indicators. U.S. production is almost at its record high, 12.84 million barrels per day against a record high of 13 million barrels per day, with 17% of the rigs off the market. That's 127 fewer rigs, with the Saudis intentionally keeping barrels off the market. Right now, we're saying there's roughly a 3 million barrel per day supply versus demand gap because demand continues to go up. And we think OPEC's purposely keeping about 1.8 million barrels per day off the market. And there's no global relief valve in this environment. We can't rely on the SPR. There's no other source where we can turn on a tap and oil will flood back into the market.
Given the fact that production is so high in the United States, is that an indication that, yes, inventories are the tightest, as you said, going back 10 years, but this isn't as much about supply as it is ongoing continued demand, and that people are underestimating the strength on the other side that's also fueling some of these price increases?
Yeah, so we've been talking about peak demand. Potentially it happened pre-COVID. I think we definitely have put that in the rearview mirror. Right now, the EIA is saying average demand for 2023 is going to be over 101 million barrels per day. That's average. So last month, we just came off one of the hottest summers in a lot of years, and we're anticipating that's 103 million barrels per day. That's the 3 million barrel per day gap. And then the EIA is projecting it goes up to 102 million barrels per day in 2024. When is peak demand going to take place? Some are predicting it's this decade, some are predicting it's next decade. Regardless of which decade you anticipate that it's coming, we know it's coming. So if you're a major oil company or a major resource holder, you're trying to figure out when's the last marginal dollar of additional investment that I'm going to put in to grow supply against a backdrop of ultimately that supply is going to be in excess of demand.
Given that backdrop, if there is a recession or some sort of downturn, a softening in the economy, could that offset the tightness in the oil market? In other words, could oil prices come down sharply in a surprise, even with all of these technical backdrops, simply because you do get a weakening of the consumer?
Absolutely. I think if we start to see more signs that the economy is slowing down, you will start to see oil prices come back down. We are seeing the potential for supply rebuild in 2024. So it's really just this 6-month period. I know there are some that'll say it's triple digit for longer that's coming. I think there are bear signs in the market. But right now, frankly, it's all upside, very little downside.
Regina, just one final question here. With great respect for your bringing in international relations into the KPMG oil debate, does the United States of America have an energy policy?
I think we have different aspects of energy policies. I think some of the things that we've just recently seen on Anwar is more politics versus substance. It would have taken billions of dollars in investment to get drilling production and then moving that material to market. We would be best served to focus on where are our great sources of resources, Gulf of Mexico, onshore and conventionals, other dry gas plays. There are lots of different factors that slow down the ability for our industry to exploit those resources. I do think there's room for a more coherent, more effective energy policy overall.
The policy is lower prices, TK. I think that's the policy. We just want lower prices. That's kind of it.
Dead on.
Regina, just quickly, when does demand destruction start to kick in? Aren't we already thinking about that in the 90s?
For sure. I mean, I think if gas prices go substantially over $4, we're at the end of summer driving season, and U.S. gas prices are 12 cents per gallon on average higher than they were this time last year. That's probably not enough to drive demand destruction, but some of the things that you were all talking about relative to airfares, the pinch that people are starting to feel relative to how confident they feel about the future, how confident they feel about their savings cushions. I do see some of those pressures that could dampen demand as we move into the fall and the winter.
Regina Mayer of KPMG on the oil market. Regina, thank you. Crude, Brent through the 90s, WTI getting closer. The inflation report about 2 minutes away. Given what we're discussing here, what's more important, inflation in a couple of minutes or retail sales tomorrow? Drew Madison, MetLife, writing in, inflation trends is unlikely to move in a way to prompt a change in Fed thinking. Retail sales more likely to change Fed
totally agree.
Thinking. That number drops, Tom, tomorrow morning.
I have it right down in front of me. I brought it up just as Drew was probably right in that. The idea, I agree, retail sales dovetails in here with a GDP adjustment given any shocks, and then that goes into where Torsten Slok is in your 9 o'clock hour, which is a non-farm payrolls coming down.
Elisa, that speaks to the question you've been asking all morning.
Yeah, well, this to me is at what point is retail sales a reflection of whether higher inflation is essentially eating into discretionary spending? And that's to me the issue right now that we're facing off with. And that's the real question. And retail sales is the kicker to the chaser, which is really what we're going to get today. And ultimately, we just don't know because it might have been boosted. We saw that, some of the peripheral data, there was, Amazon Prime or whatever, and people are back to school. And when you strip out all those distortions, what do you get? It's always been stronger.
You said something earlier on this week that I think is really important, and I saw it in Citi Research as well, so they agree with you. When the data starts to contradict, we're at turning points. And Citi said the same thing, Bramo, and there's a lot of data out there at the moment that seems to be contradicting with each other. Claims are super low, and then you look beneath the surface of the jobs market, you start to see some cracks emerging.
I was speaking with a policymaker, and I was saying to them, is the data manipulated? Is it fake? Is it the idea?
Massaged.
Is it massaged? Is it this people aren't really responding to all of the surveys? Is it messy? Is it inaccurate? And they just looked at me and they said, this always happens at these moments.
Yep.
We just don't know which way it's going to turn. It is too facile to simply shrug it off as wrong.
Inflation data 15 seconds away. Going into it, equity futures on the S&P just slightly lower on the S&P 500. Yields in the bond market on a 10-year up by a couple of basis points. On a 2-year, 5.03%. Yields higher there by a single basis point. With the economic data this morning, here's Mike McKee. Morning, Mike.
Well, I said that economists were pretty good at forecasting, and they were pretty good at forecasting this time, except for the core there. It comes in a little hotter at 0.3 on the month, which pushes the year-over-year core to 4.3, still what had been forecast. The headline is up 0.6%, and that is what was forecast. And so the year-over-year number rises to 3.7% from 3.2. That's a tick higher. So it looks like perhaps that 0.3 was a revised up number. Let's take a look at some of the categories here. Food prices up only 0.2. So no real change there, but we get a big jump in energy prices. Gasoline up 10.5%. No surprise, I don't think, to anybody, but it definitely has a weight on this index. Used cars and trucks fall again 1.2%. They're down 6.6% for the year. So that puts pressure on the other direction. And then, of course, services, less energy services up 0.4, but that includes a 0.3 gain in shelter. So let's see what the markets are doing. I'll get you some more numbers here in just a second.
I'll start with the bond market, Mike. Stay close. I'll come back to you in just a couple of seconds. So that small upside surprise on core inflation lights a fuse under the dollar. The dollar is a whole lot stronger off the back of this. Yields are a whole lot higher in the bond market, up 5 basis points on a 2-year, 5.07%, call it 5.08 on a 10-year yield higher by 6 basis points. So the whole curve, a lift here. Yields pushing higher right across the curve. 2's out to 30s. Got a 10-year higher by 6 basis points. 434. 30 are up by 4 basis points to 439. But it's that 2-year piece of the curve that gets your attention. So yields up, dollar stronger, euro dollar holding on to 107 again at 107.18, and equities just a little bit softer here. We're lower by about 0.25% on the S&P 500. Mike, you've had time to take a second look. What stands out for you now?
Well, we were talking about airfares before the numbers came out, and airfares did rise 4.9% during the month. So that is important. Now, breaking down the housing numbers, we see shelter, as I mentioned, had been up 0.3%. Owner's equivalent rent up 0.4%, but rent of a primary residence up 0.5. That's a rise from the prior month of a 0.4 gain. So it does suggest that there is an issue with housing still not coming down the way that the Fed would like to see it. Overall, this is probably neutral for the Fed, and we can talk about the idea that perhaps we see retail sales have more of an impact, but hard to say at this point that anything will derail them from September hold.
I've got a derail, Mike. I got yen out to near 148. That gets my attention. It's a global distraction, but I've got a 10-year real yield out 3 basis points, popping a 1.96 right now. We even saw 1.98 seconds ago. Does an elevated real yield figure into Fed calculus?
It does over a longer period of time. As inflation comes down, obviously, real yields are going to rise. So the Fed has to keep an eye on that. They don't want to get any tighter than they feel they must be. But that's a long way away, and inflation on a headline basis for the CPI went up. Remember, the PCE is the Fed's indicator, and that has been moving at a slower pace than CPI. So the Fed is not overly concerned about where we are with real rates yet.
What I find interesting, Mike, just in the price action of the markets is that the long end is also affected in tandem with the short end. It's sort of this feeling that this robustness of the U.S. economy can continue even with rates where they are, even despite all of the negative discussions. From your vantage point, is it surprising? How surprising is it that we got some of these upside surprises in the core element, which was exactly where everyone was expecting to see the softness that everyone was hoping for?
Well, it is obviously a bit surprising. On a year-over-year basis, base effects mean that we don't lose any ground. We see the core year-over-year come down some. But the services prices, and we have to dig into that even further, the services prices are going to be a concern for the Fed. Now, one of the things that we had seen in the past is that commissions on Wall Street had gone into the CPI and the PCE and pushed up that services X housing number. And I haven't gotten that far into the data yet, but that's something to look for as well.
Mike, we'll come back to you a little bit later. Looking forward to catching up. Let's run through it. The fun and games lasted about 60 seconds. The whole move has faded since then. Equity futures basically back to where they were on the S&P 500, negative by 0.1%. In the bond market, we look a little something like this. Treasuries, 2-year, 10-year, 30-year. Yields higher, but that move fades as well, up by 2 basis points on a 2-year to 5.04%. And if you take a look at the chart of the euro, if you can access one, basically back to where we started. We're negative 0.2%. Dollar's still stronger, 107.32. To discuss a little bit later in the next hour, Torsten Slok of Apollo, Caterina Simonetti of Morgan Stanley, Robert Tipp of PGIM TK, all of that in the next hour on Bloomberg TV.
So nothing burger, and what does it mean for retail sales tomorrow?
Basically
it's
that.
Simple.
That's it. 60 minutes of that,
Are you
Tom,
okay there?
on Bloomberg TV. That's the tease.
We're going to continue right now. And speaking of Mr. Tipp at PGIM, joining us right now is Thomas Purcelli, Chief U.S. Economist at PGIM Fixed Income. He's definitive with work on the open market desk at the Fed, and also truly great work on wage dynamics in America. Congratulations on the new shingle across the Hudson.
Thank you, sir.
As simple as I can, I want to go to your wheelhouse right away. You're talking to Greg Peters, which is really difficult. You've got to, prepare, medicate yourself.
He's the best. Loving the pieces.
You're talking to Greg Peters here, and he's going to turn to you just like I am and say, okay, but what about wage dynamics? That's what you own the high ground on. How are wages in America into 2024?
Yeah, look, I think here's the problem for the backdrop with regard to wages, which, look, in real terms, I think we'll appreciate are sort of performing decently. The challenge, though, is if you have real revenue that's moving sideways, right, which it is, and you have, which obviously is a function of the consumer that is sort of slowing down to some extent. How do companies respond to that? How do companies respond to real revenue moving sideways, wage pressures firming up a bit in real terms? I think that, to me, that's a perfect recipe for companies to go after labor, particularly if it means you're going to get a margin compression, which is something that, we've been talking about for a while. And I think, Lisa, you and I talked about that last time I was on. That, to me, is a challenge as it relates to sort of the labor dynamic in the United States.
To translate this,
they're
going to be layoffs. That's basically what you're saying, is that if you see this incredible margin compression, if you see costs going up, and you see consumers pushing back on prices, the next step is people are going to lose their jobs. How much pushback is there actually to pricing if we're still seeing robust services side inflation, as this report just suggested?
Yeah. So, and what we know is that wage pressures, again, remaining firm in real terms, but it's coming in the context of inflationary pressure that's now slowing down. I mean, this 2/10 that we got. I get it. Firmer than expectations, but that still doesn't change the trend. The trend of inflation is actually moving slower. So that means that the pass-through is becoming much more difficult for companies.
Well, but we're seeing this, we saw this with American Airlines and Spirit earlier this morning. So the pass-through is getting more difficult.
And sorry, no, I was just going to say, Lisa, I think it's such an important idea. Not only do you have that idea, this dynamic where the pass-through is becoming much more complicated, but just look at what some of the retailers have been talking about. I mean, the consumer is now trading down. Right? I mean, just in the context of these wage pressure, these inflationary pressures that are out there, I think it's such an important idea.
The problem with it is, and this is what I'm struggling with, and I think a lot of other people are as well, we were saying this 6 months ago. We were saying that consumers were going to push back and that savings were going to be beaten down. And suddenly, we were going to see, a recession. It didn't happen. And the data just keeps surprising to the upside with this yet another surprise to the upside in core. How can you explain that?
Yeah, so I think there's a really easy way to explain it. So, in fact, there's a couple of ways to explain it. So one, the idea of excess saving is real, right? I mean, and the consumer is still working that down. So let's just be clear. The consumer has had a massive pool with which to sort of dive into. Excess savings was one of those ideas. The other was credit. I mean, credit usage has been, sort of off the charts. I mean, you're looking at revolving debt that's now running at $1 trillion. And so the consumer has been able to sort of perpetuate the sort of the consumer backdrop as a result of these two ideas. But just to be clear, that now is sort of drying up a little bit, right? Excess saving continues to fade. It's not gone. It continues to fade. Banks are now actually getting pretty stingy as it relates to how much credit they're willing to sort of lend out. And we can see that in, obviously, banks' willingness to make these kind of loans. And so I think this backdrop is drying up, right? The ammunition is drying up for the consumer to some extent.
What I think is so important here is, and with Robert Tipp coming on in the next hour with John, you've got to turn to a bunch of bond animals with the ambiguities between your economics and their portfolio management. Can you assume a disinflationary tendency means price up, yield down in bond portfolios? Is that just a given?
Yeah, so I think this is a really important idea. One of the things that we've been talking about at PGIM is this idea that rates can stay high, rates can stay pretty elevated. And I think that you can have rates remain pretty elevated. I mean, when I think about sort of the Fed's reaction function to all of this, and again, I get it. On CPI day, we're talking about inflation. But the thing that I keep on coming back to, and I'm trying to bring it back to this today, here now, is the labor backdrop. Because I think when push comes to shove, I think the Fed's going to be very responsive to the labor backdrop. So I can easily make the case for the Fed to engage in an easing cycle. Now, I think when people say easing cycle, I think they immediately think of, hey, this big aggressive easing cycle. It's not going to be that. I think it's a dynamic where the Fed cuts back.
Their easiest path within asymmetry is to go longer. To stay elevated and go longer. I agree.
100%. And so to me, that's sort of the big challenge here for the Fed. I think it doesn't have to be a big aggressive easing cycle. It's not going to be a big aggressive slowing in economic activity.
Come in 25 or 50 beeps and just sit on it through 24.
I think that's exactly right. So our call has been, you can easily see a dynamic where the Fed cuts, call it 50 to 75 basis points over the coming year. And I think that's how you sort of get to this dynamic where rates still remain pretty elevated.
Which is the reason why I wonder if Goldilocks and soft landing is the best case scenario for risk assets, or if it's actually the worst case scenario for risk assets over the longer term, particularly corporate credit, when you face off with this idea of refinancing. What's your view? Is that potentially problematic?
So it can be, right? I mean, I think the rollover risk idea will become a challenge, but that's not a challenge for necessarily right now, right? I mean, a lot of companies have done a great job of terming out their debt. One of the things that we've been talking about at PGIM and Dilip, my boss, I think he's been absolutely fantastic about highlighting this really important structural idea that's out there. I mean, which is something I've been talking about since my prior life. I think that the pieces are in place for productivity to really kill it. I think that's going to take time to develop.
Right.
And I think that, Lisa, is basically that's another really important idea to insert into your question.
We got to go. When you go across the Hudson River, does Peters let you use the Hinckley picnic boat he's got? Are you using the little Hinckley thing that takes you over to PG?
I'm just happy to be around him.
Okay. Tom Porcelli, thank you so much. Say Robert Tipp as well. He'll be here later. Mr. Porcelli is with PGIM. Fixed income markets, I'm going to call it flat. Standard & Poor's 500 down 0.1%.
Right now, I'm actually looking up Hinckley because I have no idea what that is. I've got to be honest. What is that?
Hinckley picnic boat is
amazing
what Porcelli goes large on it. It's got side turbo thrusters, so you can just ease into the dock and Nantucket.
Okay, good to know. This is I'm looking this up. This is probably gives you a pro
when
tip.
you get done with the Grand Banks, you get the Hinckley picnic boat.
So if anyone is tuning in and trying to figure out what time is making up and what is not, or what he's projecting onto me,
Peters is gorgeous. He got the light blue,
all of these,
the eggshell blue.
Boats, maybe you're projecting. Honestly, I'm just trying to put this all together and to understand the upside surprise in core, which was exactly what people didn't want. They thought we'd see an upside surprise in headline.
Burger. You know, we got to.
I disagree, because it might be nothing burger right now, but put together with that 3-month rolling trend, just gives you this feeling that people are overestimating the downside surprises. Maybe this is what I'm taking away from it.
I'm with Porcelli on this. I think the jobs day all of a sudden became more important here. Get out the calendar. We're, first week of October, we'll be to it. Stay with us with futures at -10 on radio, on television. This is Bloomberg.
We think it's going to be a mild recession because in many ways we've already had some rotating recessions to come into this. So I don't think it's going to be as broad-based, but I do think that the consumer, being the biggest part of the economy, is going to have a digestion period. And that's what's going to lead to this mild recession. When I mean mild, I think it's going to last 6 months.
This is Larry Adam earlier this morning, Chief Investment Officer at Raymond James, talking about what a soft landing means, because we always are looking for definitions as people cling onto these words that have very different meanings depending on who we're talking about. We've seen the moves fade, Tom. It was a pretty significant move in some of the Treasury yields, in particular in the dollar, and it's kind of just sort of shrugged off as people take a look and say it's a month.
I'm going to go all David Rosenberg on you. Rosenberg used to write at Merrill Lynch with Mr. Farrell, and about page 3 or 4 of his report, which was read street-wide, this is before the internet, Lisa, where theft was in order, and on the right side, he would list all the components of inflation. And the phrase I use is Rosenberg slices and dices like no one. It takes time to go through the 85, 90, whatever it is, slices and dices. So we're going to have a different view of this inflation report. Not here. Do we do a count-up clock? Once we do countdown, do we count up afterwards? We're 17 minutes afterwards, and Rosenberg's, he's got a Labatt's poured, and he's like trying to get through it by 12 noon.
Well, the data now continues, but in more granular form. And you say, what goes up? How do companies deal with this? We did see airline tickets actually tick up in this latest report. As we hear about some of the margin compression at a number of them, I want to take a look just quickly at American Airlines and Spirit, which came out earlier today revising downward their earnings outlooks. We saw EPS downgrades at American. We saw revenue downgrades at Spirit. Those shares down both 3.6, 3.7%. They've come off some of the lows. But to me, this really highlights this question: what do companies do? As we were just hearing from Tom Porcelli, what do companies do when their input costs are going up and their prices are not necessarily being received well by consumers.
I get criticized. It's been a theme for me for 18 months. Corporations are going to adjust. They're adjusting in rapid speed now. And what the airline thing today signals to me is just the continuum away from the pandemic. It's like we're in some new phase after we all traveled like idiots. You know, I mean, we're all the same on this. We all took the 7 flights we didn't want to take. And all of a sudden now it's now what for the airlines. I'm fascinated by what they say. I know we're speaking with Hurley from JetBlue here coming up on Bloomberg. She is grizzled financially about what do you do in the room when you face $93 Brent.
It's a larger story, though, also because it's not just energy prices. We heard this from American. It's also labor. It is a pushback there. And these two polls are really creating a confusing toxic stew, which creates the situation of we don't know how companies are going to respond. Are they going to hoard labor, or are they going to take the Tom Porcelli route and start laying off some workers?
Well, the ambiguity of it's interesting, and it leads to the jobs report. And as a number of you said, emailing into me, the retail sales report tomorrow. Joining us now with wonderful perspective is Rob Waldner, Chief Fixed Income Strategist, Head of Macro Research, owner of the High Ground at Invesco. I was thrilled that he could join us today. Rob, ambiguity in microeconomics is you really don't know which way the curve is going to go. In fixed income, I got lots of ambiguities, mysteries, uncertainties right now. What's the lead ambiguity for you and Invesco?
Well, I think if we're trying to look at the ambiguities, let's look at where the market action today. So, I mean, I think, we saw that CPI was slightly disappointing from a fixed income perspective, i.e. core came in a little bit higher month on month than we were expecting. It keeps the disinflationary trend in place, but nonetheless, it was a disappointing number. And I think, as you pointed out earlier, you can't really tell in the market. The market's behaving very well. So I think that tells you that the market is not fully bought into this disinflationary trend idea, and tells you that the market is more worried about inflation than maybe it needs to be.
In a given bond portfolio, and there's 472 of them at Invesco, of flavors, I should say, of portfolios, the basic idea is you have to adjust. How do you adjust a bond portfolio now? Is it a duration dynamic? Is it a portfolio structure dynamic? What's the variable of action into the fourth quarter of this year?
Well, Tom, as bond managers, we really have two components to yield in our portfolios. One is the overall level of yields represented by the Treasury market, or real yields in the Treasury market, and the other is credit spread. And I think when we look at the balance now, going into the fourth quarter and going into 2024, we've been of the view that we would have a bumpy landing, but with a growing risk of a potentially slowdown in 2024, further slowdown. And so in that environment where we've seen real yields come higher, so the real yield component is higher, and the spread component has shrunk over the balance of this year, I think that favors putting more of your resources towards real yield. And we know that the market itself has been putting money into money market funds instead of into duration. We have, close to $1 trillion of money has flown into money market funds this year. So that tells us that the market is not valuing duration and real yield as much as it should be. And so we would be reallocating towards that sort of longer duration real yield into more traditional bond portfolios, and using that as the core building block of our portfolio structure.
Let's build on that, Rob, because you said that what we have seen today in terms of the market response to today's report was that the market hasn't bought into this disinflationary idea, has not bought into this disinflationary idea, and that they're maybe more worried about inflation than they ought to be. How much are you loading the boat right now? Are you basically just going out and buying every 10-year Treasury note that you could possibly find, saying this is the time to lock it in because it's not going to last?
Well, we do think we're at the top of close to the top of the near-term range, Lisa. So, I mean, load the boat. I'm not sure we're getting overweight from a bond perspective in high-quality credit, and we think this is a good buying opportunity.
When you say high-quality credit, I'm wondering how much we're also talking about corporate credit. At what point, when we talk about margin compression and this question of what do companies do with the fact that their costs are up and they cannot raise their prices commensurately, how much does that weaken corporate credit as opposed to improve it at a time when the revenues were increasing and they didn't have to refinance yet?
Well, so the fundamentals, I think you're driving here at the fundamentals behind the corporate sector. There's no doubt that I would put it slightly differently as you did, but I think I'm saying the same thing. No doubt that very high nominal GDP growth that we've had over the last couple of years has been very, very supportive for the corporate sector.
Right.
And as that nominal GDP comes down, so nominal GDP growth now, in our estimation, is running somewhere trending around 4 to 5%. So we're now down below the level of interest rates. That is going to put pressure on the economy overall, and including the corporate sector. So fundamentals will be less positive going forward, but the offsetting benefit will be if you're in longer duration bonds, that you will get some benefit from that duration.
Rob, I did a wonderful panel last week with Christina Campany. We all didn't like her. She stole the show, which was unfortunate. But your Christina Campany made real clear, as you stated, that with a reduced nominal GDP, a reduced animal spirit, things change. What will CFOs of corporate America do?
As that the problem is people will get squeezed. CFOs will get squeezed if they don't have that pricing power that Lisa was alluding to, which is the same thing as saying nominal GDP comes down. I think CFOs are in a pretty good place in that they've, as far as we can tell, in terms of financing, there's not a lot of near-term financing needs. So it'll be more of I think, Tom, it'll be more of a sort of longer term, as things reset higher, squeeze rather than an immediate impact. But it is going to be more difficult to manage through an environment where your top line is not growing as fast as your funding costs are going up.
Rob Mulder, thank you so much. With Invesco. Lisa, this is so important, and I'm going to go back to a huge mentor and someone of great influence on me, Philip Correa, who we enjoyed living to 104. He was brilliant. He was inquisitive. He founded Pioneer Funds up in Boston. And Mr. Correa would say to me, the young whippersnapper on the elevator, he would say, Tom, don't forget the bright lights of inflation. And under the bright lights of inflation, it's easier for CFOs. Inflation helps people feel in the real time that things are great. It's getting a little dimmer out there right now, is how I'd put it.
It's a transition moment. And what we're transitioning to is the really big question that we just don't understand. But it's getting harder for the CFO to understand exactly how to navigate.
What timing? Matthew Miller in conversation with the CFO, the financial X at JetBlue, Ursula Hurley, perfectly timed given the challenges of the airline business. That tonight.
With Barclays, every change leads to a bold possibility. You have the vision, we have the insights, financial solutions, and global perspectives to help you make it real. Barclays Corporate and Investment Bank, powering possible.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. Equity futures pulling back just a little bit on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, UAW hitting Detroit's Big Three with strikes. Automakers conveying their extreme disappointment as we wait to hear from a pro-union president. We begin with the big issue, strikes in America.
We have greater strikes.
News that we're seeing about, the strikes.
The auto workers' strikes.
The UAW.
The UPS.
The strikes around riders in Hollywood.
Power is still in the hand of the worker.
Labor does have some more power now than it used to.
It's still a very tight labor market.
The labor markets have been tight for
2 years or so.
This could, again, be a weight on the economy and on the labor market.
You're going to have ongoing pressure with wages and inflation.
The risk that we do get that stickiness still in wage growth and inflation.
I'm not necessarily convinced that this is kind of the dying embers of a hot labor market.
Has the labor versus capital pendulum swung for real?
We are starting to reach an inflection point that should put the labor market into a little bit more of a balanced state.
Team coverage starts right now with Bloomberg's Anne-Marie in D.C. alongside Keith Norden in Detroit. Keith, talk to me about how far apart are Detroit's big three and this union.
They are very far apart. On the wage offers, the union has brought theirs down to a request for a 36% wage increase, and GM and Ford are offering a 20% wage increase. So there's a wide gulf.
AMH, the President of the United States, set to address the country later on today. Any idea when and what he's going to say?
We don't have a time yet, Jonathan. That's yet to be determined from the White House. But what we do know is that a month ago, the president put out a statement. He talked about that he wants to see a just transition to a greener economy. What you see this Friday morning is two of the president's key policy goals at loggerheads. One is a move towards electric vehicles. The other is to maintain that he is the most, what he likes to call himself, self-described, most pro-labor union president in history. What you see from a lot from President Biden is that in front of the cameras, he's going to want to have that rhetoric to make sure that he is fighting for labor unions. At the same time, behind the scenes, what you likely are going to be hearing about and leaking from the White House is that they've been on the phones with everyone, the labor union and the companies, to make sure they could try to find an agreement. Jared Bernstein said this week they are encouraging both of these parties to remain at the negotiating table.
Keith, let's talk about strategy. 12,700 workers across 3 plants. They're not going after the Ford F-150s of this world. Talk to me about the strategy and what's left in their back pocket if they want to escalate things.
Well, they certainly have gone after key plants. You're right, they haven't gone after the big pickup truck plants that are the most profitable. But these 3 plants make hot-selling products. The Ford plant makes the Bronco SUV, the Stellantis plant makes the Jeep Wrangler, and the General Motors plant makes the Chevy Colorado, mid-sized pickup truck, all hot sellers, all profitable. But yes, they've left the door open to ratchet the pressure up even more by going after the big pickup trucks that make the most money for the companies.
Keith, any idea of what kind of number gets this deal done?
You know, there is such a wide, divide between the ask and the offer from the companies. So it's clearly something north of 20%, but the companies say they can only afford so much. They're spending collectively more than $100 billion on their new EV programs. So they say they can't spend 36% or it will bankrupt them.
AMH, just finally, would you expect to see more Democrats on the picket line with these strikers?
Well, Jonathan, I think how Democrats would like to describe themselves if they are pro-union is that they want to be the voice of working people within the government. This is what Seth Harris said to us last night. He was Biden's former aide when it comes to labor unions and helped him coin that term that we continuously hear from the president. But likely you will see some congressmen and women from Michigan that are going to come out and talk on behalf of the UAW. At the same time, Jonathan, you have to remember, elected officials are dealing with constituents that are very concerned about higher inflation. What Anderson Economics says is that this could be a $5.6 billion drop in the bucket of lost profit if it's a 10-day strike. This could mean the difference of Michigan having a soft landing or a recession. This is a key state that Democrats need to keep control of next November.
AMH, great to catch up, as always. Anne-Marie from Washington, Keith Norden over in Detroit. Detroit shaken by strikes on all 3 automakers, GM, Ford, Stellantis. With us around the table here in New York, I'm pleased to say, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, good morning to you.
Good morning, John.
Question that has dominated this program now for weeks, and I'm going to repeat myself once again. Is this the dying embers of a hot labour market, or do you think this is here to stay?
I think this strike is here to stay for a while. Ask yourself 2 questions, a macro question and a micro question. A macro, why did it take so long? When you have a combination of a very tight labor market on the one hand and workers being hit by an unanticipated bout of inflation, you normally get catch-up wage negotiations. But it took much longer here than it took in the UK, for example. So why did it take so long? And then from a micro perspective, if you're a UAW worker, if not now, when? This is your key point of bargaining power. Your bargaining power is going to erode over time. So if you're going to strike, now is the time to strike.
Doesn't this just accelerate the move away from Labour in places like Detroit? Is this the last big contract negotiation the likes of UAW are going to have?
So I would put it the other way. It stops the shift from Labour to capital, and it provides some opportunity for the shift to come back a little bit. We've had a massive move from Labour to capital over the last few decades. And now we're seeing not that stop, and there is a possibility, and I would say there's a desirability in seeing it come back a little bit towards Labour.
And a big shift towards Labour, potentially, given some of the demands. Any idea of what kind of numbers gets this done? It started at 40, they dropped to 36. Clearly nothing in the low double digits gets it done. What gets it done?
I don't have a feel for it, but it's not just that number. It's also other working conditions. This is an opportunity for the AAW. The big question for all of us, looking at the economy, looking at the markets, will it have demonstration effects? Will it be a catalyst for many more strikes in the US, like we've seen happen in the UK?
Union membership is low in America, so if there is spillover to unions, maybe it could be limited. I'm thinking about the signalling beyond unions. When I see headlines like UBS, when I see headlines like American Airlines, when I see headlines like this, whatever the deal is going to be, it's certainly going to be north of 10% based on what we're hearing. Don't I just go into negotiations at the end of the year, sit down with management and say, you know what, I want some of that?
Yeah, you do. The real question is, do you say, I want some of that, meaning I want to regain some of the wages I lost due to this unanticipated inflation? Or do you also say, I'm anticipating future inflation and I want something more than that? So far, I think it's limited to the first, but if that second one happens, alarm bells would be ringing at the Fed.
Big question for the Fed. Do companies eat this through margins or pass it on?
Depends what happened to the economy. So far, companies have been able to pass it on. The big mistake the Fed made in 2022 is not realizing that companies will quickly pass on what they thought were once and for all and reversible increases in costs. So we're going to see this again. And it's not just labor, it is also energy. So this is another bout. For those of us who lived through the 70s, we remember that there were 2 oil shocks. 2, not 1. So think of this as being potentially a second, much smaller shock. And it will be interesting to see how it proceeds.
Labour market power on the table, crude in the 90s. If you're at the Federal Reserve next week, what are you thinking about all of this?
So they'll pause. I don't think at this point they can hike, but they'll keep wide open the possibility of another hike, and they're going to push back against this notion that they'll be cutting anytime soon. The message will be, we're going a little bit higher, and we're going to stay there for longer.
Should they worry about $90 crude? If it's just a supply shock, should they worry about that?
They should. Otherwise they're going to repeat the same mistakes they made in 2022.
Which was?
Which was to think that this is isolated, to not realize that there are spillover effects. The big hope, the linear disinflation argument, was goods were disinflating, and in some cases prices were falling, energy. Services were inflating, but if you wait long enough, services will start to disinflate as well. And the fear was that goods would start inflating. Now we're seeing goods are going to start to inflate. And that's, I suspect, will keep people up in Washington, D.C.
I was trying to tee you up to use the word, transitory, the T word. That's the question people are asking now. Is this disinflationary trend of the last few months transitory?
No. Transitory isn't a time concept. It is whether it changes behaviors. Something is transitory if you believe it is temporary, it's reversible, therefore you should look through it. It doesn't change your behavior. When these sorts of news start changing people's behavior, then it's not transitory.
Mohammed, you're going to stick with us more on the Federal Reserve and much more on this energy market move as well. Equities pulling back by about 0.2% on the S&P 500 this morning with some movers. Here's Abby.
John, let's take a look at two of the big automakers that are reacting to some degree to this unprecedented strike, by the UAW. We have Ford down 1.8%. GM is also down, not shown, but Stellantis is up 0.5%. So it's interesting to see that the surgical and uncertainty that they're creating by the strategy that they're going after is creating these mixed moves for stocks. Stellantis on the year up more than 30%. Ford is up just about 5% on the year. Adobe down 3.6% this morning. They beat estimates, but their guidance is a little bit light. That stock on the year, John, up more than 60%. Investors wanted perfection from the software maker. They didn't get it. The stock is down.
Abby, thank you. Coming up on this program, energy taking the blame.
Whether it's grain, whether it's oil, whether it's gas, we're looking at all those components very, very carefully because some of them are volatile, some of them are on the way up, and they will have consequences on prices.
That conversation up next.
Opportunity. People.
Things get done.
Before, I never did business in Georgia. I was amazed what kind of opportunities. There are many of them here.
Very little bureaucracy, simplicity of doing business.
You have access to markets, finance, and authorities.
It's perfectly located logistically. We have the biggest suppliers nearby.
EBRD has invested 4.6 billion euros in 270 projects, and I think that speaks for itself.
Georgia.
A pleasure
doing business.
Whether it's grain, whether it's oil, whether it's gas, we're looking at all those components very, very carefully. Some of them are on the way up, and they will have consequences on prices. We had a good scenario analysis produced by staff about China and the role that China growth or deceleration of growth would have on our own GDP and our inflation. That, combined with the price of oil, is obviously something that we need to be attentive to.
ECB President Christine Lagarde highlighting the energy sector, which is quickly becoming the culprit for absolutely everything this week. US retail sales and producer prices coming in hotter than expected, fueled by higher gasoline prices. Auto workers going on strike, the union nervous about President Biden's robust EV transition, eliminating jobs, and a number of US airlines slashing their outlook, all placing the blame on rising fuel costs. All of this no surprise to Jim Bianco, who wrote a few weeks ago, quote, crude oil and gasoline prices are about to take center stage. They take center stage right now. Jim Bianco joined us from Bianco Research alongside Mohammed Al-Arian here in New York. Jim, you said it. Here we are, $94 crude. What does it change?
I think it changes a lot because while we look at the reduction in supply and we look at the voluntary cuts of OPEC to blame that for the higher prices, let's look over at the demand side. And demand is booming. And demand is booming in oil, and we've got at the same time very weak growth in China. So we're seeing probably a transition from transit commuting to auto commuting, and it's also maybe an underlying sign that there's going to be no soft landing or hard landing in the economy, maybe a no landing because of this continued strength. As long as we have this cocktail of strong growth or strong demand and we have voluntary cutbacks, I think the price of oil is going to keep going up. The price of gasoline is going to keep going up. And the final thing is, I think we're ways away from demand destruction. We're at $3.87 a gallon nationally in the U.S. I don't think it's $4 that's going to start demand destruction. I think it's much, much higher, and that will first foster into much higher inflation before we start talking about demand destruction.
Hey, Jim, this is really important. This goes back to one of my favorite questions at the moment. Do you view this, then, as a reflection of the extension of the cycle and not a recipe to end it?
Yes, I do view it as an extension of the cycle. I've always been of the opinion that we're in a post-pandemic economy. Big fancy word for meaning that shutdown restart of the economy in 2020 was the most important economic event of our lifetime. When we rebooted the economy, it did not come back the same. That doesn't mean dystopian or worse. It means different. And we've got this chronic shortage glut cycle as we try to figure out what this post-pandemic economy means. And this is more of the same, whether it's the China slowdown, it's the gasoline, or it's even the strike with the UAW and the Hollywood strike and nearly the strike with the freight trains in the West Coast ports, and all of a sudden the movement in labor that we've seen, it's all part of that same mosaic that the economy has fundamentally changed since 2020. Not worse, changed, and we still haven't quite figured out what that is.
Jim, you put forward two hypotheses. One is that oil and gas prices are going higher, and two is that demand destruction will take time, which raises a very important question. What's your feeling about the pass-through? How much of this is going to spill over into a wider price impact?
I think it's going to spill over into a wider impact. I think that the attitudes have changed. I wouldn't quite go as far to say that, inflation expectations are unanchored, but let's say they're loosening as we move forward. I'll remind us back in 2021, when Procter & Gamble raised prices, they announced it in March. They said it would take place in September, and they said that in the interim, they'd write a white paper to explain why they were raising prices. That's how epic it was to raise prices 2 years ago. Today, we just raised prices. And so we've loosened the anchor a little bit. And I think if oil prices keep coming up with that loosening anchor, we're going to see this getting passed through, not just at the pump, but in transportation costs, delivery costs, input costs. It's going to be problematic, I think, up and down the line.
So if you are sitting at the Federal Reserve and you agree with your three hypotheses, oil going higher, no demand destruction, and it will be passed on, what would you do?
Well, I've been a bit more hawkish than the consensus. I think that they're going to raise rates in November, and I don't think that that's going to be the last rate hike. Now, the next one might not come until 24, but even if there isn't another rate hike, I think the idea that there will be multiple rate cuts in 2024 is premature. The only reason the Fed would cut rates in 24, I think, is if we saw a recession, a full-blown out hard landing recession, and they responded to it. Short of that, I'm in the higher for longer camp, and I'm not even sure that one more rate hike is really done, and that's the way I'd be looking at it.
So, Jim, you've got to make a bond market call off the back of that analysis. We've got a 10-year in the 430s, a 30-year around 440, a 2-year still in and around 5% right now, up 2 basis points on the day. What's the bond market call?
I think the yields are going to continue to head higher. I don't think that the cycle is over. Well, let me back up and say that yields bottomed in August of 2020. I think that ended the 40-year bull market in bonds. We're in a multi-year bear market in bonds. We're in year 4. August of 23 started year 4 of it. We're only 3 basis points or 4 basis points in the 10-year from another 16-year high. And I think that those rates were going to continue higher. Now, there will be fits and starts. There will be rallies. There was a huge rally in the bond market off of the Silicon Valley Bank failures in March. But then we turned around and completely reversed that by the end of the summer. And so I do think that irregularly rates are going to go higher. I think irregularly that the yield curve is going to at least stay at its current space or maybe even flatten or get more inverted, because ultimately I don't think the Fed is done with one more rate hike. So I'd have a very defensive position in the bond market right now regarding rates.
Jim, if that's the call and if you're right, where's the rest of the world? Where's Europe? Where's China?
Well, I think that there's a little bit of a split between China and the rest of the world. If I'm right, and the problem is that we've got sticky inflation and a post-pandemic economy, that's global, and that's going to impact everybody else. And we're seeing that whether you're talking about Japan or Europe, higher inflation across the board everywhere. We're seeing higher rates across the board everywhere, and I think we're going to continue to see those rates moving higher. China's a little different story. They're on a different cycle. They're decelerating. They're going down in terms of their economy, and I might add, it's really surprising that after they opened from zero COVID at the beginning of the year, their economy just kind of was a dull thud on the floor in terms of its pickup. So that might be something different. And because they're in a different cycle, I don't think that the spillover effects from China, there will be some, won't be nearly as great as people fear. So I think globally we're going to continue to see higher rates as well in an irregular pattern, but they're going to keep going up.
Hey, Jim, fascinating call. Jim Bianco there of Bianco Research. The last 24 hours has been so busy. China cut the reserve requirement ratio and we barely talked about it. Mohammed, quite a call there from Jim. The idea that this is going to stay, that the data is going to continue to surprise into to the upside. We had industrial production out just moments ago. That came in hotter than expected at 0.4%, the estimate 0.1%. Do you get the sense that this economy still is more resilient than people are giving it credit for?
I do. I think the U.S. exceptionalism when it comes to economic activity has been remarkable, and it's going to stay for a while. There is a lot going on that is good in this economy. Now, we could hit a pothole. There's no doubt about that. Jim pointed to one possibility, which comes from the energy prices. Another possibility is a government shutdown. A third possibility is the Fed making a policy mistake. But left to its own devices, this economy still has momentum.
Jim's not alone. Others are out there saying the same thing. Bill Dudley, the former president of the New York Fed, a guy who you know well. Remember that conference we did together back in the summer of 2021, and you were both saying this inflation story is real. He was talking up 5% interest rates at the Federal Reserve. He's now asking the question as to whether we've already seen all of the lags from policy. They're done. They hit the economy, moving on and accelerating again. Where are you on that?
So there are so many uncertainties about monetary policy right now. You know, Chair Powell said at the end of his Jackson Hole speech something along the lines of, we are looking at the stars, we are guided by the stars in a cloudy sky. I think that was the phrase. Well, if you look at the stars, they're all moving. No one knows where our star is. No one actually knows what the right inflation target is, and no one knows what the right monetary policy framework is. And then if you look at the clouds, there's massive disagreement on, have we seen the last of the lagged effects, or they're still to come? There's massive disagreement on what will QT do on top of all this, and people disagree on whether it's the level or the change in rate that is in the driving seat right now. So there are so many uncertainties. I listened to Bill Dudley really carefully.
Yep.
The major pushback against Jim's view and Bill's view are those who believe in technicals. Those that believe that there's a ton of money waiting at the short end of the curve and looking to extend once we get to 435, 440 on the 10.
Mohammed, stick with us. Coming up, the morning calls, and later, Cboe's Mandy Zhu joined us at the opening bow as stocks look to rebound from last week's declines. From New York, this is Bloomberg. Equities a touch negative. Let's get you some morning calls. First up, Piper Sandler upgrading Key Corp to overweight, highlighting the stock's compelling valuation and easing funding concerns. Your second call comes from Moffett-Nathanson, downgrading DoorDash to market perform, expecting the resumption of student loan repayments to weigh on future bookings. And your third and final call from Redburn, upgrading Estee Lauder to neutral, seeing limited downside and strengthening fundamentals. Up next, Cboe's Mandy Zhu joined us at the opening bell and why the fear gauge is trading near 2020 lows. The opening bell up next. "24 seconds away from the opening bound this morning. Good morning to you all. Heading towards a week of gains on the S&P, pulling back just a touch on futures, down about 0.4% on the Nasdaq. A similar move. The big story in Detroit, a strike on all three: GM, Stellantis, Ford. Those three names doing okay in the pre-market. We'll talk about how they perform coming out the other side. There's your opening bound. Switch at the board and get to the bond market. Yields look like this on a 10-year, higher by a couple of basis points at 430.65. In foreign exchange, the dollar stronger, potentially for a 9th consecutive week against the euro, a record weekly run. This morning, the euro just a touch stronger by 0.2% at 106.65. And crude had a little look at 90, then pulled back. WTI, 89.35 and negative 0.9%. About 25 seconds into the session, we're down a third of 1% on the S&P. On the Nasdaq, we're down a third of 1% also. One sector to watch at the open: the automakers, GM and Ford, under pressure as the United Auto Workers start striking at select locations. UAW President Shawn Fain saying this strategy will keep the companies guessing, and if we need to go all out, we will. Abby has more. Hey, Abby.
Hey, John. It does seem that confusion and uncertainty are one of the biggest goals of the UAW in terms of this strike strategy. Some experts saying that it is probably one of the least painful ways that they could stage a strike against the big three automakers, although, of course, it is unprecedented in the fact that they are striking against all three at the same time. Now, on Friday, today, at midnight, workers walked out of the three plants, one from each of the big three companies in Missouri, Michigan, and Ohio. It's being called a stand-up strike, and this is the strategy of the UAW, that they can call up other members of the UAW to stand up at every time and create logistical, surgical, tactical problems for these automakers. Right now, it's less than 10% of the UAW's 145,000 members that have walked out. And again, to create the uncertainty for the big three. But for the stocks, John, there's not so much uncertainty. I would argue GM down 0.6% and Ford down 1.4%. It could be much worse if investors were really nervous. Now, that said, each of these stocks, including Stellantis, down between 10 to 20% from the July peak. So some of this is priced in. We've been talking about this for a while. And although the gap between the UAW and the automakers for a pay raise is wide, 20% to 36%, some are saying the fact that the UAW hasn't gone for the jugular, it may mean that there could be some sort of a deal in the works.
Abby, thank you. Let's see if we can close that deal sooner rather than later. Tesla might be loving what we're hearing. Dan Ives of Wedbush expecting one automaker in particular to benefit from the work stoppage, writing this: the clear winner in this Game of Thrones battle between the UAW versus the big three is Musk and Tesla, with Champagne now on ice, which sits in a non-union position, and its biggest potential EV competitors now face mounting costs and complexities in the years ahead, depending on how this ultimately plays out. Tesla this morning positive through much of the day. Turning to the media space, Disney is said to have had initial talks to sell its ABC network and other stations, the company writing in a statement: while we're open to considering a variety of strategic options at this time, we have made no decision with respect to ABC or any other property. Simone Foxman has this one. Hey, Simone.
Yeah, it's not just Nexstar, also potentially Byron Allen, who Bloomberg has reported, and we've been all over this story, has offered $10 billion for ABC TV network, local stations, as well as FX and National Geographic. While the company might not have made any decisions, though, analysts are already trying to pick through exactly what this would mean, both for Disney and its potential acquirers. And the commentary pretty mixed. Bloomberg Intelligence estimating that selling ABC and the local networks could potentially bring Disney $4 billion. Rosenblatt Securities believes this could be great for breakup value argument for Disney's equity, but it would be risky for Nexstar, whose shares rallied yesterday. KeyBank, however, saying that selling ABC would be negative for Disney because it would likely be done on a highly dilutive basis. And the interest in selling implies that Disney soon thinks pay TV will implode. The assets on the block, the idea, not completely surprising. This is something that CEO Bob Iger had hinted about back in July. But with Disney looking closing at its lowest since 2014 on September 7th, we're seeing some positivity in the shares today as everyone reacts to this news, John.
Simone, thank you. Let's turn to the semis just briefly. ARM seeing a successful day, first day of trading, jumping nearly 25% in that debut. Needham initiating coverage on shares with a neutral rating and writing this: ARM can grow by capturing greater value from smartphones, but not enough support upside from the stock's IPO valuation. Shanali Basak following this one. Hey, Shanali.
John, you might have heard about it. It's the AI frenzy, and you have ARM feeling the heat of it. Remember, when you look at Thursday, retail orders into Fidelity surpassed 20,000 orders for ARM. So you do have retail investors and institutions alike pouring into the stock. And today, when you look at it, have a second day of trading higher, you could say something today that you couldn't say yesterday, which is that ARM is finally valued above where SoftBank repurchased its stake for just a couple of weeks ago. That was at $64 billion. Now it's closer to $70 billion. But now its valuation alone is on the list, of the risks that ARM faces ahead. That includes its nearly fourth of its sales tied to China and the risks tied to geopolitical risks in the chip wars, as well as declining smartphone sales, as well as profit alone, even at ARM facing pressures in the most recent fiscal year. Those are the list of risks that these investors face ahead. But today, yesterday, and into next week, as we face a whole horde of IPOs ahead of us, this so far is not an issue.
Shanali, thank you. The stock up again by 3.8%. Turning to Adobe, the software company delivered a mild sales forecast despite the optimism in AI. The CEO saying this: we are unleashing a new era of AI-enhanced creativity around the world with innovations across our product portfolio. Isabel Lee on top of this one. Hey, Isabel.
Hey, John. So just like a lot of other companies, Adobe has been getting a lot of mileage out of AI, but over-optimistic investors are just wanting for more, which is why even if sales forecasts meet expectations, we see shares slumping to around 5%. So here are some numbers. Sales will be 4.98 to 5.03 billion in the period ending November. Analysts were expecting around 5 billion on average. Profit excluding some items will be as much as $4.15. So that's 9 cents higher than estimates. So Adobe is adding generative AI to a lot of its products, and they will be increasing those products beginning November. And analysts expect this new increase to lift revenue quickly. We have William Blair expecting that it will add around 600 million over the next year, and Bloomberg Intelligence projects a 10% sales increase in the first year. But of course, there's a flip side for everything. Some express caution that the price increase would affect demand, John. But for now, Adobe has rallied some 60% year to date.
It's just down this morning by 4%. Isabel, thank you. Joining us now to discuss this market, Mandy Zhu of SIBO Global Markets alongside Mohammed Al-Arian. Mandy, let's get straight to it. The VIX, you know the complaints. Has it become totally irrelevant?
We don't think so. I mean, I think the decline in the VIX obviously has puzzled a lot of investors this year, but I would say it's really a reflection of the change in the macro environment, right? So when we started this year, the consensus among economists, among investors was very much, recession risk in the US. And now as we stand here, 9 months later, the consensus has turned into a soft landing. And that's why the decline in volatility has really been across asset classes. We're seeing it in FX, we're seeing it in rates, we're seeing it in commodities, in credit. It's really in line and in sync with the other asset classes, which suggests to me that it's very much macro-driven rather than anything equity-specific.
That's your observation. Let's get your judgment. Do you think those soft landing hopes and dreams are relevant? Do you share them?
Look, I mean, there's clearly still a lot of risks, going forward. And I think that's why starting to see a pickup in option volumes in VIX, particularly investors coming in to buy those VIX upside calls and call spreads. VIX option volumes are actually on pace to hit a record this year, which I think surprises a lot of people given, the market rally. And I've gotten a lot of questions around kind of why the interest in hedging now versus last year when the market was actually selling off. And I do think a big part of it is positioning, right? People have capitulated to this soft landing view. We're seeing leverage really start to build. Institutional investors really start to increase their allocation to equities, systematic strategies increasing their allocation as well. So as leverage builds, that's when you could potentially get, that convex move in volatility. And I think that is driving a lot of that interest in those VIX upside calls.
So, Mandy, we're looking at two worlds. One where things are relatively calm, you just described it, and it's reflected in the VIX. Another one, whether it's in rates or in FX, where people are seeing major relative price changes. John mentioned dollar stronger 9 weeks in a row. We've seen what has happened to U.S. rates relative to the rest of the world. Can we live in this two-world world, or at some point do we see convergence? And what does that convergence look like?
That's a great question. Can we live in this world? We've been living in this world for about 2 years now, where we've had elevated rates of volatility and relatively more subdued equity volatility. And what I would say is, that divergence is only a mispricing if you think the volatilities in each of these asset classes reflect the same risk. And I would argue they actually do not, right? Rates volatility is really a function of policy outlook uncertainty. And as we stand today, there's still a lot of uncertainty of whether ultimately terminal rates going to end up, right? Could we see rates, Fed taking rates above 5%, 6%? Yes, absolutely. Could they, be cutting rates if economic situation turns? Absolutely. But I think for equities and for a lot of risky assets, what really drives volatility in those asset classes is the risk of recession, and that has undeniably gone down over the past year as we have seen, labor market data hold up and inflation come down. So I think that's what is driving it. And then specifically with the VIX, I would just say, given that it's a 30-day measure of implied volatility in the S&P, it's much more catalyst-driven rather than a gauge for long-term recession risk.
I'm pleased you mentioned that number 30. I want to talk about this one, 0. Mandy, just briefly, 0 day to expiry options. We've had a long conversation about that over the last 12, 18 months. Mandy, there's a lot of volume there, an explosion in volume coming out of the pandemic. From your perspective, does high volume equal high risk?
No, it does not. And I think that's the source of the misunderstanding in this product, right? So yes, 50% of option volumes in S&P is going through these 0-day to expiry options. So people often quote the notional number, 500 billion a day trade in these 0 DTE products. But what matters at the end of the day is the net balance between buys versus sells. If everyone is chasing, one side of the trade, then potentially, yes, that could pose risk. But if the flow is evenly split between buys versus sells, then at the end of the day, the net risk to market makers hedging those positions is very minimal. And what we see, and again, at SIBO, we see all this flow, right? All these options trade on our exchange. And what we see is that the flow is remarkably close to 50-50. And at the end of the day, the net risk to market makers having to hedge those options, we're talking about, 0.1% of the S&P daily liquidity. So this is not a case of the tail wagging the dog at all.
Mandy, appreciate the update. Mandy Zhu there of SIBO. Mohammed, let's talk about this market more broadly. You remember the days when we had zero rates, we had QE forever, and people would come on programs like this one and say, we can't possibly go back to 5%. This is what the market is built on now. I take Europe as an example. I never thought we'd go to 4% over the ECB. I thought it was a potential in the pandemic that we'd never see a rate hike from this ECB for the next cycle, never mind the last one. And here we are. Do you think we can adjust and have adjusted to these high rates?
So far we've adjusted remarkably well. Remember, it's a trilemma. How do you reduce inflation without pushing the economy into recession and without causing excessive financial volatility? And so far, in the US, we have achieved all three. So far, so good. However, remember, especially if rates stay higher for longer, there are things that have to be refinanced in this economy that cannot be refinanced in an orderly fashion at these rates. So this is not something that happens instantaneously. It's something that happens over time. Now, in the UK, because the mortgage market has such short duration, it happens very quickly. Here, it happens more slowly. And that's why the long bit of higher for longer is really important. How long is long?
So the effective rate on mortgages right now in this country is 3.6%. Torsten's Lock of Apollo put out some work over the weekend, and I'm sure you're familiar with it. Ultimately, at origination, I think about 10% of the mortgage market's paying above 6%, so we're just not there yet. And to your point, because it's 30 years, it could take a long, long time. I'm thinking more specifically about high yield. Is there a spot on the calendar where corporations below a certain grade are going to come to market and they're going to have some problems?
Yes. I mean, if you look at high yield, if you look at commercial real estate, massive refinancing needs next year. Massive. So that's the point of pain that starts to happen. Now, some people will tell you there's lots of distressed credit funds with lots of money waiting to come in. And we're going to see a game of chicken between the two. That's what we're going to see.
Is that a story for next year or the year after?
I think it's a story for next year. And we've got to be really careful. That's why the minute the market starts pushing back rate cuts, and it hasn't really pushed it back, but the minute it starts pushing back rate cuts, the conversation gets a lot more interested in various segments.
And more data like the data we've had this week, and maybe we go in that direction. Mohammed, stick with us. Coming up, looking ahead to a Fed rate decision.
I think they'll be inclined to deliver a hawkish pause. If you look at the underlying trends, core inflation is moving in the direction they want. So I think what we'll see next week is a pause, but an indication that they're prepared to do more.
Chair Powell taking centre stage in a busy week for monetary policy. That conversation up next.
I think they'll be inclined to deliver a hawkish pause. They have gotten good news on inflation. Yesterday, a mixed report, but if you look at the underlying trends, core inflation is moving in the direction they want. So I think what we'll see next week is a pause, but an indication that they're prepared to do more. And I would expect them, I think it's finally balanced, but I would expect them probably to get one more hike in this cycle.
Former Fed Vice Chair Richard Clarida on the Fed's next move. The September FOMC meeting kicking off next Tuesday, leading a busy week ahead for policymakers with rate decisions coming from the Bank of England and the Bank of Japan. Mike McKee has more. Morning, Mike.
Morning, John. We're all traveling next week. I get to go to Washington. You get to go check on the Bank of England. Maybe we should meet in Tokyo when we're all done, because it is a big week with three central banks who have the same problem, inflation. And the Japanese have actually joined that party. Take a look at the inflation rates in all of these countries. You can see the Bank of England's problem. They have a very large inflation problem. The U.S. has made a lot of progress, but we just ticked up a bit. So does the Fed raise rates? The betting is they probably will. And the Japanese are now above zero and have been there long enough. And the odds are they're going to keep inflation high, according to the latest forecast. So they may start tightening policy a little bit as well, which leads us to what's going to happen in the markets. Well, the bet is nothing from the Fed, even though Rich Clarida was suggesting a hawkish pause. Nobody thinks they're actually going to hawk out and raise rates. About a 3.8% chance, as you can see. There is a bet, a strong bet on the Bank of England moving, and now there's a bet on the Bank of Japan. We haven't had that in a very long time. What do all three of these have in common? The U.S. dollar. The dollar has been strengthening because the Fed keeps raising interest rates, and because the U.S. is the biggest economy in the world, it's affecting everybody else. You can see the impact on the pound, and you can see the impact on the yen. I reversed the yen so you could get an impression of what it's actually doing. It's getting weaker. And that's a question for the Fed. Do they care? They care. They don't want to hurt other people, but their job is the United States. So expect the dollar to stay strong for now, and it's going to have an impact on the rest of the world. I guess you have somebody sitting with you who has a pretty good handle on cross-currency issues for people who work in two parts of the world.
That's a question for Mohammed, Mike McKee. Mohammed, have we got a dollar problem for all these central banks?
So in the past, whenever we've seen a very sharp appreciation in the dollar, it has tended to break something. What I thought was really interesting from Mike's comments is the Bank of Japan. I don't think the potential for the Fed to surprise is very large. It will keep rates unchanged, nor do I think the potential for the Bank of England to surprise is very large. It will raise 25 basis points. The big uncertainty is the Bank of Japan. And that is what I think markets haven't understood. It's not as much rates as the yield curve control. Do we get another signal that they are easing out of yield curve control territory?
Well, where do you think they are now? What is the actual policy on yield curve control of the BOJ?
So they're tolerating a 70 basis point 10-year,
yeah,
which was unthinkable 6 months ago. And I think they may indicate that they're willing to tolerate something more, and the rate will move immediately on that news.
Governor Wade has suggested that maybe they do raise interest rates at the end of this year and abandon negative interest rate policy. Do you think we should be paying attention to that as well?
We should absolutely be paying attention, not because of the rate spillover, but because the Japanese are very big owners of foreign securities.
Okay, so the next question is, what does that mean for treasuries? So the anchors have gone now. Put market away. ECB is done with all of this. Bank of Japan set to follow potentially, given what you've just said. Does that mean a new floor for treasuries or a new ceiling for treasury yields?
So first, the policy anchors have gone away. Okay, the economic anchor is still holding in the U.S. That's really important. It's important for the U.S. It's important for the rest of the world. And then there are the technicals. The good news for most market participants is that the technicals are favorable. Keep a very close eye on the 10-year if it gets to 0.35, 4.35. That is a major resistance point. And if it goes through there, then people are going to start talking about 450, 475, and it's going to be a different narrative.
Interesting. 433 right now, by the way, on a 10-year Treasury. Mohammed, stick with us. Coming up on the programme, I'll run you through the trading diary, the calendar for the week ahead. From New York, this is Bloomberg. Let's get to the calendar. The week ahead looks like this. At the top of the hour, UMich Consumer Sentiment Survey Plus. President Biden expected to address the UAW strike later today. Wednesday, Fed rate decision, Pound News Conference. Thursday, the Bank of England's turn. And finally, on Friday, it's the BOJ. Mohammed with us around a table in New York. Mohammed, what a week.
What a week. And next week will be also what a week.
What stands out for you this week?
4 things. U.S. growth exceptionalism. 2, the return of some inflationary pressure. 3, Europe deep into stagflationary risk. And finally, Japan likely to exit YCC much quicker than most people expect. That is quite a combination for 1 week.
Stagflation, risk or reality in Europe?
I fear it's going to be a reality. I really worry about that, John.
That is brutal. It just looked terrible for them this week, didn't it? What's the answer? What's the policy response you should have when you confront that into next year?
So I know what the ECB is going to do. It's going to stick to its single mandate. I think policymakers have to do a lot more on the industrial policy side because they have to take advantage of this opening as a transition in their growth model, something that's absolutely critical.
Interesting. Mohammed, just fantastic to see you, as always. Thanks for being with us. Mohammed Al-Arian from New York City. That does it for me. Have a fantastic weekend. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
If a more advanced biology CAD tool existed, AI could design a vaccine that can protect against multiple diseases.
When curiosity comes together and respect for others' discipline, that's where true collaboration really happens.
And some of these problems are really large scale, so they require many different ways of thinking about things.
Hyundai Motor, connecting art and technology.
A triple strike, a triple threat, and triple witching. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Bonnie Quinn. We're kicking you off to the closing bell right here in the United States. Let's take a look at where we stand right now because we have the Nasdaq 100 down 1.75%. It's been a pretty volatile day. We're talking about a $4 trillion event happening today. But if you think about it, all week, volume has been anemic. $10 billion worth of shares changing hands each day this week. So we're getting a little bit of a capitulation today. However, that belies what's going on underneath. In the S&P 500, for example, there are about 100 stocks higher, mostly airlines, leisure stocks, and stocks that have given up some ground. Take a look at the two-year yield, very close to 5.02%. It was up another few basis points earlier on. We got some good data today, including New York State manufacturing and also inflation expectations from the University of Michigan, which the Fed will be watching, down to 3.1 over the next year by consumers from 3.5, which is a big drop. And then just to point out, crude oil still above $90 a barrel.
Yeah, we talk about the broader market now at session lows. Let's talk about some of the individual sectors. A slew of negative catalysts this Friday morning, tamping down the broader market. But there's been an outsized effect right now on the chip space. Reuters a little bit earlier reported that Taiwan Semiconductor told its major suppliers to delay deliveries because of concern about demand from its end customers. TSMC saying it won't respond to the report. But investors, they already have. The company's American Depository receipts wiping out almost all the gains from the previous three sessions. ASML, which is the biggest supplier to TSMC, those shares down 4%. And Applied Materials, the second biggest supplier, slumping the most in about 2 months. You put it all together and you have a Philadelphia Semiconductor Index, one of the best performing sectors in the first half of the year. Right now, though, it's on pace for its second straight weekly decline and now testing some key technical levels to the downside. Meanwhile, one of the best performing sectors in the month of June has now flipped to become one of the worst performers since. Airline stocks, they're actually back in a bear market. The S&P Super Composite Airlines Index hit a year-to-date high back on July 11th. Remember, that was part of a stunning 2-month 36% rally, but that index has now slid more than 23% since, and you got 30% plus drops for names like Allegiant, American, Hawaiian Airlines, as well as JetBlue. A big shift in investor sentiment out there, coming after several of these carriers cut their profit outlooks amid a jump in fuel prices, a big slump in domestic ticket purchases, and, of course, more expensive labor contracts. And you add insult to injury, that airline index, believe it or not, is still actually trading almost 50% below its pre-pandemic levels. Now, the slump in chips and the slump in airlines, it highlights the market's fears, really, about the state of the U.S. and the global economy. And so now the attention turns back to Jay Powell and the Fed. A big decision next week, Bonnie, for policymakers. And it's going to be less about where rates need to be now, but where they really need to be over the next year.
Exactly, Romaine. We've had a week of a blackout period. And as Romaine said, the FOMC decision comes next week. With it comes the SEP, the Summary of Economic Projections. And that's where this chart comes in, because while traders are still pricing in a 50-50 chance of another hike by the end of the year, what they're now pricing in is a longer hold. Look at Fed funds futures for December of 2024. They're at a record at this point. And of course, we could see that median dot tilt a little bit higher next week. That's at least what JP Morgan's Michael Feroli has just said in the last few minutes.
All right, let's kick things off here. Kicking you off to the close, Leslie Falconio joining us right now, head of taxable fixed income strategy over at UBS, Global Wealth Management. All right, put this together here for us, Leslie. I mean, do you care as much, I mean, from an investor's perspective, that is, about what the Fed has to say next, or do we kind of already know where we're headed?
Well, I think that we do care in the sense that we want to know what the summary of economic projections are going to do. And when I say that, investors know that, the summary of economic projections in terms of its, accuracy is not very accurate, right? And we know it's a longer term median, but it is important, I think, at this point in particular, because now the market has really shifted in terms of pricing out a lot of Fed easing in 2024. And as a matter of fact, just today, it went below, 100 basis points of easing for the first time, in about 6 months. So I think in that regard, they're going to pay attention in terms of, what Powell has to say. It's expected right now. It's going to be probably a hawkish pause. But I do think because it's so reliant on this data dependence, that they will listen to his commentary, and particularly look at the summary of economic projections.
How do you think the market is going to take that in stride right now? We talk a lot about, and obviously your expertise is in fixed income, and congratulations, because this has really been your time to shine over the last
finally.
Finally. Does that last, though? I guess that's kind of what I'm getting at here. If people feel like they have an all clear from the Fed, that sort of flight into the relative safety and, more importantly, the relative returns that you get in fixed income, does that reverse? Do people then just go back to growth stocks?
Well, listen, I think they have the all clear from the Fed, and more importantly, the all clear from the economy right now. Right. I mean, when you think about it, we have inflation coming down. We have growth remaining, relatively strong. In the fourth quarter and the first quarter, our expectation is for growth to slow, but not necessarily have a hard landing. So I think where the fixed income has a benefit of is really locking in these yields over a longer period of time and being able to compound that income. And I think, and today in particular, after seeing interest rates that are 50 basis point, 1%, and particularly as we have, an aging population, fixed income is finally doing what it's supposed to be doing. Now, when you think about going forward and you think about the projections that we have in terms of easing, it's not as though the 10-year Treasury yield is going to fall to a 2.5% next year. So you're going to have this higher for longer. You're going to have a higher cost of capital, higher borrowing cost to the consumer. So over time, growth will slow. It doesn't necessarily have to slow to the point where it reaches a hard landing.
Leslie, it's not that often that the bank's head of fixed income research writes an op-ed for the FT, but today it so happens that Stephen Major of HSBC does have one in the FT, and he says this: there are 3 supportive arguments for the battered U.S. Treasury bond market: fading momentum, the restoration of value, and opportunity cost. So if you were to listen to Stephen Major, where are the best opportunities given those arguments?
Listen, the fading of value, one of the things that just is interesting about the Treasury market this year, and as much sort of, focus we've had on rising interest rates, if you look at 2022, the intraday high in the 10-year yields was around a 430, 434. This year it's a 436. So even with all of this recalibration of we're not going to go into recession, we are going to have a soft landing, it's not as though we're looking at a 5.5% Treasury yield. And by the way, if we did have that scenario, then I would be concerned for both the risk assets and the equity market. But I do think in terms of opportunity, you do have the opportunity to lock in. One of the differences today, though, versus historically, is that when you think about when the Fed pauses, right, historically 10-year yields have a tendency to decline anywhere from 70 to 110 basis points. More than likely, this time around, that decline will be less. It's just a reason to point of increasing supply because of the deficit. Right. So the trend will be the same. The magnitude might be different. But I think if people have readjusted sort of what they expect the interest rate market to do after the Fed pauses, whether it's in September or November.
Leslie, if you look at corporates, lower quality has been performing well. Does that continue, or is this a risk?
Listen, when we think about high yield spreads, like this morning, we're about 380, right, around that. And that's pretty much the tightest that we've seen this year. I don't think that continues. We think high yield spreads will widen out, not in terms of a catalyst perspective, but it's not unusual for lower quality assets like high yield to tighten during an end of a cycle, but it's also not unusual for defaults to keep rising even after the Fed pauses, right? Because it works on a lag. I think there was a lot of money on the sidelines, a lot of dry powder, because most investors thought a recession would happen a little bit sooner. So I think people are allocating money to work. But one thing I can say about the high yield market, even though we do like higher quality much better, is that listen, the capital markets are open, right? And they have the ability to issue. But the thing is, out of the 120 billion that they've issued in supply, if you take out refinancing, it's only about 45 billion. So it's not as though we think there's going to be sort of a catalyst in lower quality like high yield. We just don't think you're compensated for it. And given the fact you have a much wider opportunity set now with yields at the levels that they are, just stick with a higher quality, particularly at this stage of the cycle.
Leslie, always great to talk to you. Leslie Falcone, have a wonderful weekend. Head of Taxable Fixed Income Strategy over at UBS Global Wealth Management, helping us kick you off to the close here on this Friday afternoon, where everyone is now focused on the United Auto Workers Union going on strike with targeted walkouts to maximize pressure on the three major automakers here in the U.S. We're going to talk about some of those pressure points coming up in a bit.
Plus, the latest on reports that Disney held talks about selling its ABC network and TV stations to local broadcaster Nexstar. What a sale could mean for the future of broadcasting.
And we're going to check in with ARM Holdings, day 2 here of the newly publicly traded company here. Of course, a big pop yesterday, somewhat tepid today. We're going to talk about what's behind the volatility. All that and more coming up in just a bit. Stick with us. This is Bloomberg.
What we have observed is that larger asset management firms, but also private banks or just general financial institutions have established themselves here in ADGM.
Abu Dhabi gives us capital access, but it also gives us talent access and market access.
So we have access to the private sector, to the public sector, to the policy makers.
A big catalyst next week for markets when the Federal Reserve's FOMC meets on Tuesday for that 2-day meeting. A big decision on Wednesday, followed by the press conference. And of course, coming among rate decisions from the Bank of England as well as the Bank of Japan. Our own international economics and policy correspondent here at Bloomberg, Michael McKee, joining us right now to talk a little bit more about this. And Mike, let's talk about the setup going into this. The setup, of course, about inflation. We got some inflation reports this week. And while there was some concern about a reacceleration in certain pockets, overall, we're still trending in the right direction.
Overall, all of the banks are trending in the right direction, although you have to break it down by individual bank. In the U.S., we saw the consumer price index come in hot on the headline number because of energy prices. But the core dropped, and that is good news for the Fed. But they still have to decide whether they have done enough to keep inflation falling. And that'll be the question for them on Wednesday. For the Bank of England and the Bank of Japan, the questions are similar in that the Bank of England has a real inflation problem, which you can see on the screen. They just probably, the betting is they're going to have to do more.
I love this chart too because it really just sort of illustrates, I think.
Well, the great part is the blue line there is Japan, and they finally have inflation above their target, which is where they want to be. So now they're beginning to talk about the possibility of doing some tightening. And when you look at the odds that our WIRP function produces, nobody thinks the Fed will do anything. They do think the Brits will raise rates, but now there's like a 22% chance that the Japanese will do something that will push rates up.
It's partially because Ueda spoke, right? He told Yomiuri that there might be some kind of light at the end of the year, let's say, on yield curve control or something like that, and he's not, dismissing negative rates entirely. But the Bank of Japan is the one that thinks that inflation is too low, right? The underlying part is not good enough.
Yeah, it has really changed. Their story is starting to change now, and that's what they've been hoping for years and years and years. So the question for them is, can they keep inflation kind of where it is? Or does it get out of control? And so they should start raising rates again, doing something to tighten credit.
All right, Michael McKee, our Bloomberg International Economics correspondent. We're going to let him go early because he's going to have a very busy week next week here, of course, as we head into a consequential Fed meeting. Before we continue our coverage here on The Close, we do want to take a moment to look back. Back on September 12th, we had a segment about Smurfit Kappa's purchase of WestRock. A Bloomberg reporter said that the Smurfit family wanted to take money off the table through that deal. We now know that that statement was incorrect, and we apologize to Smurfit WestRock, and we regret the error. Fani?
Well, coming up, we'll hear from our interview with GM CEO Mary Barra, her take on the UAW walkout, and what could happen next. This is Bloomberg.
Question: how is the anti-ESG sentiment in the US affecting investor thinking when it comes to sustainability? Answers to that and more in HSBC's 5th ESG Sentiment Survey.
Let's turn now to the strike by the United Auto Workers Union against Detroit's big three car makers. Earlier today, Bloomberg's David Weston asked GM CEO Mary Barra for her reaction to the walkout.
I'm extremely disappointed and frustrated that we're even on a strike. We didn't need to get here. General Motors has an exceptionally strong offer on the table. It's historic. It's the largest increase from a wages perspective in our 115-year history, along with world-class health care benefits and many other provisions, job security, et cetera, and a COLA adjustment. So when you look at the strength of the agreement we have on the table, we really don't need to be here. Yes, they have one plant down right now, and it'll impact three very important products. Two brand new, our Chevrolet Colorado and our GMC Canyon, both mid-size pickups that are in strong demand, as well as our Chevrolet cargo van that does exceptionally well in the market. So this is having an impact, and we'll have to see where they go next. I will say we're ready for this. As we've dealt with COVID and dealt with the semiconductor shortage, as well as other supply chain challenges that have continued to persist from COVID. Our team knows how to manage these situations. They're staying agile, and we're going to do what's right for the company. We're going to make sure everyone stays safe. But this is a strike that didn't need to happen.
Mary, as you say, you've made an offer already for a rather substantial increase in wages. It's not what the UAW wants. Implicitly, you've agreed that they do need and deserve some increase in wages. But is this about more than that? Is this existential in a sense for the auto companies in terms of your need to move into electric vehicles, and from the UAW's point of view, that they believe that, in fact, moving to EVs will actually cut the workforce by as much as 40%?
Well, you're absolutely right. This is a once-in-a-century transformation we're in the middle of moving from internal combustion engine vehicles to electric vehicles. And at GM, we're at a very pivotal point because we have so many electric vehicles ready to launch, in the process of launching. And this is important to securing all of our futures. We need to get these vehicles out. They're wonderful vehicles. We've got waiting lists for most of them, or orders already in place. So it's important that we meet that demand. And one thing from a General Motors perspective, from job security, we have jobs for all of our people as we make this transformation. More than 2 years ago, we started planning for this. And one of the reasons General Motors invested in doing our own power units, which is a component that's very important on an electric vehicle, we designed them internally, and we are now allocating that production to the plants that build internal combustion vehicle engines right now. So we have worked very carefully to have a job for everyone so we can make this transformation together.
And that was the CEO of General Motors, Mary Barra, speaking a little bit earlier today about the strike. Let's continue this conversation right now about the potential impact here on the automakers. David Whiston joining us right now, U.S. Autos equity analyst over at Morningstar Research. And David, we talk about the idea of how long this strike could go on, and more importantly, how long these automakers can, I guess, muddle along without a full production capacity, if you will, here. But I'm taking a look at balance sheets here, and you're talking, $25 billion or so sitting on the balance sheet of GM in cash, something similar for Ford, and I believe Stellantis is something like double that. How far does that get them?
Yeah, that's a really important point here, because I think, generally speaking,
when there's a strike, personally, I've always, generally, it seems like labor ultimately has the upper hand. But what I don't think people realize who aren't following the industry, this negotiation is incredibly different. This is not just about wages or just about a plant that's being closed. There's so many issues because the union basically wants to go back to how things used to be in the glory days when GM had as much as 50% market share or 29% market share at the start of this century. So when you look at the liquidity, I only cover for GM and Ford, so I'll just speak to those. I know Stellantis disclosed, I think, something like 63.9 billion in industrial liquidity at June 30 in euros. But on the GM and Ford side, they have ample cash, around 25 billion for GM, and total liquidity of around 39 billion. And then Ford has over 51 billion in total automotive liquidity as of June 30. So what I think will happen if the strike goes on a long time, the automakers will have to take on more debt, which they can do through their credit lines, and this is assuming they don't even issue any other bonds or anything. And that's you get obviously a little bit. That's one thing. A lot of debt starts to really hurt stock prices, but we just don't know how far this is going to go. But it looks like I think the automakers could outlast the union.
Well, that seems to be, and you see that kind of reflected in some of the stock prices today with most of the automakers and auto suppliers, for that matter, higher on the day here, David. I am curious with regards to Ford and GM specifically and their ability to continue selling new cars. What does it look like right now in terms of the inventory that they have available to sell, and I guess how much time would have to elapse before there basically would be nothing material on the lots?
Yeah, so there's a lot of layers to that question because right now we're only talking about, in GM's case, for example, we're only talking about an assembly plant shutdown, and it's primarily a mid-sized pickup truck plant in Wentzville, Missouri. Where you can get this to hurt a lot is if you start hitting powertrain plants and stamping plants. GM's Romulus powertrain plant, for example, it supplies V6 engines, 10-speed transmissions to 5 plants in North America, 4 of which are in the United States. So from the UAW's perspective, it would be more efficient to actually shut down the powertrain plants because then you can, in turn, shut down assembly plants without calling the assembly plant workers on a strike, which preserves your strike fund. And that math is something the union's not acknowledging to their members publicly in the videos they're doing. There were a lot of upset members in the comments online on Wednesday night. Why aren't we striking everything at once? And the union president Fain is saying, well, it's to maintain flexibility and to keep the automakers guessing. Yeah, that's true. But the real reason is it's very risky to do that because depending whether or not the union pays health care, it's 6 to 11 weeks is what the strike fund would last if you struck all 3 at once.
Right, and you're estimating about $500 a week per worker from that strike fund, David, and that's not sure whether healthcare is involved or not. What happens if the strike fund runs out?
Well, that's a very good question. I mean, can the union get more money? I don't know. I'd have to plan on, even if they could, it wouldn't be a lot. And then I don't think the union wants the strike fund to go to zero. The union is more than just the auto workers. The auto workers are the biggest piece. There are 146,000 of a nearly 400,000 strong union, but they have other members who are on strike right now. About 1,000 workers at Blue Cross Michigan, for example, or at West Rock, there's a few hundred workers on strike. So you can't have the strike fund go to zero because you've got other strikes going on too. And then once it does go, even if you get a little bit back, you're not going to get something probably close to the 825 million roughly that it is now.
Yeah, it's going to be interesting to see how this plays out. Maybe at some point these two sides do actually come to the table. David, great stuff here. David Whiston, a U.S. Autos equity analyst over at Morningstar Research. And Bonnie, I think everybody right now is trying to put a price here on what this could mean in terms of the costs, whether it's to the workers themselves and lost wages, whether it's to the automakers and also to the economy.
Yes, exactly. And we're seeing more power with the labor movement. But for how long does this last, Romain? I mean, take a look at California right now. And we have the franchise model workers also deciding that, they deserve to be paid a little bit more. And franchisors and franchisees need to be treated differently.
And it's interesting, too, because we talk about what's going on in Cal. Some of that, of course, is being spurred by the government there itself, the state government sort of pushing for higher minimum wages for fast food workers and others here. But this came out of this is an outgrowth of a strong labor market, right? And we know that labor market might be starting to soften. So how much leverage do these unions still have in this environment?
Exactly. And when you think about it, franchises are around the country, right? So if you're talking about a McDonald's or a Yum Brands, do you have, a $20 minimum wage eventually in California, but then much less than that in New York? And how does that all work? How does it change where franchisors open franchises?
Yeah, absolutely. Certainly a bit of an inflection point when it comes to the labor market and what people pay and, more importantly, what they demand. Kicking you off to the close here on this Friday afternoon, Romaine Bostick alongside Bonnie Quinn. A look at the equity market still camped out around session lows. We'll be back in a moment. This is Bloomberg. This is the countdown to the close. A look at the broader market with equities at session lows here on this Friday afternoon. Meanwhile, a lot of activity in the commodity space. Abigail Doolittle, she's standing by right now with our commodities close.
There certainly is a lot of action in the commodity space. Unlike stocks, not down quite as much, down, but down modestly. But here are some of the more interesting mixed moves within the commodity space. European natural gas getting a bid up 2.7%. Of course, the LNG strikes continue in Australia. Natural gas here in the U.S., though, it's down a little bit. We've seen this kind of divergence a lot recently based on those strikes, other factors, supply and weather. Speaking of weather, we do have orange juice hitting a new record high today. I believe some of the recent storms hitting both Florida and California at play there in terms of the recent spike. And then wheat, a rare update for wheat, up 1.7%. Apparently dry weather is causing some traders to think that wheat supplies could be constrained. But the big commodity this week, of course, is oil. Let's take a look at oil back above $90 per barrel. The first time that we have seen that, going all the way back to June of 2022 over this time period. My gosh, what a round trip. But over the last few months, up and away for oil. And it won't be surprising, Romaine, if we soon see oil over this time period higher as opposed to slightly lower.
Yeah, a momentous week here for crude oil as it now back to those November highs. Also a momentous week for the IPO market. We, of course, had the biggest IPO of the year so far, ARM coming to the market. And now everyone's looking to what comes next. Instacart said to be raising the price range for its initial public offering, and is now seeking to raise as much as $660 million at a target of $28 to $30 a share. That new issue could actually come to market as soon as next Tuesday. Bloomberg's Ryan Gould joining us right now to talk a little bit more about that. And Ryan, I guess the big question people want to know off the bat is how much does the success of the ARM IPO maybe feed into the potential success for an Instacart IPO?
Yeah, Romaine, it's been quite the week. People are saying that ARM has been a shot in the arm for the rest of the IPO market at large. There are quite a few people who are looking on, thinking about this week as, are the floodgates opening? I would caution and say that maybe not quite yet. We are looking to be sort of constructive through the end of this year at least, and then maybe by the first quarter of next year, we could be in a position where we're seeing, quite a few marquee names come and think about testing the waters if they're not already. But as far as this week has gone, I don't think ARM could have got off to a better start. It closed yesterday at 25% higher than it opened, and I mean, people are looking on and thinking, well, is it, isn't it? And maybe we're sort of on the better side of things for that. So yeah, I mean, Instacart. Sorry.
Well, I was just going to say Instacart is such a totally different company to ARM. Is it wise, just having seen the evidence of the ARM IPO, to now increase, what Instacart is looking for? It's something like a 7% increase. It's quite large, Ryan.
It is. But I think, people said at the beginning when Instacart went out and said its range last week that, it was always attractively priced. It looked fairly, nice on paper. I think when they put it out initially, they were being pretty conservative. So now, they've obviously seen what's happened yesterday and said, OK, well, we're not going to bite off too much more than we can chew, but we do think there's probably a little more room for us to, adjust things. So, that $2 hike in the initial range is enough, probably. Again, in a market where there is still so much price sensitivity, particularly around valuation, Instacart is probably, still being pretty conservative on this. I wouldn't be surprised next week to think about when we get to trading on Tuesday, bearing in mind this is pricing on Monday, that we'll see another good a good pop, so they might hope at least.
So what comes after this, Ryan? We've heard a lot of chatter about other companies that might come to market, like Birkenstock, like Klaviyo.
Yeah, so Klaviyo is already out there. They had set a range. They're working pretty much the same schedule as Instacart. Klaviyo is set to price on Tuesday to trade Wednesday. So the early part of next week will look pretty busy for down at the exchanges. Beyond Klaviyo, I mean, Klaviyo itself is a very different business to Instacart, but beyond Klaviyo, we obviously have Birkenstock, the marquee name in German footwear. Probably, a lot of us might have worn them. People are looking forward to that as, again, another big household name coming to, the US exchanges. Looking a bit further on towards the end of this month, we've got VNG, which is a Vietnamese internet company that we expect to file. And then, of course, there are some more sort of going into that maybe might creep out before Thanksgiving.
Ryan, thank you. We'll be looking to your reporting on all of those. That is Bloomberg's Ryan Gould, and thanks for that. And Romain, it's interesting because even with this price boost, Instacart is still valued at about 25% less than it was about 2 years ago.
Yeah, and I mean, it's a pretty big drop, but this was kind of necessary, right? We talk about this idea that you need an exit strategy, and even if that exit strategy means some pain here with regards to the down round, then I guess you have to take it. The question, though, is how much activity is there going to be in the secondary market for it once it comes to market? Exactly,
and if you actually look at ARM's trading today was really fascinating. At one point it was up 5%, and now it's down 2%, so it's been like a 7% swing for ARM itself today, so still sort of a little bit of price discovery going on.
Yeah, I mean, we should point out ARM, too. I mean, that float they have is it's tiny, too. So you're going to have some big swings here because they only really sold a small portion of the company.
Exactly. Can't wait for Birkenstock and Instacart and Klaviyo. We'll see if this is just symptomatic of the wider capital markets or particular to these companies, this price action. Well, still ahead, we'll dig deeper into ARM with the biggest debut of the year, obviously. We'll talk to one of the analysts that started coverage of the stock next. This is Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start with Unity Software, the maker of graphic tools for video games, causing some controversy among developers with the announcement of a new fee for games using its platforms. The developers, they hate it, but investors and analysts, they actually like it. Bank of America upgrading the stock to buy because of what it says is the improvement in monetization. Those shares up fractionally on the day. Next, let's take a look at Cava, the Mediterranean restaurant that went public back in June. Loop Capital starting coverage with a hold rating and a street low price target of about $40 a share. Now, while the analyst says he loves Cava's investment story and comp sales growth, he's not a big fan of the stock's valuation, arguing that Cava's positive attributes are already priced into the shares. Those shares down 2.5 on the day. And finally, the talk of the NASDAQ, ARM. Needham launching coverage of the chip designer with a hold rating. The analyst says that the world is entering a post-smartphone era, which was highly attributable to ARM's past success. And while the company can grow beyond that, it might not be enough to support upside from its IPO valuation. Those shares on the back foot today after yesterday's 20% plus gain, and those are some of our top calls. We do want to stay in the sell side space and in the ARM space, and well, with that call that we just gave you. Charles Shi joining us right now. He is Needham's senior analyst covering the semiconductor industry and has that hold rating on ARM. And Charles, let's start off here with the valuations. I mean, we knew the valuation was going to probably be, at least in the eyes of investors, more comparable with an NVIDIA, more comparable, I guess, with some of the more sizzling AI names. But you're saying it should be valued maybe more along the lines of a Cadence or a Synopsys.
Yes, that's correct. I think the whole idea about ARM, NVIDIA being a comp to ARM is kind of is a misperception about where ARM actually sits in the semiconductor supply chain. NVIDIA is a hardware company, and ARM, they actually provide the IP, which is actually the easiest way to understand. There's a bunch of software codes. So they actually sit at the same place as Cadence Design Systems and Synopsys, which happen to be number 2 and number 3 in the IP space for semiconductors, ARM is number one.
But when you listen, but I am curious, I mean, when you listen to what executives have said, at least publicly, particularly with the interviews we had yesterday with the CEO, the discussion about artificial intelligence, how integral that is to their growth plans here. Do you not buy into that?
Well, I think technically they are part of the semiconductor industry. AI is going to be a very important driver for the next phase of the semiconductor growth. I think you already mentioned smartphone probably drove the semiconductor growth over the past decade or so. Going forward, it has to be coming from AI, high-performance computing space. They are playing a role there, but what I'm trying to argue here is what we are seeing is more like NVIDIA type GPU AI accelerators that's driving that next phase of growth. ARM is in the CPU space, more importantly, mostly in the smartphone space. That's not the same generative AI demand we are talking about today as it relates to NVIDIA. So what I'm trying to say is, yes, AI demand will eventually, that will trickle down to ARM, but it's probably not coming at the rate this kind of valuation is justifying. So I think investors probably need to be a little bit more patient when it comes to how AI is going to drive ARM's growth in the next 1, 2, 3 years.
So, Charles, what it will depend on then for growth is increasing royalty rates. How much room does it have to increase royalty rates on, say, Qualcomm?
Yeah, that's an excellent question here. It's actually one of the key things we kind of want to be a little bit cautious on some of the outlook people are envisioning to justify the current valuation. We know that the units of smartphones, that's the biggest source of the royalty revenue, is not going to have a very strong double-digit growth. Smartphones already reaching the saturation. I would argue actually probably 5 years ago, we are already at that saturation point. So the lever they can pull is royalty rates. But the royalty rate, where they are at, roughly 2 to 2.5%, is already where I think it's probably closer to the ceiling than to the floor. What that means is you already see the dispute between Qualcomm and ARM. I'm not getting into the details, but I think it boils down to the royalty rates.
All right, Charles, great stuff here. We got to get you back on maybe in a few weeks' time when we have a little bit more investor reaction to the latest issue here. Charles Shi over at Needham starting coverage on ARM with a hold rating and a street low price target of $40 a share. Meanwhile, we go back to one of the other big stories of the day, and that is the strike by the United Auto Workers Union here in the U.S. against the 3 major automakers. And we're now learning, Bonnie, in just the last few minutes that the UAW president is saying that he expects to be back at the bargaining table tomorrow.
Well, you have to wonder if this hasn't got something to do with President Biden speaking earlier and saying the negotiations had broken down, because Fain is disputing this and saying, no, negotiations didn't break down. But what the president did do was give them some support and suggest to the big 3 that perhaps if they were making record profits, that there should be a record contract.
Yeah, walking a fine line here, of course, between trying to get what he thinks he is due, at the same time trying to appease a very diverse worker base that he has to represent there. We're going to pivot from that story to the other big story that we learned this week, and that's about the potential sale of Disney's ABC assets. We're already learning that media mogul Byron Allen is set to offer $10 billion to buy those assets, and learning that there are some other potential buyers lining up as well. We're going to check in with Chris Palmieri out in Los Angeles after the break. This is Bloomberg.
Well, Disney is said to have held initial talks to sell its ABC network and other stations. The company writing in a statement, quote, "While we're open to considering a variety of strategic options, at this time we have made no decision with respect to ABC or any other property." Joining us now is Tim Nolan, who's Senior Media Tech Analyst over at Macquarie. Tim, thanks so much for joining us. So Disney obviously saying it's going to drum up interest. It's been saying that for some time. Bloomberg Intelligence is calculating that its TV portfolio might be worth between $19 and $23 billion. But ABC is only a little part of that. Does Disney need ABC when it comes, for example, to its next carriage negotiations?
Yes, this is a very interesting question because, the value of Disney's TV assets has been in the bundle to date. And now as the bundle is shifting toward more streaming options and including streaming bundles, as we saw with the Charter deal, which got done earlier this week, that's streaming plus linear. The question becomes, where does Disney really want to go with its TV assets? We know that ESPN is a very valuable asset within Disney, and they've made a number of signals that they intend to keep it and put it completely over the top and into a streaming standalone service. So that raises a few questions about ABC. One of the values of ESPN, obviously ESPN is about sports. One of its most important properties is the NBA, and the NBA finals are on the ABC network. So you have to wonder how this will play in, for example, to the value of the sports rights and what Disney's willing to pay for over time. You also have to wonder what the value is of ABC for Hulu, because as we know, Disney is quite likely to buy the 1/3 stake from Charter that Charter owns in Hulu in fairly short order. And so what will the content on Hulu be? And if Disney sells ABC, then, what happens to the content on Hulu? There's a lot of questions around all of this. $10 billion is an interesting price. The value of the linear networks is certainly higher than that with ESPN, but it's a very confusing landscape given the linear shift towards streaming.
It really is, and you calculate that the ABC broadcast network and stations may have generated, less than $600 million in EBITDA in 2022. So what is a good valuation for ABC? How much should somebody pay for that asset? And is it big enough of an offset for Disney to actually move the needle for Disney?
Again, difficult question to answer. I don't have a specific valuation for the ABC network or stations. It's the national network, and Disney owns, I believe it's 8 stations, ABC affiliate stations around the country. The value of the linear network business, which includes ESPN, includes some Disney cable channels, includes a lot of international channels, we think is at least $50 billion. Could be quite a bit higher depending how you split out ESPN, and we'll get a split out of ESPN from Disney quite soon. So ABC would be a component of that 50. ESPN would be the majority. So that's why I say $10 billion is an interesting number. I don't know if it's the right number. I don't know if it's a bit higher, a bit lower than that, but it's sort of in that right ballpark.
Tim, there's a broader question here, I think, about the strategy that Iger has taken, or maybe some folks out there, investors, are trying to force his hand on this. But the whole sort of conglomerate nature of what Disney became and that sort of template, is that kind of over? I mean, is there not value in maybe having an underperforming division like the linear television network, but still finding value as it complements some of the other areas of the business?
Yeah, definitely. I mean, the trends in linear TV may very well be negative, maybe permanently negative on the subscription side in linear. The affiliate fees, the retrans fees that ABC gets. Advertising, could be positive, but let's call it zero growth business. But it still is a decent, margin business. It still generates cash, which is funding the transition to the streaming world. And as we just saw with the Charter deal that got closed, just earlier this week, that is a combined linear and streaming deal, and it's kind of a stepping stone toward a more completely streaming future. So we're still very much in the middle of that transition now. That Charter deal did accelerate that, did push it, 10 yards further down the field, let's say. But it's a very open question. It's been about bundling thus far. Separating out ABC from the other Disney networks is questionable. And remember, ABC is a broadcast network. What a lot of people forget is you can get ABC for free. You can get CBS, Fox, NBC, and ABC for free if you have a broadcast antenna. So if you figure in the number of potential households that ABC broadcast network can reach, it's practically 100% of U.S. households. That's why there is value in it. The local news in the stations is valuable, and that maximum household reach for sports distribution is still valuable.
So this gets into the idea here then, where do you see Disney going? I mean, I know Iger has tried to articulate the strategy to a certain extent, but there's so many parts. I mean, we talk about the dispute with Charter, the dispute over the ESPN and the carriage fees there. Obviously now the potential sale of ABC here. And then, he's rolled back a lot of initiatives that Chapek made with regards to the parks business here. What is he trying to create? Is it just a leaner company?
A leaner company would be nice, but I'm sure it's not just for the sake of being a leaner company. Clearly, streaming is the present and very much more so the future. And Bob Iger has made quite clear, I think even more so in recent weeks and months, that there is a streaming future for ESPN. He said in so many words, it's a question of when, not if. So a completely streaming ESPN over-the-top service, in a way, it's a compliment to, what could be a very completely over-the-top Disney Plus service. I mean, This is why some of the longer tail networks, Disney Junior, and I forgot which other ones, have fallen off of the new Charter offering because so much of that content and so much other exclusive content is available on Disney Plus, and you can now get that as a Charter TV Select subscriber. So we're moving very much toward a streaming future. It's been kind of trying to enact a transition and try to protect the old while building for the new. We're getting closer to a breaking point. We're not there yet. ESPN going completely over the top will be a much bigger breaking point. Maybe that's a year or two or three away. But it is definitely coming. Streaming is the future.
All right, Tim, great stuff. Tim Nolan, Senior Media Tech Analyst over at Macquarie. Let's go out to Los Angeles right now, where Chris Palmieri is standing by right now in our bureau. A big focus right now on Iger, but I think everyone really got a lot of attention when we had the breaking news yesterday that Byron Allen and his media company is apparently willing to pony up $10 billion for these assets.
Yeah, I mean, Byron Allen, look, you got to hand it to the guy, former stand-up comedian who's become a media mogul, owns a Weather Channel, a couple of dozen TV channels across the country, local stations. It'll be a big lift to get to this $10 billion number that we reported. He'll have to bring in a lot of big banks and private equity partners. His track record is not 100% in terms of being able to close some of the deals that he's bid on in recent years. But it really does highlight some of the value potentially in Disney, and maybe lights a fire under CEO Bob Iger to do something.
Yeah, and it's interesting. Do you think we're going to hear other potential bidders step forward, Chris?
Absolutely, yeah. I don't think you can, when you see a number like that and you see the response from Disney that we're still considering it. I think a lot of people are now excited.
All right, Chris Palmieri out there in Los Angeles. And we should point out we did reach out to Byron Allen and his company here for comment, at least right now. Not really willing to speak publicly about this. But this is a huge, I'm interested in this too, because it also shows you the divergence in terms of how people view this type of asset, right? If Iger doesn't see value in it, but then someone else willing to pay $10 billion for whatever reason thinks that he might see value in it.
It's fascinating. And also, where did it come up with the $10 billion, as we heard from the Quarry analyst earlier on, Tim Nolan, and does that include the games, the Monday Night Football games? Does it not?
A lot of questions here, and something I think we're going to be talking about a lot, Vonnie, here. 1 hour in the tank here on this Friday afternoon. Stick with us. Full coverage coming up here as we round out into the final hour of trading.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Almost 3 p.m. here in New York. This is the countdown to the close. Let's get you a view from the top here. Romaine Bostic alongside Vonnie Quinn, the final trading day of the week. And it looks like we're actually wiping out almost all of the gains that we were trying to cling to a little bit earlier here. A big downdraft here right now in the equity market.
It's, as you said earlier, triple witching as well, so that's making some kind of a difference. Also, of course, it had been anemic trading all week, but we do have another hour left, so we'll see if we can make some of those gains good before we get to the closing bell.
Yeah, absolutely here. And of course, the volume will pick up as we get closer to those closing bells because of the options expirations. But right now, you're looking at stocks pretty much around the lows of the day, with the NASDAQ 100 down almost 2% here right now. Remember, we came into this week, Vania, there was a lot of talk here about all these different moving averages and whether we were going to break to the upside or downside. And then ARM was supposed to be that catalyst. It had a great day yesterday, not doing much today.
Up 25%. Although I will say, just after the open today, we saw it spike up 5-6% again. And, you know, it took a little while for it to turn negative, but indeed it has turned negative, as have most of the stocks in the NASDAQ. Not so much the S&P 500. We still have about 100 stocks positive there.
Your two-year yield still camped out about above 5% here as we head into a Fed meeting next week. And, of course, a big story here with WTI crude, 91 bucks a barrel, highest levels we've seen going back to at least November. I want to flip up the board just a little bit here because the other big story of the week is that UAW strike, and just kind of puts into perspective, I think, why the union is asking for so much here. This is actually the share of U.S. employee compensation, or the U.S. employee compensation as a share of the total value of business added. So basically, how much people are getting paid out of the profit that corporations make. And that trend has been down. We know that as a percentage of corporate profitability, the amount that flows to the employees has been going down here, now at about 58 on the nose right now. And this is exactly what the UAW has talked about, how they're not just thinking about the future. They want to sort of make up, I guess, for what they say is a past wrong.
Exactly. And
Yeah.
I think somebody probably showed that chart, that very chart, to the president, maybe Gene Sperling, who's been appointed to try and sort of move this thing along, because that's exactly what he said earlier, right?
Yeah.
That if their
Yeah.
car companies are making record profits, then they should be seeing record contracts for their workers. But from one strike to another, and this for a good reason, Paramount is higher. It's up 1.7%, and this is because Hollywood studios will hold talks with striking writers next week. Now, obviously, it's just the very, very beginning, but it could lead somewhere, and it would be a relief to a lot of workers out there in many different industries.
Yeah, it'll be interesting to see if that can get resolved. I saw you had Schwab on there. They're under pressure once again.
Once again,
Yeah.
this keeps happening this year, right, Romaine?
Yeah.
Down about 2.2% now, but they were down a lot more earlier on in the session after saying they were temporarily affected by attrition from clients still integrating TD Ameritrade. I thought that was done after Labor Day.
Yeah, I mean, they've obviously got a lot to sort out here. It'll be interesting to see what they do. I think they kind of got caught in that downdraft with the regional banking crisis, even though they weren't really directly sort of affected by it.
Exactly,
Yeah.
but they did have to come out and defend
Yeah.
themselves, and we know that that's always not a good thing to have to do if you're a bank or a brokerage. And then, of course, you mentioned all of these earlier, Romaine. It's the chips, the chip makers, the chip suppliers. I've just picked Applied Materials from all of them, but KLA, Lam Research, they're all down 4-5%.
All right, we are less than 1 hour away from the closing bell. Our cross-platform coverage, counting you down to those bells, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Bonnie Quinn. We're joined right now by our colleagues Jess Menton and Simone Foxman. Together, we welcome our audiences across all of our Bloomberg platforms, television, radio, originals, as well as those folks streaming us on YouTube. An interesting day, guys, in the market today. And, of course, obviously a big focus right now on economic conditions.
Definitely. And I know y'all are probably missing Carol Masser and Tim Stinovic today, but you do have Simone and myself here. And obviously when we come back for the closing bell later on, but looking more broadly in the market and seeing things, especially stocks jeopardizing those weekly gains, Romaine, especially when you're thinking ahead to the Fed's next week Federal Reserve meeting.
Yeah, not to mention all that focus that we're paying on what's happening in Detroit with the first UAW strike against 3 automakers at once, certainly.
And of course, Simone and I were taking a close look when it came to what's going on in the housing market, and especially when you're looking at some of these cancellations that are happening there as well, and some of the dynamics, because when you think of the backdrop and just think of where mortgage rates are at this moment, especially doubling just over the last couple of years. And then when you think about the issues when it comes to low inventory, obviously a big thing coming out of the housing crisis, but really was exacerbated by the pandemic, Simone. And when you're thinking, when you're vying for all these options and how competitive the housing market is at this point.
Yeah, look at it. 60,000 homes nearly, home purchase agreements canceled in the month of August. That's about 15.7% of homes that went under contract that month, according to Redfin. trillion. Big numbers.
Yeah, big numbers here, and it gets, I think, to the broader point about whether we're at some sort of inflection point in the economy, in the markets, and the cycle itself here. And I'd be remiss in not mentioning that here on this September 15th, 2023, it's actually, well, the anniversary of the collapse of Lehman Brothers. Remember, this was a pretty big week. Of course, Lehman actually filed for Chapter 11 on September 15th. But remember, that same week, you had Merrill Lynch being sold off, and then you had Fannie Mae, Freddie Mac being put into conservatorship. So you had just a huge shift in I guess our financial system, if you will. We should point out, 25,000 people or more lost their jobs just in the Lehman bankruptcy alone, Bonnie.
It's sending chills down my spine, Romaine, because I was working in here that whole weekend long. We finally got this resolution, and I had to pass Lehman Brothers on my way home, and I saw people carrying cardboard boxes out of there, and there's nothing worse than seeing that.
And it's amazing. We talked to a lot of folks who unfortunately managed to find other jobs on Wall Street, and we asked them about those days and just how they felt there. I mean, this was stunning. To see it, not just the collapse, but the fact that it happened so quickly, guys.
Exactly.
Yeah.
Well, we should point out John Authers' column today, pointing out that while much of everything else hasn't done very well since, from economic to cultural conditions.
No. Have you looked at bank stock valuation since then? You put that chart on your Bloomberg terminal, and I think it tells you a lot here, just how damaging that crisis was.
Yeah, but, I remember I was actually in an economics classroom, believe it or not, 15 years ago, trying to learn about what exactly was happening in the market. And yet, at the same time, we're looking at home prices continue going up and up again, but now the stakes very different.
Yeah, when you think about also, though, just kind of changing dynamics and thinking about we're getting closer to that 1-year anniversary of when the S&P 500 did trough on October 12th of last year. But if you look at the S&P 500 year-to-date, up 16%, well up over 20%, which many consider to be that bear market territory since then. So we've come a long way over the past year. So it's going to be interesting to see heading into next week, especially with that Fed meeting, what shapes up there.
All right, guys, a quick check-in, of course, with our radio colleagues. That does it for now, but we're going to check back in with Jess and Simone a little bit later, live on television, radio, and YouTube at 4 p.m. for our Beyond the Bell coverage, where we will take you through the market close. Also, a reminder that Bloomberg Business Week is now on Bloomberg Originals. We continue our markets coverage right here on Bloomberg Television, counting you down to the close with just about 50 minutes or so to go. Bank of America's Michael Hartnett out with a note this morning, sticking with his cautious view on the markets, writing, "Nothing screams bear market in conviction more than money market funds seeing $1 trillion of inflows year to date." Here with her perspective is Sherry Paul, Senior Portfolio Manager over at Morgan Stanley Private Wealth Management. And we should point out that Hartnett's note was on the back of the latest fund flow data that Bank of America puts out, which actually showed a lot of people gravitating back to equities. But he is kind of putting a fine point on it, saying that for any enthusiasm you're seeing in the equity market, there's still a lot of people on those quote-unquote sidelines.
Yeah. Well, you guys really know how to kick off a Friday with Lehman Brothers and bear markets. Thank you for having me.
You got something positive to say?
I do. I got something really good to say. Well, first of all, let's just hope that Lehman Brothers is, like today, not a foreshadowing for what could potentially come with the installation of AI, this transformative technology that people have been talking about all week that is consciously designed to remove humans from the economy. And so not surprising that we're starting to see strikes and other things come into the economy from where I sit. As far as money market inflows, we had $10 trillion worth of printed money. I don't think $1 trillion going into cash tells us a whole lot other than it's a smart trade to put money in 5% yields where you can and take a breather from what has been a fantastic market this year that so many economists thought was going to go in a different direction, but portfolio managers like myself, our responsibility is to find the corridor of opportunity, and that's exactly what we've done in our portfolios this year.
I am curious. You used the word smart, and it seems prudent, certainly so, when you look at the yields you can get there, particularly relative to what you couldn't get even just, a year ago, barely.
Wild, yeah.
Do you think that stays there? Do you think people are still going to have that kind of appetite for, I guess, a level of diversification with regards to fixed income and even short duration fixed income in a way that they didn't have during the last bull market cycle?
It's so interesting. There's emotional diversification, at least in my experience working with individual investors, and then there's just portfolio diversification. And right now, cash sort of serves both for a lot of people. And I think, though, going forward, as we move into what I call political and policy volatility, there's a lot more change coming Deglobalization is a big narrative right now, too. We've got what I'm referring to as this industrial revolution of cost compression. And that will produce, I think, an uneven continuation of the bull market based on the ability for corporations to really capitalize on the download of AI in a way that becomes cost effective. So going forward, I think that the smart money is liquid, dynamic, and aware, and incredibly thoughtful. And prudence is a powerful point in a portfolio just as much as growth is.
And yet, even with the gains that we've had across the indices this year, you're still preferring stocks over bonds.
Well, yeah, I think long-term stocks over bonds. When you take a look at the inflation rate, we're probably going to continue in this. I'm calling them microeconomies. That the United States is now a collection of what I call microeconomies, and so the recovery is very uneven. Inflation spots are also very uneven, and wages are also very uneven across the country. And so, from a long-term hedge standpoint, absolutely the stock market. And again, we're in a seminal moment of innovation. I just really want to encourage investors not to miss the forest for the trees. This one's a little bit different, though, than the last two. The infrastructure build out for the internet, I would call number one. Then the socialization and monetization in terms of how we consume goods, order, point of purchase, number two. This one, very different, all about giving companies the ability to save money and build efficiencies, all right? And that's its own kind of profits bull market, different than growth and expansion.
So when do we get this new cycle starting?
Well, I think it's already begun, and I think it's going to be sector-based. And so, again, I want to try and pull people out of a broad market perspective and start to understand that money placement at the sector level is going to be crucial, and then, of course, at the single security level. So healthcare, which has sort of underperformed this year, a great beneficiary of the installation of AI technologies from an innovation, biotech, and cost savings. Industrials, defensives, economies are made up of what people need, staples, what they desire, consumer discretionary, and then what they want. And so we're going to see this economy unfold, I think, in an uneven way, but lots of opportunity.
Lots of opportunity. I mean, just so we started on a kind of a negative note, on the positive note. I mean, I think anyone with half a brain can see some of the positive sort of developments that are occurring in the economy, even though there might be some pain along the way. I am curious about the role of monetary policy, because the last well, really the last couple of big bull market cycles we had was really dominated by the presence of monetary policy, both to the upside and to the downside in terms of rates here. Do you think that there is going to be, I guess, some breathing room, if you will, where we don't have to pay as much attention to Jay Powell? We don't have to obsess as much over where the Fed funds rate is going?
I mean, wouldn't that be amazing? Something tells me you're half a brain and my half a brain. We could do a super brain. Come on, let's do it.
I'm all for it.
Wouldn't that be great? Yeah. But although, when we take a look at things like the chip bill and how we're trying to rebuild manufacturing or the change the geography of manufacturing due to deglobalization, I think we probably continue to see both monetary and fiscal intervention. And frankly, we don't want to fight that. It's a classic saying, you don't fight the stimulus. And so that's why I'm still positive on stocks.
All right, we do have to leave it there, but we're going to have to continue this discussion very soon. That is Sherry Paul, Senior Portfolio Manager over at Morgan Stanley Private Wealth Management. Coming up, it is Triple Witching Day. $4 trillion of options contracts are set to expire. We'll look at how it's impacting the markets.
Plus, we're going to take an interesting look at how the Dow Jones Industrial Average is paying a big price this year for snubbing Amazon and Alphabet.
And Goldman Sachs will offer wealthy clients the chance to own a piece of a private sports team. We'll look at how that works and whether it could be a good...
Do I get to pick which team?
Well, do you
Not
get
the
to
Jets,
pick your fellow investors? Because you don't have to sit together. You realize that at the games, right?
Huh, okay, maybe we do.
I don't know.
How's the Rugby World Cup going, Bonnie?
All of that and lots more coming up. This is Bloomberg.
It's great to see you. Microsoft, Nvidia, Amazon, Apple, Meta, the Magnificent Seven, not so magnificent today, with about 43 minutes until we get to the closing bells. Stocks have been on the back foot for a good portion of the day. A bit of a reversal from what we saw earlier this week. We had modest gains. They weren't major gains here, but this seemed to be a market that was trying to find its way higher here. But a slew of economic data that may be providing, well, I guess some confusion as to what the Fed does next, causing a lot of folks to maybe take a pause. Also some negative catalysts coming out of the chip space with that warning by, or the reporting, we should say, on TSMC telling some of its customers, well, hold off just a little bit on delivering any new things. And of course, concerns about what could happen with regards to the economy here in the U.S., with a major strike now going on with the United Auto Workers affecting 3 of the big automakers. The S&P 500 cannot hold that 4,500 level, down 1% on the day. The NASDAQ could not hold that 50-day moving average, down almost 2% here on the day. As we close out the week, there are going to be a couple things you're going to remember very well here. That is, well, the low volatility that we continue to see despite all the volatility we see on a single-day basis. The VIX still below 14 here, but then you take a look at what we saw in the commodity space here. NYMEX crude right now, $91 a barrel. This could become a big story, particularly when folks are trying to assess just whether or not inflation is going to be that bugaboo going forward as we move deeper into the year. Let's bring Abigail Doolittle into this conversation, as we do every day at this time, for our Options Insight segment. And one thing we haven't talked about today, Abigail, that we talked a lot about the last couple of weeks, was the strength of the dollar and what that means for rates and stocks.
Yeah, absolutely, Romaine. And one reason we're not talking about that dollar strength today, this week, is the Bloomberg Dollar Index, at least, it's actually lower. That's because it has a lower allocation to the euro than the DXY. The DXY about flat, but we had been in this multi-week upstreak for the dollar that was really pressuring risk assets right across the board. So what makes all of this so surprising is the fact that right now we have stocks near the lows on the day, now down on the week. Not really the way I was expecting this week to end, Christian Fromhertz of Tribeca Trade Group. It's actually, I mean, you could talk about it. We haven't closed yet, but sort of a ugly way to close out the week. What's going on?
Hey, Abigail. Great to be here. Yeah, I mean, we've been seeing this now, I think, for a couple weeks, where the indices are trading in a tight range, but we continue to explore the ranges of the sideways price action or the range. So it's tough to really get a lot of signals out of the market right now because they're just not consistent on a day-to-day basis. They look pretty good yesterday, today not so good, and we're kind of surrounded by a lot of events as well and weak seasonality.
Well, one board, you probably can't see it. We're looking at the 2-year yields. It is at 503. Over the last 2 years, it's moved up 482. I mean, it's really just extraordinary that at one point it was at 20 basis points. So probably taking that liquidity out, maybe the psychological effect about being above 5 again. It's also triple witching, though. Volume right now, 30% above the average. It seems as though a lot of securities are changing hands. If we think about the Fed next week, are you expecting them to say anything significant that could put more pressure on yields and therefore stocks?
Well, I think from just a very basic standpoint is what that's telling us, the higher rates and stronger dollar, is that there are significant headwinds for stocks. With all the economic data that we got this week, the CPI, the PPI report, and retail sales, so on and so forth, one thing that's been pretty consistent is we have not seen Fed fund futures really move or budge. And they're not implying an interest rate hike for the 20th meeting. And then right now, and of course this could change because we're going to get a lot more information before the next meeting in November, but there's a slim chance right now that they're going to be raising rates there. So that's been pretty inconsistent. But overall, you still have those headwinds that are, that are prevalent with the stronger dollar, the higher rates outside of short-term interest rates, and then of course you have weaker seasonality now until the end of September, basically.
Well, speaking of headwinds, oil could certainly become one of them, back above 90. I would say right now it's in a sweet spot and has been in a sweet spot in terms of being a risk asset. Although, as I think about it, oil has accompanied stocks declining over the last month and a half. There is a nice opportunity, though, a 7 to 8% spread between oil and the XLE. Is that something that you would be interested in trading at some point?
Yeah, I mean, I've been overweight energy stocks for the last couple months, and I think that's a good way to be while we're seeing that trend in crude push higher. So I do like that trade. I think there's also one of the other areas to look at besides crude is what's going on with nat gas, which remains in a range. So I think that has to do with a little bit of the underperformance of XLE because you do have some nat gas stocks that are in that ETF as well. Mm-hmm. But I do continue to be overweight energy here. And
then you also like another part of the commodity play, some of the metals.
Yeah, we've actually been seeing some bullish option activity in things like tech resources. And, that's a stock that I think fits well with higher interest rates. The PE in that stock is only about a 10. So I think the market does like cheaper stocks right now. And specifically the tech October 44 calls, we're seeing those trade as well as the 43 calls. The 44 calls you can get into for about $1.90.
Terrific perspective. We have covered a lot of ground. Christian Bromhertz, CEO of Tribeca Trade Group, thanks for joining us for Options Insight today. And from New York, this is Bloomberg.
Goldman Sachs is set to offer clients more access to a unique investment, the chance to own a piece of a private sports team. This is according to reporting from the Wall Street Journal. And Romain, I have to wonder about this because you're supposed to be pretty dispassionate about your investments, right? So how would you own a piece of a sports team and not care?
Well, I hope they don't invest like in their home team or whatever team they're rooting for. That way they make a more objective decision about whether it's a good value. But I do think it's interesting because we know that this has become a huge area for investment for at least the people who want to actually buy these teams and be either, if not the primary owner, one of the significant owners here. And so it kind of makes sense that you would have sort of an investor base that will want to piggyback on that.
Totally, but as an investor, you wouldn't get to have any say. It's not like you'd be able to, be Steve Cohen at the Mets. You wouldn't have
and
any
say.
By say,
you mean what, like calling plays or something?
Well, what else do you want to own a sports team for unless you can pick players and do trades and so on? But also
valuations, Vonnie.
Sorry. Well, there you go. There's the dispassionate investment gone right there.
Yeah.
But isn't supply limited too, Romain?
Yeah, well, that's the other thing that'll be interesting. I mean, I don't know how much you can go around. I mean, not only is the supply limited, we know sports leagues are relatively small, but at the same time, it's also like, I don't know, like how many of these teams are investable, right?
Well, I don't know. I could own a piece of Inter Miami, I'll tell you that.
Well, yeah, but you missed that boat. I feel like the value, you're buying at the top, Vonnie.
I don't think
you got to find something at the bottom here. Are there any good teams in Ireland? Aren't you guys in the Rugby World Cup?
We are playing Tonga tomorrow.
Tonga?
Yeah.
Are they any good? I don't follow rugby enough to know one way or the other. But.
Listen, we have to get through Tonga and South Africa and, a couple of other nations before we win. So I guess, I don't know. We'll have to see.
All right. Well, I'm going to root for Ireland just because I like you. We'll be back in a moment. This is Bloomberg. This is the countdown to the close. About 30 minutes left to go here, Bonnie, in the trading day.
And what a trading day. Triple witching, as you pointed out at the beginning of the close. Well, it's kicking in right now, and we can see that we're seeing a little bit more momentum to the downside for most stocks and definitely the indices more broadly. If we look into the S&P 500, look at that. If I were to, block the map, you wouldn't see. There are tiny pockets of green. There's, in fact, about 100 companies in the S&P 500 that are higher. They're mostly things like airlines, car parts companies, stocks that had been beaten down and are just getting a little bit of momentum back. But if you look at the securities in all of the larger sectors, well, it's a disaster of a day, particularly information technology. And of course, we know why. It's on that Reuters report that TSMC has asked some chip suppliers and chip companies to delay delivery. So not a great looking picture, but it has been an anemic week and not the best month in the world.
Yeah, but of course the catalysts are starting to pick back up. We had that ARM IPO yesterday, second trading day for the company, and a bit of a down day, only down 1%. Of course, put that against the backdrop of the 20+% gain that it had yesterday, and I guess some folks will take it. Amazon also on the back foot, as are most of the Magnificent Seven, a big part of the reason why you're seeing the NASDAQ and the S&P significantly lower on the day. But keep an eye on the automakers. Ford up on the day. GM at one point was up more than 1%. A lot of those investors in those stocks really taking in stride the latest strike news that we got with the UAW overnight walking off the job at several key assembly plants. This won't affect all of the production at these companies, but certainly some potential for disruption there. So keep an eye on that space, and keep an eye on Planet Fitness having its worst day since May, a surprise departure of its CEO. Now, the CEO is going to stay with the company in an advisory role and sit on the board, but some concerns here about why he's leaving, and more importantly, who's going to replace him. Of course, that brings us back to triple witching here. We should point out volume as of right now already about 20% higher than the 30-day average. That's expected to pick up significantly here over the next 30 minutes as we get to the close here. Of course, this is always a volatile time for the market. And of course, it comes against the backdrop of a big rebalancing of the S&P 500. Don't forget, starting on Monday, you're going to have two big entrants into the S&P 500 with Blackstone and Airbnb taking their position in the S&P. Bonnie.
There's always something going on, Romain. Thank you. Well, Disney is one of the stocks that is higher today. It's up 1%. And the initial talks to sell its ABC network and TV stations behind this move, most likely. Joining us now with his insights is Ross Gerber, President and CEO of wealth investment firm Gerber Kawasaki. I'm reminded a little bit of, how do you value Waystar Royco? How do you value ABC? What should somebody pay for it, Ross?
Well, it's interesting because you're like, who would actually want, it's sort of like a network at this point, but there are still people who watch network television and it drives a pretty decent amount of revenue and profits. And although it's a declining number, it still has value to people in the TV business. So I think it's a real smart move for Disney to divest ABC because I think it's sort of like a non-core asset at this point.
What would happen to Disney if it did divest ABC? What would be the next for the chopping block?
Well, in my mind, ESPN is like the big piece that they could get like a ton of money for and really is synergistic with a lot of companies that want to be in the sports business and the gambling business. They just did this deal with Penn Gaming to now be a gambling app, ESPN, Bet ESPN. And so they're making these steps that I think are very attractive to many in the tech industry that are wanting to be in sports, which is really Apple, Amazon, and Google. Apple's had a lot of success with the MLS, but they typically don't take big, bites out of companies. But ESPN is a piece that's extremely valuable that I think they might end up just keeping anyways, but certainly is a sellable asset.
Well, what has he said, though? I mean, Iger is I felt when he first took over, there was all this talk about, okay, you got to spin off the ESPN or do something with it. And he kind of made clear that ain't happening. And then he seemed to at least leave the door open to that.
Yeah, I prefer them to keep ESPN because I think ESPN and the ESPN Plus app and with the gambling, is actually a wonderful asset to grow, especially as the contracts change with the cable companies where ESPN content will be able to be, more dedicated specifically for the app as the years go on. So there's a lot of value to be gained in ESPN over time. So I prefer if they keep that asset and sell off other assets personally.
I know there's a lot of talk about kind of the quote unquote dead weight that the ABC network, at least the linear television networks had on the company here. But is there any sense here that they would still need some sort of exposure to the broadcast television market in some way or another?
I mean, I think the big question is people are still watching broadcast television, but I just don't know who. And so I'm sure you haven't been watching ABC lately. So, it's like, I don't know who watches broadcast television, but somebody does. My mom probably
people,
still
Ross.
watches it.
I didn't want to say that out loud, but yes, my mother still watches it, and I guess there's still a generation.
It's our moms, right?
Yeah. But there's a younger generation, the folks much younger than us. I don't know. I couldn't name a single one. So.
But
nobody, zero.
Yeah, I'm curious though as to what Disney would do without news. Does it not need news whatsoever?
Well, what is news today? It's changed dramatically. So companies that are very focused on news, like Bloomberg, for example, have done very well because of that focus. But when you look at ABC and the network news, I don't think anybody watches it anymore except our moms we were just talking about. So young people today don't like the news. They don't watch the news. A lot of people are getting their news off social media, basically. And so I think that actually the news business is the first thing I'd get rid of.
Ouch, Ross.
No, because you guys are doing such a good job.
No,
it's because of you.
No, I always appreciate your candor and playing it straight. And in all seriousness, though, too, this gets to the idea, though, of how much runway Iger has left. I mean, in theory, at some point he'll leave. Maybe. But at some point, he's trying to really set this company up, I guess, for whatever the transition is going to be to the new leadership here. I mean, I know maybe it's too early to kind of give a report card, but are you generally happy with the progress that he's made?
Yeah, I am. And he's doing exactly, what he's setting out to do and cutting costs and making strategic decisions. He's brought back Kevin Mayer, Tom Staggs, which I think are great, they're advisors, but I think great addition from a management perspective, and they're doing what needs to be done. It hasn't been that long of a time, and it's been an extremely challenging time in the entertainment industry with the strikes and what's going on. And so, Iger's taken on a big challenge, but I think he's doing what needs to be done. And, Disney here at $85, $86 a share with the assets that it has seems, awful cheap to me as an investor. It's a top holding at my firm and in my fund GK. I think as an investor, you look at Disney, it hasn't gone up in 8 years. It was the last time it was at this price. There's a lot of value that they can create if they make the right moves here.
Well, I guess it's patience that's called for, Ross. Thank you so much, and thanks for joining us. That is Ross Gerber of Gerber Kawasaki. Coming up, the Dow's exclusion of Amazon and Alphabet went from a blessing to a curse in the span of a year. Now, some are speculating that the duo's day has come again. More next. This is Bloomberg.
All right, here's a story that caught my eye. The Dow Jones Industrial Average has been trailing other indexes by double-digit percentages so far this year. And one big reason for that is because the benchmark has some really notable absences. Alphabet and Amazon, two of the biggest companies in the world, not part of the average. After splitting their stocks in 2022, many are calling for a rebalancing of the 127-year-old average. For more, let's bring in Isabel Lee, who wrote this story for us here at Bloomberg. And I kind of forget, I mean, we make fun of the Dow all the time because, the whole debate between market cap weighting and price weighting here. But you have Apple in there, you have Microsoft. But other than that, as far as the biggest names, the names we talk about so much, Amazons, Alphabets, Teslas, even Metas of the world, they're nowhere to be found.
Yes, they're nowhere to be found, and that's why people are asking, what is up? In this year, they're clearly the big laggards. But here's one thing that we realized also. Last year, they were the big winners compared to the S&P and the NASDAQ. And this is why Chris Harvey of Wells Fargo told me that it's okay to be unfashionable at times. I mean, the Dow is unlike other indexes. It rebalances on an as-needed basis. So our team covers rebalances. Every quarter, we have this routine. We're like, okay, here we go. What are the biggest additions or deletions? But not for the Dow. It's been 3 years since they last rebalanced.
When will they rebalance again? Are they considering it perhaps now, given, the price action?
They're very mum on that, but 3 years actually, for others, it's been a while. But if you look at their history, they've had really few and far in between. In fact, 3 years, if you look at it based on their history, is quite recent. So they don't really do that. They just add companies that they deem are excellent. I read their methodology, and it's very vague, as you could probably tell. And I tried to talk to their people, befriend them, but they're like, listen, we're completely separate. We're the index committee. We also only know when something is added or subtracted on the day itself.
So they don't reveal that methodology at all, really?
It's just like we add companies that are
just
excellent in reputation, that represent American society. It's kind of a secretive club. Maybe I want to be part of it someday.
It feels like a jury or something like that. Like you can find out afterwards, but not before or during. So Isabel, when you were going about this, did you also figure out who actually sort of takes notice of the Dow? I mean, we all look at it every day, right? But what does it mean to anybody?
So that's a great question. When I asked two of the sources that I talked to, they said they don't even look at the Dow. Again, to quote Chris Harvey, he said only his dad asks him about the Dow. Stephen DeSantis of Jefferies said our clients don't look at the Dow. I asked him, will you read my story? And he's like, I'll read it because you wrote it. But no one really looks at the Dow. But I want to say that the Dow is still kind of this litmus test of the industry. Like people still clamor, companies still clamor to be part of the Dow. It's still a venerable index. It's the oldest. It's 127 years old. So I don't want to shove it away and make it appear like it's not important. But let's just say that when you look at ETFs, not a lot of ETFs track it. In fact, just one track it compared to the
I'm curious.
S&P.
I mean, it obviously has prestige. I mean, one of the big limitations, obviously the price weighting, but also the fact that it's only 30 stocks. So you have to be much more selective as opposed to the S&P 500, which can, sort of put things in and out because it's got, 500 plus names to choose from. But when I go through the names in the Dow, it is kind of representative of the economy, isn't it?
It is kind of, yes. That's why someone said maybe the blue chip stocks of yesterday isn't the ones today. That could be true, but we also know that this year is just an extraordinary year. I mean, who saw NVIDIA rally like that? Who saw all these big tech companies powered by AI? I mean, if you remove all of them, the economy is still looking kind of shaky. So maybe it is still the best reflection of society, to your point. So
I mean, how many of these remain were even in it back when Lehman went away? Never mind, the last 50, 60 years. And can you still call it the Dow Industrials?
These
questions.
I know.
You'd have to do a multi-part series as well.
Interesting stuff. And we should point out we're getting the S&P S&P rebalancing overnight, I guess, into Monday here. Just some minor additions, Airbnb and
Yes,
Blackstone.
Airbnb and Blackstone, don't forget.
Yeah. Blackstone. So it'll be interesting to see how that shakes out. A great reporting here by Isabel Lee. Look, a deeper dive into the Dow Jones Industrial Average. It is still industrial. Bonnie Quinn.
I was just looking at Salesforce, but yeah, I mean, it's all industrial.
Is that an industrial?
They're in industries, right?
Yeah.
I mean,
all right, a lot more coverage.
Define industrial.
A lot more coverage coming up here as we round out to the closing bells. Just about 15 minutes to go here. Tom Galvin over at National Rockdale, Chief Investment Officer. He's going to be joining us after the break. Stick with us. This is Bloomberg.
Opportunity.
People.
Things get done.
Before, I never did business in Georgia. I was amazed what kind of opportunities. There are many of them here.
Very little bureaucracy, simplicity of doing business.
You have access to markets, finance, and authorities.
It's perfectly located logistically. We have the biggest suppliers nearby.
EBRD has invested 4.6 billion euros in 270 projects, and I think that speaks for itself.
Georgia.
A pleasure
doing business.
This is the countdown to the close. Romaine Bostick here, joined right now by Scarlett Fu, as she does every day at this time. And Scarlett, you're joining us at I guess a pretty spectacular time of day here, because we talk about a down day in the markets,
Yep.
right around session lows, but more importantly, triple witching. So volume is really starting to pick up here. And I'm just taking a look at the breadth here. You got something like 80% of the S&P members right now in the red.
See, I was thinking about that too, and when I was looking at the individual movers, what's noticeable is that if you look at the best performers, the top 5 have at least 2% gains. Usually on a big down day, you don't see a lot of stocks with big gains. But there you have it. I mean, that goes back to the triple witching. The 10 worst performers are down at least 3.5%.
No.
I don't remember the last time triple witching resulted in this much sizable move in individual names.
It is very lopsided, right? And,
Yeah.
and it kind of makes you wonder whether this is because of triple witching, whether it's more concerns about what's going on with the economy.
Yep.
And of course, we had some interesting catalysts we've been talking about earlier, that kind of warning by TSMC, the reporting that we had that they were actually telling some of their customers, don't send us any more supplies here.
Just hold off on everything. And of course, all of this taking place 1 week before the Fed decides on what it's going to do next. No one's expecting it to actually do anything on Wednesday, but still there's a lot of nervousness.
Yeah, and remember, you're going to get those economic projections out of them. That's going to be big, at least as far as guiding the market. And of course, I'm sure Jay Powell is going to be peppered with a lot of questions that he'd rather not answer.
That he's going to decline to discuss specifically.
All right, let's see if we can pepper our next guest with some questions that he will answer. Tom Galvin joining us right now, pleased to say. He's the Chief Investment Officer over at City National Rockdale, helping us count you down to the close. And Tom, let's start off with the inflation reports that we got this week. I guess they showed some degree of progress, but certainly some concerns here that we're going to see a reacceleration in inflation, particularly in the energy space. And, the caveat that the Fed likes to back that out, but consumers don't back that out. And I'm looking at $91 a barrel right now in WTI crude.
Well said, Romaine. Thanks for having me back on. So I think you hit the nail on the head. So I think the price of oil these last few weeks, the CPI reports, is a very strong reminder of a lot of key things. Firstly, that the geopolitical situation around the world is still not back to where it was. There could be something that can come along quickly, raise the price of oil, raise the price of fuel, as we saw in the headline CPI. The good news in the headline CPI was that it's still below the wage gains. Average hourly earnings are growing 4.3%. So that's the good news. The bad news is the wage are higher than the inflation level, so that could be supportive of the consumer to continue to spend. If that's the case, then it's going to be challenging for the Fed to get wages back under control. Getting wages under control, Romaine, I think is foundational to getting the inflation genie back in the bottle. And with wages and inflation running, 4.3% on the core, 4.4 on wages, it's going to be hard, particularly because the pendulum of power, if you will, as it relates to labor costs. Back in the 70s, the unions had the power, and then it kind of shifted over with outsourcing, globalization. Corporations had all the power going into the pandemic, and it's starting to flow back the other way. So it's going to be a challenge for the Fed, and I think that's one of the things they're going to be speaking
But
of.
I'm curious, when I hear you say that, Tom, I think to myself, does the Fed really have that much control over that? I mean, those seem like kind of just economic forces that are kind of outside the purview of just raising or lowering interest rates.
Absolutely, absolutely. It's interesting you say that. The perspectives on the Fed have really changed. If you remember back in 2021, 2022, the Fed was behind the curve. They were clueless. Now they're in control. They've got this. They're going to land the plane safely, take inflation down, no recession, no increase in the unemployment rates, and they're going to start cutting early next year. I think there's a lot of complacency out there. I think they're not going to hike next week, but I do think they're going to remind everybody that wages are still high, the core levels are still high, the battle against inflation, just isn't won. So I think we're going to see some volatility.
We're going to see some volatility, but the big picture of the economy hasn't really changed all that much the last couple of days. What accounts for the extraordinary weakness that we're seeing today in stocks, in bonds? How much of it do you think is tied to things like corporate issuance early next week, investors making room in their portfolio for new issues?
Scarlett is spot on there. So I think it's a confluence of events, the triple witching for sure, TSM reminding everybody that the things are slowing in the global economy, the airlines reminding everyone that, yes, consumers are out there traveling during the summer. They put a lot on their credit cards. They have to pay those credit cards off, and that's going to slow things down. So we see the economy being fine. It's going to stay fine through the end of the year. Consumer spending is going to slow going forward, but that's not going to make it easier for the Fed to reverse course and change the expectations that they're going to stay higher for longer through probably the middle part of 2024.
Yeah, I'm looking at the sector performances today, and everything is in the red. All 11 industry groups are down right now. Utilities are holding up the best in that they're only down by 0.4%. I know that you like dividend stocks, and you're talking about how they are perhaps in a position to do better now. What's prompting the rethink on dividend payers right now?
Yeah, so dividend stocks and have gone through a very volatile period of time. In 2022, they were by far the best performing equity asset class on the planet, bar none. This year, they've been the absolute worst. The truth is probably somewhere in the middle. So why we like those stocks at this point in time, firstly, the valuations have pulled in a lot. They're very, very cheap. Secondly, if you look at the earnings revision trends for the companies in that index, they've been pretty good. Thirdly, when the Fed is near the peak and is likely to pause, interest rate sensitive dividend stocks tend to do better. So we see the asset class coming back in favor. Stocks like AT&T, I'm sure just me mentioning is making people cringe because the stock has done so poorly this year, but it's got a 7.3% yield. Yes, there's this cloud of the copper risk out there, but the way we see it, we think those clouds are going to clear. And that combined with this pause of the Fed that's likely to lift dividend stocks, utility stocks have been clobbered this year, are likely to lead to a better outcome in 2024.
All right, Tom, we're going to have to leave it there. Have a wonderful weekend. Tom Galvin there, of course, helping to lead the investments over there at City National Rockdale. Some great insights here, Scarlett. I mean, we hear so many people talk about dividend-paying stocks, and we could joke about AT&T, but at the end of the day, it doesn't have to be sexy. It just has to give you a return.
Yeah, I mean, 7.8%, that's pretty significant. And I was trying to find what other companies would fit that bill. Verizon's right up there, of course, 7.9% as well. But you have to get past all those copper issues, like you said.
No comment. All right. Volume is picking up here on a triple witching Friday as we're about 2 minutes away from the closing bell. As we move closer to these closing bells, sit tight here because full market coverage coming up right here on Bloomberg with all of our colleagues as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with our radio colleagues, Jess Menton and Simone Foxman, in today for Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms on a Friday afternoon that has effectively erased any modest gains that we had earlier in this week, with the NASDAQ and the Russell, as well as the S&P down more than 1%, guys.
Yeah, and especially when you're looking at this triple witching event, adding volatility to this, but then we also have the rebalancing that's happening before the start of trading on Monday. So you do have Blackstone as well as Airbnb set to join the S&P 500 there. So you have a lot of different dynamics moving in the market on this Friday.
But it really does feel like some of the enthusiasm has gone out of the market over the past couple of hours. I mean, we were talking just a few minutes ago, Jess and I, about how remember the Apple event? Remember that was September 12th? That was that felt like ages ago. Yeah.
And let's not forget also the possibility of a looming shutdown. I know that people are so inured to this, thinking that, Washington dysfunction is a normal part of the market, but it does feel like there is a lot of the division politically is a lot more entrenched this time. Romaine is laughing at me. Yeah,
division
I know.
even within certain parties here. I forgot about the shutdown. Thanks for bringing me down.
That could happen. It'll probably get pushed off later on, but it's going to be a focal point.
Yeah, it's going to be a focal point here. We'll see if that has a material impact on the market as markets try to look past that here. Of course, the big event next week is going to be the Fed here. A catalyst actually starting to build back up. Whether that ends up being good or bad remains to be seen. A lot of talk coming into this week about whether the major indices could hold the line, a tight trading range that they've been in, hugging some of those key moving averages. But we're getting a break to the downside here on this Friday afternoon. A Dow Jones Industrial Average down more than almost 300 points here on the day, or about 0.8%. The S&P 500 could not hold that 4,500 level, closing at right around 4,450, down 50 points or 1.2%. The NASDAQ Composite lower by about 1.5%. And your laggard here on the day, or actually, I shouldn't say a complete laggard. The Russell 2000 going to close down by 1%, basically even.
Taking a look under the hood for the S&P 500, about 20% of the stocks, just that, were advancing today. But then if you look over at the decliners, just over 80%, Scarlett.
And if you look at the S&P 500 index by its 24 industry groups, it is a sea of red. Let's start with the best performers here. Telecom services, transportation, healthcare equipment. At one point, utilities were up there as well. What's notable is a lot of these have high dividends. We were just talking with Tom Galvin, who was saying that AT&T and Verizon have dividend yields of in excess of about 7.5%. On the downside, chip companies off by 3.2%, retailers off by 2.6%, and software companies losing about 2.25%.
I'm going to take a look at what's happening with the gainers today. Typically, I have the decliners, so it's nice to be on the other side of things. But when you want to look at some of the few bright spots here, Apellis Pharmaceuticals, that's ticker symbol APLS, it's actually gained about 2.6%, best day since September 1st. So what happened there, Wells Fargo actually upgraded the company to overweight from equal weight. And they did say the worst may be over regarding some of the reports of severe inflammation associated with one of the drug makers' eye drugs there. Another one I'm taking a look at is Moderna. That stock up about 1.6%, so its best day actually just since Thursday, because it has had a bit of a boost this week. But obviously today you're looking at these new COVID-19 vaccines that have been made available. And then I wanted to point out also, when it comes to some of these airline stocks, Southwest in particular, because a lot of these names have been under pressure with some of these outlooks being cut back when you're looking at American Airlines early this week, as well as Spirit. But LUV is a ticker symbol on this one, up about 2.6%. So it's best day since June 27th.
Yeah, I'm going to lean into some of this market angst right now and talk you through some of the decliners. Planet Fitness really catching Wall Street off guard with the departure of its longtime CEO. Shares there falling at a 3-year low. Chris Rondeau is out. He's been CEO since 2013. He's not immediately being replaced. The shares have been down about 24% through yesterday, now down about 36%. So maybe it's just a transition for the company. Also looking at KLA Corporation. This is a semiconductor equipment maker, but I really could give you just about any chip maker or semiconductor equipment maker here. There was a Reuters report out that Taiwan's TSMC telling major suppliers to temporarily delay delivery of high-end chip-making equipment. They're concerned about customer uptake there. The stocks also down about 3% on the day. And finally, Lennar, this is the home builder. Markets processing somewhat disappointing results late yesterday. Yes, it beat on expected orders for new houses, but gross margins seem to be be pressured. The company really just trying to keep customers buying homes. You know, JP Morgan says they thought the order growth would be higher, but Vital Knowledge pointing out that people just seem to be looking for any excuse to sell this group, with average mortgage rates well over 7%, guys.
Yeah, a lot of great stories this week, and we should just point out, as far as the broader market on that volume and the triple witching volume, looks like we're going to come in. It's the third highest volume day of the year. The other two high volume days were also on triple witching Fridays here. Let's take a look at the yield space here. There was a lot of volatility, but actually not a whole lot of movement in where yields are. You're looking at 2 basis points here on your 2-year yield higher, and on a weekly basis, it's only up about 4 basis points. So despite all the volatility, still yields are pretty much where they've been now for the last couple of weeks. We are firmly at that 5% level for the 2-year as we head into that 2-day Fed meeting on Tuesday and Wednesday. You had some activity on the longer end of the curve as well, particularly when it comes to the 30-year yield. It'll be interesting to see whether that flip-flops on Wednesday once we do get that Fed decision, Scarlett, and of course the big press conference that I think is probably going to be much more of an event.
Right, not to mention their economic projections as well. Another reason why yields may be moving higher is that investors could be making more room in their portfolios for the corporate issuance that's coming out early next week. It's not going to look anything like what we saw following Labor Day, but there is still some companies trying to lock in rates before the Federal Reserve meets on Wednesday.
Also, there tends to be a lot of analyst days in the month of September. That was something that Goldman Sachs analysts were pointing out that typically does add to some volatility there. So that's why they were a bit neutral on selling those puts, but also looking at what's happening when it comes to the dollar yields as well as oil prices and that kind of dynamic. We're talking to JJ Kinahan earlier on the radio program, and he's also watching 44.60 as a key level on the S&P 500 to monitor for traders.
Yeah, but if you're looking for something positive here, though, you have to look at some of these consumer expectations of inflation a year from now. Notably below where everyone expected them to be, and consumers believing we're going to get about 3.1% inflation 12 months from now. The expectations were for about 3.5%. So perhaps suggesting that the Fed's plan of attack seems to be working, even in the mind of consumers.
Yeah, even in the mind of consumers, how much has that changed, though? I mean, when you talk about oil prices going up and $91 a barrel, a lot has been made about that with WTI and how that feeds through into gas prices. Obviously, we know the Fed backs all that out, but at the end of the day, I mean, this is what people pay attention to when you talk about inflation. At least the average consumer pays attention to is what they're paying at the pump and at the grocery store.
Yeah, this week was a reminder that if inflation is going to reaccelerate, what kind of conditions is that going to create for 2024 when we see the economy slowing down as well? Today's Friday. Are you guys going to go see any movies this weekend? Any Dumb Money? Anyone?
Oh, I definitely want to see that one. It's going to be great.
Got an 85% rating on Rotten Tomatoes.
I'm excited for that.
Is that
I feel
where Carol and Tim are right now?
I think so. Actually, I think that's what they took Friday off to go together. But there was a stat I wanted to point out. So it's been 99 consecutive trading days since the S&P 500 saw a decline of at least 1.5%. So you have to go back to late April since it's been that long. And that kind of ties into a lot of the hedging and lack of hedging thereof and why hedging has been so cheap in the past 3 months.
I think Dumb Money is going to be the hit of the year.
I want to.
I don't know. I don't know if it can overtake Barbie. I assume Barbie's like the #1 movie of the year.
Oh, yeah, by far, sure.
Yeah, some superlative there, best grossing of X many years. I think.
I don't know. Dumb Money looks good.
Yeah. Are you going to watch it, Romaine?
No. In the theater? No.
What? Why not?
No. He doesn't stimulate the economy.
I actually did go to the movies last week. I did see what was it, Oppenheimer.
Like 2 months after everyone else.
Yeah, and the theater was packed. I was like, who are all these people?
You're supposed to do Barbenheimer, Romaine, where you go back to back and you see both.
I don't have that kind of stamina here. I mean, in fact,
we're spending
I gotta
well.
wait. I don't, and even Dumb Money. Look, just put it on streaming.
Perhaps.
Why are these streaming services exist in the first place?
See, Romaine, I thought you weren't going to see Dumb Money because, as Jim Chanos put it to us on radio, and I know he was speaking to you yesterday as well, he said he lives Dumb Money every day.
He does. But you know what? Is he in the movie? Who plays him? That's the question.
I don't know if he's in the movie.
Yeah.
I know Gabe Plotkin's in the movie. I know Ken Griffin's in the movie. I mean, people playing Ken Griffin. People playing Steve.
Which I think it's funny they made Ken Griffin a little, villainous, at least based on the trailer I saw. So. No comment.
I'll watch it.
All right, guys.
What's he up to these days? He moved to Miami, right?
Yes, he's
right there on
in
the water.
Florida.
Okay.
He's doing just fine, Romaine.
All right, guys.
Yeah.
We unfortunately have to go, but it's been so much fun being with y'all on this Friday. But I hear Carol Masser will be back from vacation on Monday, and Tim Stenovic will be back as well. But obviously, Beyond the Bell, Bloomberg Originals, it's on everything, YouTube, Bloomberg Radio, all the things over here at Bloomberg. But same time, same place. Join us on Monday.
All right, a lot more coverage coming up here on Bloomberg Television. We're actually going to take a little deeper dive into Intel and to talk a little bit more about what the future holds for that company, the turnaround plan. Matt Bryson over at Wedbush is going to be joining us after the break. This is Bloomberg.
Powering financial solutions that transform industries. Powering seamless execution in evolving markets. We deliver our entire global bank to power new possibilities for you. Barclays Corporate and Investment Bank, powering possible.
A somewhat tepid week for the price action in equity markets earlier this week. It picked up in a big way here on this Friday, a triple witching day, but unfortunately it was all to the downside. 1% losses pretty much across the board for most of the major indices, including the S&P 500. Not only could it not hold that 4,500 level, but some concern now that it couldn't hold that 50-day moving average. A similar narrative for the NASDAQ 100 as we head into next week, a week that, of course, is going to be dominated probably by a lot of moves in the Treasury market around that big Fed decision on Wednesday. 5% on your 2-year yield. WTI crude at $91 a barrel. This is going to cause a little bit of a rethink, I think, of where valuations are and more of a rethink, I think, of the business cycle. There was a lot of talk a little bit earlier about a note out by Bank of America's Michael Hartnett, the latest fund flow survey showing an embrace, a re-embrace, if you will, of equities. But Hartnett was quick to point out here that there's still a full-on embrace of money market funds, short duration and the yields that you're getting out of that, setting up for what is going to be a record year of inflows in the money market funds. That has not reversed just yet, though Sherry Paul over at Morgan Stanley Private Wealth says that could reverse pretty soon. She's hearing a lot from clients itching, I guess, to get in and find new areas of return, new areas of yield. As far as what happens when we come back on Monday, we should point out that in addition to triple witching, there was an S&P rebalancing that is taking place right now, goes into effect on Monday. It will add Blackstone as well as Airbnb to the S&P 500. That's at the expense of Lincoln Financial and Newell Rubbermaid. But we should point out that a lot of these stocks, including Blackstone, including Apollo, and a lot of the financial companies, particularly those exposed to the alternative asset space, have been on a tear. We're talking about 8-9 day rallies here right now that has really shown that there is a pocket of strength in this market if you dare to look. Unfortunately, you're not going to find that on the other side here. Day 2 of ARM after that 20% plus gain yesterday. Scarlett giving back some of it down 4.5%.
Yeah, and of course, on the heels of TSMC's that report that TSMC is telling its suppliers to maybe delay deliveries, not helping either. It's time now for Factor Friday. Chris Kane, equity strategist for Bloomberg Intelligence, is here now to walk us through the action. Romain mentioned, of course, ARM, TSMC, another decliner today. Chip makers, the worst performers in the S&P 500, followed by software companies and tech hardware. So I'm guessing when you look at the notable factor moves this week, growth is not near the top.
Growth is not near the top. Yeah, growth was down 2% on the week on a long for basis. Momentum was the other one that really got hurt, down about 3%. Momentum has been weak all year, so it kind of continues that. Value is up this week, about 3%. A lot of definitions have long-short value now back to positive on the year, and low volatility was up as well. With some market turmoil, that's still down a good bit on the year, but it's kind of clawing back.
I am curious if we can talk a little bit more about small caps, because the breakout that is basically no more here. And I'm curious about the momentum factors in the small cap space and why we haven't seen a little bit more of it.
Yeah, momentum has just not worked in large caps. It has not worked in small caps all year. One of the reasons why we think this is true is that the index dispersion is very high. So as a reminder, dispersion really measures how similar or different are the returns of stocks in an index. Mm-hmm. When the dispersion is high, that means the returns are very different. That should be bad for momentum, because momentum positions for trends to continue. High dispersion means that the trends are kind of changing, right? So quantitatively, that's true, and in small caps, it's even stronger. So we looked at this week. Mm-hmm. Over the last 30 years, after the lowest 20% of dispersion readings, mm-hmm. the median long-short momentum factor return over the next quarter was positive 2.25%. On the highest dispersion readings, where we are right now, the median is negative 2.25%. So you're talking about a 4.5% spread over just the next quarter based on the dispersion reading. So that continues to be a headwind for momentum.
Yeah. You know, I'm looking at the dollar, and last week we were talking up this idea that it was on this 8 straight weeks of gains, and this week it actually declined. So it's the first weekly decline since mid-July. What does dollar performance say about forward stock performance?
Yeah, so not much. There's been a narrative out there. Since the pandemic, the correlation between the U.S. dollar and called the S&P 500 has been very, very negative, right? When one goes up, one goes down typically. So that has led to this narrative that it's the dollar that's wagging the tail of stocks or leading stocks, but they're concurrent indicators. So the correlation is negative at the same time or concurrently. When you look at the correlation between dollar movements and forward stock returns, so you would use that as a trading signal or an investing signal, that correlation just completely falls apart. So it's a coincident thing. It's not a predictive thing.
Don't read into it.
Don't read into it.
All right, Chris, always great to talk to you. Have a wonderful weekend. Chris Kane here for our Factor Friday, the best of Bloomberg intelligence here. We want to continue in this space here and take a closer look at Intel. After years of mixed sentiment from investors, Intel shares actually finally performing a somewhat at an attractive level relative to its peers. Now, Intel may be viewed as the lowest rated chip maker by analysts, but believe it or not, over the last month, it's the best performer in the Philadelphia Semiconductor Index, up about 9%. Matt Bryson joining us right now. He's the Senior Vice President of Equity Research over at Wedbush Securities. And I was kind of surprised when I saw that stat. I guess it's sort of a stealth rally for Intel. What's behind it?
I think it's in part they told us that they're performing better than the expectations that they gave. That's in part, I think, due to them having guided a bit conservatively. I think it's in part due to them doing a bit better on the PC side of things. So I think when you look at chips and chips in general are struggling a bit, Intel right now is acting a bit better.
Okay, so these are things within the company's control. What about the idea that Intel's a potential beneficiary of geopolitical tensions between the U.S. and China? It is, of course, investing in the U.S., expanding its facilities in the U.S. and Europe, and in contrast to other chip makers, and I'm thinking here of TSMC, a critical supplier to companies like Apple.
Yeah, no, I think that certainly could play a role here. You have China at least purportedly talking about prohibiting government employees from using iPhones. That raises tensions. You obviously have had speculation around potential further U.S. regulations to prevent China from getting certain AI chips. So when you think about tensions rising and what that might mean for chips being made in China or in Taiwan, certainly if you're looking to move away from exposure there, you've got only a couple choices. You've got Intel, you've got Global Foundries, you've got Tower Semi, but of all of those, only Intel is producing the most advanced chips.
Yeah. Well, is Intel a good backup plan to some of those names you mentioned? They don't necessarily specialize in making the same kinds of chips.
Yeah, I mean, Intel versus your other two kind of advanced manufacturing companies out there are Samsung and Taiwan Semi, but really it comes down to Taiwan Semi is 50% of the foundry business. So if there's risk to Taiwan Semi, what other choices are there? Intel is one of the few for those advanced chips.
I am curious, too, just about kind of the American story, the homegrown story, if you will, Matt. This was supposed to be somewhat of a tailwind for Intel. The idea that it was, to a certain degree, removed from some of the geopolitical issues that you would have to address with the Taiwan Semi, with even with the ARM or ASML or anything else out there. Here, Intel seemed to be much more contained within our borders, at least in terms of its operations and manufacturing here. Does that not work as a somewhat valuation enhancer?
I think it should. The other piece of that, though, of course, is that Intel needs to show that it can execute on its roadmap. And so the thing that Intel struggled with over the last 5, 6, 7 years is getting their manufacturing in line. One of the things I'm looking for at the innovation event next week is what they have to say about their new notebook chip, Meteor Lake. That would move them from 7 nanometer to 4 nanometer in terms of production. So what they have to say is an important benchmark in terms of if they're executing on moving along their manufacturing path and catching back up to TSMC in 2025.
All right. Matt, great to talk to you. Matt Bryson there over at Wedbush, a deeper dive into Intel. And, of course, that big event next week. We'll have coverage right here on Bloomberg Television as it happens. Coming up here on the big program, a lot more to cover, including a sit-down with Aaron Brown. We're going to get his insights on why the traditional correlation between stock and bond returns is shifting in a very meaningful way. That conversation up next. This is Bloomberg.
What do you see on the horizon? Uncertainty or opportunity? Whatever you see, at PGIM, we can help you rise to the challenges of today, when active investing and disciplined risk management are needed most. Drawing on deep expertise across the world's public and private markets in pursuit of long-term returns. PGIM. Our investments shape tomorrow, today.
There was a recent paper out there analyzing the correlation between stock and bond returns. It went all the way back to 1875, and it suggests the relationship of the past quarter century is changing, and it may cause some investors to rethink their portfolio allocations. Aaron Brown wrote a column about this for us here at Bloomberg Opinion. He is the former managing director and head of financial market research at AQR Capital. And I was really fascinated by this because you kind of forget, Aaron, or at least some people forget, not you, that a lot of the risk taking, or at least the risk profile that investors were able to sort of structure their portfolios around, was directly tied to this inverse correlation between stocks and bonds.
Certainly. Since the year 2000, we've had a negative correlation, and that sounds pretty technical and quantity, but what it means is the more risk you took in bonds, at least up to a point, the less total risk in your portfolio. It wasn't just a diversifier. It wasn't just a way to own fewer stocks. You actually could eat up some of the equity risk using bonds. And I think a lot of investors and managers and advisors have gotten used to this and think of it as a normal, but it really isn't. For most of history, we have a positive correlation. And in particular, some of the things we're seeing in the markets today, rising and uncertain inflation, possible aggressive Fed actions, are the kinds of things that historically have destroyed this negative correlation.
Well, I'm curious, okay, destroyed it. I mean, that sounds like it's not coming back, like it's over. I mean, look, I understand this was kind of like, us being able to have our cake and eat it too here. But is there some sense that what's taking place right now is so significant in structure that we're not going to be able to rely on that inverse correlation anymore?
I don't like to predict it that much, but we just have to say for, 150 years of history, it's been mostly positive. This is the longest period we've ever seen negative correlations, and they seem to be shrinking. So there's at least a possibility that we go back to the old normal.
Okay, so since 2000, there's been a negative correlation, but if you go further back, the old normal is a positive correlation. What if it's no longer negatively correlated, but it's not even positively correlated? It's just the correlation is zero.
The Goldilocks. Well, that would make bonds more valuable than they were traditionally, but it still will mean they're not as valuable as they have been since 2000. And in particular, it says to investors, maybe you don't want to take a lot of risk in your bonds. You might want to put money in bonds to get them out of stock. So you buy money markets and treasury bills, but you don't buy the long-dated bonds, you don't buy the risky bonds, the corporate bonds, where a lot of investors have been picking up yield.
So that raises an interesting question, because when you talk about bonds, fixed income, it obviously includes more than just U.S. Treasuries. You mentioned T-bills, obviously corporate credit, both investment grade and high yield, TIPS as well. Should high yield credit be kind of its own category rather than lumped in with the rest of fixed income, the rest of bonds?
It's a hybrid, right? So you're taking the bond risk plus you're taking some credit risk. And credit risk is highly correlated with equity risk. We know that.
Yeah.
But it's not the same. It does some diversification. And a lot of people think you get more reward for credit risk than you do for the same amount of equity risk. Credit risk seems to be particularly scary to a lot of people.
When you hear some of these alternative asset managers talking about the diversification benefits of kind of this new crop of alternative investments, they kind of pitch it as the idea that this can sort of be similar to what treasuries were, what fixed income was, being that ballast in a portfolio, that can now sort of provide that same role.
That's absolutely true. And in fact, one of the reasons hedge funds have had a little bit of a struggle since 2000 is that bonds have given a lot of what hedge funds traditionally offered. The old mantra of hedge funds used to be, we'll give you bond equity returns with bond market risk. But when the bond market risk was actually negative correlation, that was pretty hard to deliver. If bonds are positively correlated, that will push a lot of investors to look more seriously at alternatives.
All right, Aaron, great to talk to you. Aaron, of course, is the former financial market research head over at AQR. He's now a Bloomberg opinion columnist. A great column the other day here about that breakdown of correlations, and I actually urge you to read another great column he wrote today here about the quant revolution, and a great documentary here about the role Tom Wolfe played in that. A lot more coverage coming up here on the big program, including a discussion about the future of the labor movement and unions, Scarlett, here on a day, of course, where we're all talking about this latest strike here going on right now with the three biggest automakers.
Right. There's actually a report, a headline from another network saying Ford is laying off around 600 employees at a Michigan plant as well. So we'll keep you posted on the developments. Yeah, potential big ramifications here depending on how long it goes on. Stick around. That conversation coming up after the break. This is Bloomberg.
If we need to go all out, we will. Everything is on the table.
Our team knows how to manage these situations. They're staying agile, and we're going to do what's right for the company. We're going to make sure everyone stays safe. But this is a strike that didn't need to happen.
Our two factories are not under UAW, but obviously any disruption and any issue will have will give some shocking waves out to the whole industry.
In the last 2 years, we've learned a lot how to be less reliant on one or another supplier. And also, we are a very much vertically integrated company. So I hope things will end up in good place for everybody, and we'll continue to produce cars and sell cars.
Those are just some of the auto executives we heard from this week discussing the UAW strike.